Introducing Sean Emory, founding partner and chief investment officer at Avory and Company.
Hello, everybody. Welcome to Avory Idea Day 2024. This is our fifth time doing this, and we're so happy to bring these type of conversations to the forefront. I am Sean Emory, the founding partner of Avory and Company. Alongside me and putting this together is our other founding partner, Luis Alvarez. You've seen him on many of our other webcasts, but he also echoes my sentiment in welcoming you to this year's event and sessions. Now, before we get started, I think the bigger question is, why are we doing this? Why are we doing this today? You know, at Avory, we are an investment firm. We're here in Miami. We're data-driven. We invest where the world is headed. That's our focus. And in order to do so, we think you have to have these types of conversations. Without these discussions, there's no discovery. Without discovery, there's really, no way to really pinpoint the direction of some of these breakthrough innovations, such as eVTOLs, which are electric takeoff and landing aircrafts, or what's happening within the Fintech ecosystem as digital wallets continue to prosper, really in an age where younger generations become older generations and those habits transform into habitual use cases like digital wallets. We're all asking ourselves, where and what artificial intelligence can achieve. I think we all witnessed that day ChatGPT launched from OpenAI. The question really now is this evolutionary or revolutionary? Is this a new way of building business, of doing business, communicating with others? Will this create new industries? Will this destroy some? Will it be somewhere in between? Our views is have these conversations and try to discern, what is the potential outcomes here. Now, our sessions will cover many of these aspects. Speaking to someone like Mark Mahaney at Evercore, who has covered the internet for multiple decades, somebody that has a great purview of the building blocks of the internet, cloud, where we are today. We'll have someone like Michael Halen from Bloomberg Intelligence speaking about how robotics, AI are impacting restaurants. This is a legacy industry that has not innovated in years, and yet we may find ourselves at the forefront of something happening in the back office or in the kitchen. Or Max Friedrich and Will Summerlin. They'll join us today. You'll likely remember Max specifically on our podcast many years ago. He was a leading fintech at ARK Invest and has since gone and started Autopilot, a venture firm focused on specifically AI. And we'll have Will Summerlin from there joining us from Autopilot. Or how about the crypto economy? One use case emerging, I think, is tokenization within the financial service industry. And we have Jeremy Schwartz, the global CIO from WisdomTree, joining us and speaking about this topic specifically. The list goes on, but the focus is the same. We're trying to discover and doing so with you at the same time. Where is the world headed? That's the big question we're trying to solve. So I wanted to lay out some stats here before we get started. Our first session will be Mark Mahaney from Evercore. Now, population. If we step back and we look at the population demographics, it's at a very important inflection point in our view. You can see here the stats showing that nearly 40% of the workforce managers are millennials. Millennials grew up in an age of technology. We were the first users of Facebook, the first users of Snapchat. Many of our first phones were iPhones. Our TVs came in color. The internet was slow, but then very fast as life progressed. And so many other things that we could go over. But the most important part of this, I think, is the fact that millennials will be the dominant share of the managers for the first time ever. This equates to 4 in 10 managers being millennials, and Gen Z is not far behind, approaching 10%. So ultimately, what does that mean? That means over half of the managers out there will be Gen Z or millennials, and they're tech enabled, they're tech first. That's super important when it comes to enterprise corporations. They're more likely to embrace technology, and that means many of the technologies of the past will continue to compound into the future. The second thing is ChatGPT. This was launched roughly 2 years ago, and it's proved to be one of the most successful, if not the most successful launches in history. The speed of adoption has been quick, and data shows that the adoption has been sticky. Recent data shows that there's now 350 million monthly active users, up from 100 million just in March. While only 10% are paid, that's somewhat of a small number considering this size of their monthly active users. Those numbers are staggering nonetheless. We don't know yet at this stage, what will happen in the future. We do know that generative AI is something of importance to people's lives. Even Apple has spent quite a bit of time here trying to market it, selling iPhones that have Apple Intelligence features all across it. And we think that could drive some change. But ultimately, we're in the wait and see, but we're following the story closely. various AIs. And when I speak about AI, I think, it's important to focus not only on the idea of AI, but there's generative AI and some of the other things that are happening within the field. Generative AI is pretty new in terms of its capabilities. The field of AI is old. It's been with us for multiple decades. You can see here in the history diagram where we're showing things like, in 1950, Alan Turing proposed a test for machine intelligence. Siri came out in 2011. Companies like Meta have been using AI to personalize your and my Instagram and Facebook since its beginning. IBM constantly professed about IBM Watson and the AI capabilities there and what that could achieve, but we know the outcome there. We know Waymo has been in existence for over a decade, and they've been using fully autonomous features and capabilities using artificial intelligence to automatically drive passengers to places in Arizona. They've launched in other states. The latest stat around Waymo is 22.2 million miles driven across 4 states so far. So we know AI has been with us. It's really the jump in generative AI. eVTOL, I spoke about this earlier. But speaking of transportation, we're happy to talk to two founders throughout this session, and we're focused on eVTOL, and that's stands for Electric Vertical Takeoff and Landing Aircrafts. There's publicly traded companies in this space now. You have Archer, you have Joby. They've all raised significant capital. They're ready for a commercial launch here in the coming years. If you've not seen this before, these are essentially massive electric drones. They somewhere looking like a jet, and it also kind of looks like a helicopter. Similar to, I think, autonomous vehicles on the ground, eVTOL, we think, will create a sea change among the current state of aviation and likely broader as it provides, access to different locations at what sounds like a fraction of the price. So more to learn there, and we'll have some conversations around that. Stopping there, I think ultimately, either way, I'm excited about where the world is headed. There's a lot of interesting things taking place all at the same time. And while there are things like the macro, inflation, the thought of where are rates going, sentiment shifts all across the board, geopolitical risks that we think are more frequent than they definitely should be. Our goal here at Avory is really to gauge the macro. We have some sessions on that today, but also make our best judgment about, where's the world headed, find capable management teams that are executing that vision, do so in a financially prudent way, remove the hype of pure storytelling, and source ideas and evaluate the ones that make long-term sense while also, including some form of margin of safety in that investment. Before we get to our first session, again, Mark Mahaney from Evercore, I did want to bring on Houston Hess. He's our head of operations and compliance. He has a few words and disclaimers to share. If you have any questions related to Avory, investments, questions around any of the topics today, shoot us an email. You can email us at avoryco.com. It's team, TEAM, at AVORYCO.com. I think you can see it here in the visual. Same thing, if you have any questions about our respective guests, please channel that to us as well. So with that, I'll pass that to you, Houston, and we'll get started with Avory Idea Day 2024. Thanks for joining, guys.
Hello, everyone, and thanks, Sean. Welcome to Avory Idea Day 2024, our first Idea Day from our new office space here in Coconut Grove. It'll be an exciting event with a bunch of great sessions from industry experts, data providers, founders of companies, and interesting industries. I'm Houston Hess, head of compliance and operations. And before we kick off, I just want to read a quick disclaimer. Avory & Company is a registered investment advisor. The information presented is for educational purposes only. It does not intend to make an offer or solicitation to sell or purchase any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed in this presentation does not consider your specific situation or objectives and is not intended as recommendations appropriate for any individual. And with that, I'll pass it back over to you, Sean.
Welcome, legendary analyst and investor Mark Mahaney.
All right, so let's get started here for Avory Idea Day 2024. We're here with Mark Mahaney. He's one of the best. He is one of the senior directors at Evercore ISI. he just entered, the Pro Bowl 2024. I think, correct me if I'm wrong, on the all research team, covering things like internet, small caps and large caps. I've been following you for a long time, going back to the days of, when Wix went public. You were at another firm at the time, but pretty interesting to say the least. Welcome today. You
Thanks,
have a
John.
book out as well. So
Nothing but net.
there it is in 2022. I think they can find it on Amazon. If not, the team here will make sure that it is, highlighted. Always appreciated your work. But, today we wanted to cover the internet, the, state of the internet today as it relates to, some of the more important things that are happening in the world, like Gen AI, maybe some of the impacts there, some of your best, thoughts around the companies out there. And then other topics as well. But, first and foremost, I wanted to welcome you to Avory Idea Day 2024.
Thanks, Sean. Great to be here.
Yeah, so let's kick it off. The state of the internet, obviously that's a pretty broad topic. But, someone that's covering it day to day, how are you thinking about the state of the internet as it relates to, now and into the future?
Well, let's see. We just finished earnings season. I work on Wall Street, so I'm obviously very triggered by anything related to earnings, and triggered in a good way.
Sure.
There's kind of three big themes I think I'm seeing in the space, year to date. And the internet, covers. I'm talking about Amazon, Google, Meta, Netflix, Spotify, Uber, Booking, Airbnb, Shopify, Trade Desk. There's a bunch of names in there. We cover me and my team. We're based in San Francisco. There's 6 of us. We cover almost 40 stocks. We have a very broad view into the economy. I mean, Amazon, Shopify, and eBay, that's $1 trillion in retail spend. Google, Meta, even Amazon's ad revenue and Trade Desk, that's like $500 billion in ad spend. And then Booking, Airbnb, and Expedia, that's like $300 billion in travel spend. So we have a pretty broad view into the economy. One of the first takeaways I have of the three is that overall demand trends seem actually pretty good. In fact, demand trends at the margin now versus the beginning of the year, I'd argue, are actually a little stronger. And we're talking mostly consumer demand trends, but there's some enterprise in there too. For example, cloud computing growth, I think, is a little stronger now than it was at the beginning of the year. So the macro demand trends, the read I have just from the companies I cover, but I have a lot of that, they have a pretty big read into the economy, are actually relatively robust. It's not 10 on a scale of 10, but it's 8 or something. It's pretty high up there, and it's improved since the beginning of the year. That's the first takeaway. Second takeaway, just thinking about these businesses, but there was this year of efficiency that Mark Zuckerberg kind of used. I don't think he coined it, but he was associated with it, and how he started managing the expenses much more aggressively at Meta. Well, I think it's become years of efficiency, and across a lot of these companies. We just finished a quarter in which the following companies recorded record high operating margins. Record high operating margins. Here's the list: Amazon, Google, Booking.com. I know I can come up with some others. I think Meta was in there too. Netflix, Spotify, Uber. So a large number of these. And so what I think has happened is there really is, I don't know if it's a sea change, and I always hate using those kind of terms because things can switch right back. But these companies have become much more careful about managing expenses. They've matured. They're not going for growth. They're not going for growth. It's not growth at all costs anymore. And that means for investors, we've had margins that are holding or expanding, which is great. If you get good top line growth and margin expansion, that's what you want as an investor. And then the third thing, and you touched on this earlier, is AI. So look, we've had a massive amount of investments in the sector from the hyperscalers that I cover, Amazon, Google, and Meta. I mean, their CapEx spend is going up aggressively. They're doing like 150 billion in CapEx next year. Not all of it, but a lot of it's triggered or driven, I should say, by AI, by Gen AI. But I'm now seeing, and then we as investors are starting to see more and more data points that suggest you're getting an ROAI. Return on artificial intelligence. The number of data points that keep coming up each earnings cycle about companies that are getting 25% efficiencies, like getting more output per engineer. They're using artificial intelligence and machine learning to better personalize their experiences. That's what Meta has done with Facebook and Instagram, and it's led to like 8% increase in people's time spent with Instagram and Facebook. Look, you give Meta 8% more audience engagement, they'll generate more ad revenue for you. Even small companies like Duolingo and Booking, they're using AI and they're doing it to improve processes, make their services more relevant for their customers. They're personalizing them more, and it's led to cost efficiency. So you're starting to see, and AI is going to be a gift that keeps on giving. For this is not going to be a quarter or two. Like we're going to see this for a couple of years, like greater efficiencies, better products, better processes. So those three reasons probably gave you too long of an answer for you, Sean. Three reasons I got positive. I'm seeing these companies really kind of drift into these years or execute on these years of efficiency. And I'm seeing more and more positive data points on AI deployments succeeding in terms of improving products, processes, and costs. And I'm thinking generally, I want to be bullish. I want to stay bullish on this sector.
Yeah. Okay. Yeah. No, you packed a lot in there. So let's deconstruct it a little bit. So starting at the top, you highlighted, the fact that you're seeing consumption trends pretty strong. Now, my big question there is obviously the Shopifys of the world, are they taking share? And therefore that's the driver of growth, bottoms up versus top down. We know retail sales are, still pretty strong. I think Deloitte, KPMG, MasterCard are all like, expecting, 3 to 4% growth in retail sales this year. That's kind of probably the driver of growth for many of these like commerce platforms. But then Uber doing pretty well, Meta doing pretty well. So do you think it's more share shift to some of these more, innovative slash companies over the last couple of years that have been the enablers of, shift to the cloud versus, do you think it's actually a purview into the health of the broader economy? It could be both, right? But, what's your views on that?
Well, Sean, I'd probably agree with you. It's probably both. I mean, if Amazon is doing 800 billion in retail sales, like, I mean, they're cyclical. I mean, they're secular and cyclical, but there's clearly a cyclical element. If the U.S. consumer was getting weaker, I mean, Amazon wouldn't be able to escape that. But there are some product cycles that are going on here too. So, I focus like heck on these product cycles. What's the big product cycle at Amazon? Faster shipping. Like, it may not sound like a product cycle to most people who think about the next gen of iPhones, but you bet that faster shipping speeds matter. The concept of demand elasticity. Lower the price, the more the demand. Well, I think Amazon's kind of showing you shipping elasticity. The faster you ship, the faster people shop. I think that's absolutely true. I've done survey work to kind of really test this out. I call it testing the obvious, because of course, the sooner the instant gratification, right? Like, this is not a novel concept. And but anyway, so Amazon is sustaining kind of high single digit, kind of 8, 9, 10% growth. This is not the Amazon of 10 years ago or 20 years ago, but it's still 3x the growth of retail sales growth. But they're doing that because retail sales are generally holding in okay. They're not 10 out of 10, but we're not seeing a fall off in consumer discretionary spend. And then Amazon is also just doing better and better customer service, broader selection, better prices, and they've got this. They're really kind of leaning into faster and faster shipping. And Amazon households, like, you can look at this anthill data. Those Amazon households, they get products shipped more to them. More quickly. Greater chance of getting products same day. Well, they're doing more of it, and especially household essentials. It's like a big new area that Amazon's really tapping into. So yeah, there's some product cycles in here. So it's macro and company execution reasons. And by the way, best example of this is eBay. eBay has the same overall trends, in terms of macro trends, but they're vastly underperforming. And I think it's just because it's a really poor performing asset, and has been for a while. I think they've got structural challenges there. So I think the Amazon eBay contrast kind of says to you, yeah, there's a good macro environment, but the way companies execute against that macro environment matters.
Yeah, that makes sense. The fact that eBay is, staying afloat is probably driven by the macro, but someone like Amazon thriving is probably driven by the product evolution. And add me to your survey from the standpoint that I'm definitely one of those that are ordering more frequent, just in the fact that I can probably get this thing within the next, today between 5 and 10, it always says. So pretty interesting. Going to the second point, I think is really around margins, and
Yes.
we know what has happened. You kind of had this period of which, maybe two things happened. Number one, you saw private equity kind of pull in the reins, which didn't allow maybe some of these startups to, essentially sell things for free, to, lack of a better term. And that put some pressure on the margins across the board within some of the incumbents or tech enablers. Over the last couple of years, you haven't seen that, which has given the breathing room for someone like a Meta to kind of flush their expense cost structure. Maybe some of the others as well, like an Uber, not battling as much on cost and for talent with what we saw with wages and those spiking in 2022 or 2021. Now, but peeking out on the horizon, right? We know yesterday or the day before, Klarna, is one of those that basically said they're likely to file for an IPO, or they've just filed for an IPO. You have probably the Stripes of the world and many other maybe ecosystems that exist out there or companies. Do you think we're on the horizon of kind of that 2019, 2018, maybe not 2020, 2021? Now, I think that was a special period. But, are we back where maybe margins from here on out are capped at these levels, at record levels, still really good? And it's more about our revenue driving, net profits as opposed to revenue plus margin expansion.
Well,
It's a hard question, but
it's a good nuanced question. In an industry, a lot of tech, it's got a lot of fixed costs. It just does, and so if you can sustain premium revenue growth on a somewhat fixed cost basis, there's always variable costs and fixed costs, but on a somewhat fixed cost basis, if you can sustain premium revenue growth, your margins are going to keep rising. So no, I don't think we're capped on margins, but that's depending on two things: whether the revenue growth trends kind of remain consistent, and I think they will, because I've got a generally positive view on the macro environment. There's always, always black swan risks out there. There's always another Ukraine, China, COVID risk. That's black swan stuff. We always got to be careful about that. The biggest lesson in the last 3 years. The second thing, though, is these companies keep executing, and is there a kind of a new technology platform shift that kind of can further maintain or accelerate this growth, and that's AI. So yeah, I'm pretty confident that barring black swans, I'm pretty confident that these growth trends are gonna kind of hold, kind of be consistent. And then the second thing you got to ask yourself is there really a change in attitude amongst these companies? And I think there is, but stuff can always go back. But this is not, we're not go. I mean, there are parts of technology that are absolutely go growth. But the internet sector that I look at is much more mature than that. There's a few go names in there, go growth names in there. Duolingo is one very well managed company, a stock that I've really have liked. It's been my top pick from time to time. It's not now because of valuation, but
agree there.
These companies, they're just more mature. They're acting their age, and growth has slowed down. They're not growing 30%, 20% top line anymore. Google's not. Actually, shockingly, Meta is, but that'll fade to mid-teens next year. And there's a realization that, and maybe something else happened. Like the market sometimes play a very effective role in guiding companies. And the lesson that Wall Street gave to these companies was they way overhired. Now, this is all easy to say in hindsight. They way overhired and way overbuilt during COVID. And then Wall Street made them pay the price for that. Those stocks corrected 50% in the first half of 22. And I think companies like Meta took the lesson and realized, we're going to make more money as stakeholders in the company if we get tougher on our expenses. And let's from now on run the business such that our expenses will grow, but not as quickly as our revenue. And I think a lot of companies in tech kind of got this memo, and that's why we've got these record margins now. So I think there's been a shift in mentality. It can go back. We may get irresponsible again, but right now I'm seeing rational exuberance. I'm not seeing irrational. And what I mean, and then we'll talk about valuations next. But I mean, in terms of the way these management teams that I cover day in and day out are operating.
Got it. No, that makes a lot of sense. Yeah, Duolingo. That was we had the CFO here, a couple years back, 2 years ago, and on Avery Idea Day, what is it, like 2022 or something? And that was one of our, again, we're buy side, so we were one of our better ideas at the time, and eventually valuation, got a little excessive. Great company that shifts to the conversation around AI. I know they're doing like Duolingo Max and conversational kind of AI within a language learning, but beyond just that, talk about how, like, where are you seeing AI fit into some of these companies that you are tracking? And there's the question of whether it's a revenue driver versus an efficiency driver. And obviously those that can kind of manifest both of those at the same time, I think, are the ones that are possibly getting the deeper re-ratings or more re-ratings or higher multiples based on that. What's your views on AI and kind of like where it fits into some of these companies or
Yep.
industries, small, large? There's different nuances. So however you want to slice it.
Yeah, yeah, Sean, thanks for setting it up. So, again, I look at this, I lean on fundamentals more than anything else as a stock picker. And again, I think macro background is constructive. I think management kind of cost management background is constructive. And the third thing is AI trends. And I remember writing a report a few years ago saying, when am I going to see? When are we going to see this ROAI? Return instead of ROI, return on investment,
It's a great
ROAI.
acronym.
Yeah, I take some credit for that. Every once in a while, something good. And it was unclear. Like, there's no, I can't, there's no. You can look through the P&L, and you're not going to see like an AI line. I don't think you'll ever see an AI line, but you're seeing more and more of these data points, more and more of these deployments of AI. So I don't have a. I wish I could give you a number. Like, I wish I could tell you that the internet sector is seeing a 2.6% increase in revenue because of AI. You're not going to get that. But what you're going to see are these small little examples, and they're going to become bigger and bigger, of products that are being rolled out that are enabled by AI. You mentioned Duolingo. This is a very small example, but it's a wonderful example. I use Duolingo Max. My wife's a doctor. I go with her once a year on medical missions overseas. And we went to Senegal, and I used Duolingo Max to ramp back up on that French I learned in high school. And, Duolingo Max, because of AI, I can do these conversations in French with like a video bot. And That's AI at work. And it's such a powerful tool, and it really helped me ramp up, and it helps a lot of other people who sign up for Duolingo Max ramp up. But it's something like you wouldn't have had that a few years ago if it hadn't been for AI machine learning. So there are products out there that they're literally putting a higher price tag on. That's one example. Now, other companies are finding that because of AI, they don't need to hire engineers as much. Like the productivity, the amount of code that can be run, that can be generated, that can be tested per engineer is greater now than it was before, because they can use AI tools, Copilot and things like that, to do their jobs. And so that's kind of an efficiency point. And then I'm gonna veer off a little bit here. I want to ask you to think about two other examples. Robotics. I don't think that's oftentimes associated with AI, but it should be. And Amazon is starting to really aggressively deploy robotics, and you bet that that's going to reduce the cost to serve, the amount of money and the amount of time it takes for them to get those packages off the pallets, run them around their distribution centers, put them in the trucks, get them to your house when you order something. Like, they're using robotics to do this, and at scale, I think that's going to be a great cost savings. And finally, my favorite AI example, I'm out here in San Francisco, and this is Waymo City. And like
Oof.
my staff and I, we use Waymos. I got a couple of younger people on the team who live a mile or two away from the office, and they use Waymos, get back and forth. And it's just like this. It took them 19 years to get where they are now. That's how long it takes some of these really
Wow.
great tech innovations to happen. And there's still a lot of improvement that could be done. But like I just love this example. And um, anyway, so that's a little bit of a stretch, in terms of the examples. I think it's gonna be really interesting to follow in the public markets. I really hope they come out into the public markets. We'll see. But anyway, I think we're seeing these AI deployments by the largest companies. I think Meta's been able to use AI to improve their ad targeting, so they help their advertisers, and to make their service your news feed is now more relevant. I would argue to you, it's more relevant, it's more interesting, more engaging. I may be wrong, but that's the case. And I hope you're watching this. You're probably nodding your head. I hope you are. And and that's look. And Meta gets you to spend more time in the feed and in the reels and in videos and watching stuff that you're just more intrigued by. I mean, I notice it. Like this kind of stuff that's in my news feed now is so much more interesting to me than it was several years ago. And I'm spending more time on Meta, and that's AI. They're using AI to go across the internet, find stuff that's relevant to you, and bring it to you. And more time spent with Meta means more ad revenue. That's why they had almost 30% revenue growth earlier this year, off of 100 billion plus ad revenue base.
Wild.
Wow. So yeah, there are plenty of examples, I think, and I think they're growing. And every quarter, I try to put together this list, and I'll have it in a report I put out to clients on Monday of the latest data points I've gotten. But that list is growing.
Nice. Yeah, no, that all those are interesting anecdotes. And to add, you see someone that's like Microsoft with Azure, where I think they broke out the AI compute spend, which I think added like another 8 to 9% of, quarter to quarter, growth, which was really the driver of the acceleration. So you saw some, dollars and cents there. Again, that was more compute resources as opposed to, some of the products that you're talking about, which I think are much more interesting than, compute resources. Again, to me or to us, just basically highlights that people are spending. The question is, are they getting, your term return on AI spend, capital, whatever the acronym was, but it was a great one. Shifting. There you go. There you go. So shifting to like the here and now, right? We're seeing kind of like this renaissance again, and I think you see this in waves, right? Which is in the crypto space. And I don't mean it to go into crypto land, but I mean to ask about decentralized internet. I'm talking 10, 15, 20 years from now. Have you thought about it? What does that mean? We kind of talked about this maybe 6 years ago when there was the whole wave of decentralization. I'm not sure exactly how that manifests. You have the Blue Skies of the world and Jack Dorsey's, trying to do, Nostr, and I think it's called something else now. But, it's the fact of data going back in the hands of the individual, and then the underlying internet, almost like how open source functions. Just any generalized thoughts. And I ask that now, just given the fact that Bitcoin's hitting X dollars a day, and it's just a thought. And someone that's been in the space for quite a long time has seen multiple iterations of what's happened to the internet, and this likely seems something that is investors should have on the back of their mind.
Well, I'm mostly going to punt on that, Sean. I don't formally cover this space. I'm intrigued enough that I have a tiny, tiny little investment in Bitcoin, just because it strikes me as there's probably a there, but I don't have a strong opinion about the best way to play it and to invest in it. So I'll just let me punt on the rest of that. Sorry.
Yeah, no, fair game. I didn't even remotely hint that I was going to talk about that. But the I think one thing I wanted to learn a little bit was nothing but net. Like, talk to us about the origin of it. What is your underlying thought there in terms of the book that you have?
Yeah, and of course I keep it around. Yes, it's on Amazon. And look, I gave a speech a couple of years ago where I tried to distill some of the lessons I got from, spending 25 years covering one of the most explosive parts of Wall Street. The good and bad. In terms of tracking Amazon from the way beginning days, and Netflix and Google, and also the companies, the stocks that didn't do so well at times, eBay, Yahoo. And I went through my good calls and my bad calls. You learn from all of it. If you can't learn from your bad calls, then you're in the wrong business. And
Sure.
like everybody, I've had plenty of bad calls, and I've had some decent good calls too. So I tried to draw some lessons from that and put it in the book, and what to look for. And if I were to really summarize it all in a phrase, it's DHQ. Now, not DQ, that's Dairy Queen, but DHQ is dislocated high quality names. And so my pitch was, I try to put together a framework for how you figure out what are high quality names, and then I just try to instill in people the patience to wait for them to be dislocated. And usually it's a simple rule of thumb, a 20 to 30% correction. But I try to give more examples than that in the book. And so that's what I'm sort of hunting for DHQs all the time. High quality companies are usually very quickly companies that address large TAMs, total addressable markets, have excellent management teams. That's a very hard thing to prove one way or the other. But you can look at track records. I look for companies that are very good, really powerful customer value propositions, and then are really great at product innovation. And so I try to provide a bunch of examples for each of those things, especially on the management team. I'll give you this one quip, which is, when you watch these financial shows or see the ads, they always say, past performance is no indicator of future performance. They always say that. I think that's true, but it's not true with management teams. I find that you find a good management team, and they're successful in multiple different product areas. Like, somewhere along the way, Amazon went from being pure speculation, to being an asset that you really should look to stay and buy and stick with in the long term. Somewhere along in that framework, not 1999, not 2002, somewhere later on is probably when they rolled out cloud computing and Kindle and showed you they could expand into multiple different areas, when they could prove that they could succeed in multiple different ways. Realizing you still can get the team that you generally want to be in. So anyway, and the
Got it. I'm going to give you a rapid fire here. Off the cusp, your and you can answer it if you don't, if you want to. Favorite management team?
Well, it's probably going to be Amazon. But if I want to give you a more interesting kind of off the cuff, a more Booking.com. And then
Wow.
I'm going to get even a little bit further out, and Netflix. And then I'll throw in the last one you and I talked about, Duolingo. I love to see these founder-led companies. I generally have a bias towards founder-led companies, but of course, a lot of founder-led companies never make it. But I like this, the founder who has the vision and the patience and can be long-term oriented, and it's his or her baby, and they've got skin in the game, and they're just passionate about it. All of those I mentioned are founder-led companies, except for Booking. So it doesn't have to be the case, but I like those and companies, and then companies that show that they need to be battle tested. And Booking.com's been battle tested. Look what happened to travel during COVID, in and out of COVID, decimated, recovered. I like to see companies do that, and companies that can roll out multiple different products to show that they can succeed in more than one vertical, and then are willing to acknowledge when they make mistakes and hard pivot. And that, I think, is the example of Netflix when they kind of ran out of gas in their core subscription business and realized, hey, maybe we always hated advertising, but maybe it's time to start advertising, lowering the price point and going with an ad-supported plan. I think that was tough for that management team to swallow that, but they did, and they quickly pivoted. And within 2 years, they now have a very successful ad-supported business that's ramping up. That's half of their new subscribers. So yeah, they acknowledged they made a mistake and they pivoted, and and you had a great chance to buy it on a massive dislocation. So anyway, those are 4 management teams and some of the reasons why I like.
Cool. Next rapid fire question is metaverse or not to metaverse? What is your
TBD? Totally
TBD?
TBD. But I will tell you something. Like I want to see these companies. You want to have these. You want to see moonshots. Within reason. You spend a lot of time watching Google waste money on Waymo. But now, are you glad that they invested in Waymo? Yeah. And is the
Sure.
metaverse the right area of investment for Google? I don't for Meta. I don't know. I'm not sure. In hindsight, they should have renamed the company, but that's okay. And I don't know about. I've got the Oculus devices, and I don't know. My kids and I loved them for about a day. But maybe we're not being
I think I
creative.
got one somewhere around here.
But these a Meta Ray Bans. Like I tried the original Google Glass and I thought, nah. But Meta Ray Bans, there's a very interesting product that's much more natural. And I tell you, just the ability to walk around with these Ray Bans and to all of a sudden say, hey Meta, when is the Jake Paul Mike Tyson fight tonight? Like just and have it answered, kind of seamlessly into your ear, so it's not you're not geeking out too much. You're not looking awkward or odd, and you're not putting other people at, making them feel ill because you feel like they're anxious because you're like they think you may be videoing them. Like I
Sure.
really got something interesting there. So I'm not sure that was the original part of the metaverse, but I'm glad that Meta seems to be pitching that way. So that's my answer on metaverse TBD. But I'm glad they're investing in that area, and I'm very intrigued about what's happening with these Meta Ray Bans.
Yeah. Side note to that is I'm seeing a lot of creators, specifically cooking creators, put on these Ray Bans, and actually from a first
Yeah.
person, you're watching this individual cook, and it's an interesting I think use case of these type of tools for creators, which is the irony that Meta is in content platform. Last question here is the your high quality, from your book, right? In terms of the thought of high quality
Yeah.
dislocated stocks, what's your what's one that sticks out, I guess, for you?
Well, we finally get to this at the very end. And truth is, we're in a bull market especially for tech stocks, and so I actually have very few dislocated. This is not the beginning of 2023 when I thought there were a lot of
I
really
remember
great
that.
opportunities. So I want to be, like every once in a while, I should be telling you, yeah, there's some interesting
Um,
things here. I like Amazon here. This was our top pick about 3 months ago, and then boom, that the stock's gone up, and so yeah, I still like it here. I like Meta, I like Netflix, but they're kind of small buys for me. I want to stay long. I'd love to see it. They're not aggressive. I don't have. There's maybe one aggressive buy in large cap. That's my DHQ candidate. And I may be wrong here, but there's one of these stocks that's pulled in recently on concern with robo taxis, on concerns that their core mobility business may be slowing, and that's Uber. And so the market may be right. The stock's pulled back 20%, but I'm going to take the other side on this. I think it's a high quality asset. Uh, it's it's one that's really starting to ramp up on free cash flow. It faces two really large TAMs, total addressable markets, in terms of global delivery, global mobility, or ride sharing. It's the market leader, global market leader in both of those categories. There's synergies between those two. They're managing costs well. And I think the biggest call I have to make is, if we're going to go to robo taxis, is that good or bad for Uber? And the market assumes that it's bad. And I'm going to give you the argument that Uber, as the ultimate demand aggregator, the largest aggregator of ride sharing demand in the world, I think they're actually going to benefit from robo taxis, because I think what's going to happen is a lot of these robo taxi companies are going to put their supply on Uber's network. And you have it on Uber network. And I think what you're going to do, Sean, and what I'm going to do is, I do it in San Francisco now, but I'm going to be in another city like New York, and I'm going to open up my Uber app, and I'm going to go Uber Black, Comfort, X, Robo. And some people are going to want Black. Some people are going to want X. Some people will never step into a robo taxi. Other people will be willing to spend more for a robo taxi than anything else. That's small. But I think people are going to pick these options, their option on how long does it take to get to me, and how much is it going to cost to get to LaGuardia, and or wherever you're going. And I think what that means is that for Uber, as the rideshare platform, there's more supply. So there's more ways that they can match the demand in the market. So it's actually beneficial to them. We'll see if that thesis plays out. That's my thesis. And I'm taking the other side of this recent correction. So Uber is really my best DHQ pitch right here, right now.
Perfect. Everybody, Mark Mahaney, the Pro Bowler for research. Appreciate you coming on and joining us. Obviously great work as always, and appreciate you coming on and hope to see you soon.
Thanks a ton, Sean. Take care.
Please welcome the Global Chief Investment Officer at WisdomTree, Jeremy Schwartz.
All right. So once again, thank you everybody for joining Avory Idea Day 2024. In this session, we are diving into things like fintech, tokenization of assets, the latest macro trends, and a little bit more. To lead today's session, we're thrilled to announce Jeremy Schwartz. He's from WisdomTree, known him from his time coming down to Miami. He is currently the Global Chief Investment Officer since 2021. He's focused on things like quantitative active strategies, equity indices, multi-asset models, and more. He was the head research assistant for Jeremy Siegel. Everybody knows him. He also has a book, Stocks for the Long Run, so good to check that out. Last but not least, he is a graduate of, the Wharton School, but also he is the host of Behind the Markets for their Sirius XM, broadcast. We're happy to have you here, Jeremy, and having you with us today to talk about some of the things we discussed earlier.
Sean, it's great to be reconnected and good to see you again. And thanks so much for having us.
Yeah, how you doing? So let's start with the very first thing around fintech, WisdomTree, tokenization. I think all of that is, somewhat combined. We were just talking a little bit ago about how the early days of WisdomTree was really around, an early leader in ETFs. And now ETFs is pretty much mainstream, and now everyone's talking about other forms of ETFs and, going from passive to active. I remember back in the days, in our coming into Brickell, when you were giving, some of your speeches, it was really around, emerging market, local currency, or things like that, where, you're really pioneering interesting ways of using ETFs. I know you have a lot more to share about what you guys are doing at WisdomTree. You've been a pioneer, a leader yourself at WisdomTree. So first, tell us a little bit about what you guys are doing.
Yeah, so today, WisdomTree, it's interesting. This is our 20-year anniversary this month of raising capital in November of 2004. Jonathan Steinberg, our CEO, got a group of investors, Michael Steinhardt, Jeremy Siegel, my mentor for the last 20 plus years, and then Jim Robbins from American Express. They funded it in November of 2004. It took us another 2 years to launch our first 20 funds. Just as people were talking about how hard it was to launch the Bitcoin ETF, we were the first firm to do self-indexing back, and it's, where we would create an index like MSCI or S&P or Russell, and we wanted to launch our own funds against it. The SEC never heard of that. It took us 2 years to get through that. We launched our first 20 funds in 2006. Today, we're up to globally about 110 billion between the US and Europe, 80 billion in the US, 30 in Europe. Sort of global provider from equities to bonds to commodities. Also, it's really a multifaceted platform. And our CEO has been pressuring. We have a strategy team, and he was asking the team, is there anything that could do to ETFs? What ETFs did to mutual funds? Sort of thinking about being disrupting. Can we disrupt ourselves in a way that it's hard as when you have a big established business, how do you cannibalize, or how do you keep disrupting yourself? And so we were asking that question. And there was elements of the tokens where you see crypto gaining mind share and mindset there, where Bitcoin is, and without a single employee, how big it's gotten to be in the trillions of total addressable market cap just from crypto, and we're big gold investors in Europe. We have over, of our 30 billion in Europe, it's 20 billion commodities with a big emphasis on gold. So we're saying if Bitcoin's the new digital gold, we've got to be watching to see what's happening. But there was elements of tokenization that we do think is very important and very transformative. And so we've got a few different initiatives. We've got a direct-to-consumer and an institutional offering. The institutional offering is called WisdomTree Connect, but the direct-to-consumer that people should play around with for yourself is called WisdomTree Prime, where it's a blockchain-based wallet, but we're tokenizing mainstream assets. So yes, you could buy Bitcoin and Ether in there, but you can get a debit card linked to a money market fund. And so I'm using this as my primary banking relationship. I put all my cash in this app, and there's a money market fund, and you're paying for your groceries, but earning 5% today. So what banks pay everybody 5% today? Very few.
Sure.
And so you could have a CD. There was stories of a big bank offering for people with $5 million, a 6% CD not so long ago. But this is everybody can get, always, you're not leaving your bank account earning zero. You have a debit card directly from the fund. So right now we have 13 different things in there, from S&P type large cap exposure to a tech strategy for equities, Siegel branded funds, so Siegel multi-asset, Siegel all equities, where we're taking our best ideas from Siegel's work and putting into a fund of ETFs, sort of tokenizing this wrapper, sort of like a model portfolio, but putting a token wrapper around it. But to me, the transformative thing is that you're spending off assets. That's a pretty big idea.
Yeah, no, a lot going on there. Almost called you Siegel earlier. But in general, who are you trying to compete against? Because it sounds like when you're saying, in some ways, it sounds like a wallet, right? You have some of these, direct to consumer wallets out there that exist already, that are, at least as of today, are still in kind of more so the legacy space. But they are these, digital wallets. So like, just to throw out some names, obviously the PayPals of the world, there's Apple Pay, but
Right.
they don't actually, there's no additional transactions happening. You have Cash App where you can buy Bitcoin and send it, Robinhood and then Chimes. And, anyways, there's a long list of, call it tech enablers, that are out there. So who's this Prime product, specifically the consumer product that you mentioned earlier that you're using, what's the, where are you headed with that product, I think?
Well, it's still, I'd say, slowly being rolled out, but it took us a while to get just sort of like it took us 2 years to get the SEC to allow us to launch the first 20 ETFs from when we got funding to when we first launched 20 funds. You got to have a money transfer license in every state, so you're going state by state to be able to transfer money. So we're in the mid 40s states. So there's a few more states, big states to finalize before we really aggressively market it. But we're making progress. There will be more peer-to-peer transfers. That is part of the vision, that you and I can send money back and forth to each other, and we could send the tokenized funds back and forth to each other, where you get the money market funds. So we are going after that. But even you think about PayPal and Venmo, you're just earning cash. They're not really
Sure.
You could buy Bitcoin either, but they're not giving. The way they make their money is you give them the money and then they go buy the treasuries and they earn the 5% spread. This is putting the power back in your hands to say, hey, we're going to give you you put cash in there, put it in the money market fund, connect it there all the time. You shouldn't have quote unquote dumb cash sitting there, not earning anything. Don't let the banks earn your spread. Put it in and earn the right rates yourselves. They don't want to make spending off of money markets widespread, because that's how they earn their money, the banks. And this is trying to really disrupt that element. But then the peer-to-peer transfer, it's really just that the tokenization allows you to do so much more. And we do think it's more efficient. So when I talked about what could do to ETFs, what ETFs could do to funds, it just became a better experience. And so, while certainly not there today, over time, there's elements of it that we do think add to the experience that are positive. And so from all elements of where the technology is going, we do think it's a form of asset management, but also just spending that is better.
Yeah, no, yeah. I mean, it's pretty interesting. I think you're probably one of the only pure play, asset managers out there that are doing something like this. On the tokenized side, talk a little bit more about what was required for you guys to actually get to this level, because there's obviously some of the legacy, call it employee base that you have that has focused directly on, some of these ETF or active ETF, passive ETF wrappers.
Yeah.
You throw in the mix of, tokenization. Did you start where you're partnering with outside, firms, and then, trying to bring some of that and migrate some of it in-house? Just talk about that journey, and then, we'll dig a little bit deeper into, what tokenization means for, today and possibly, 10 years from now.
This is such a great point, Sean. I mean, in terms of how do you make these things? How do you do it with your existing base? And you could say we have this little startup with inside the bigger organization. There's people say, why are you trying to build this tech startup inside the larger umbrella? Why don't you do a spin out, start it yourself? And we're saying, well, there is a lot of overlap between my teams, the regulatory teams, the operations team. There's a lot that feels exactly the same. So if we were to do this externally from WisdomTree versus internally to WisdomTree, how much more expensive it would have been as a startup by itself? But we have made investments. So at one point in time, we invested in a company called Securrency. We were using some of their technology on the tokenization front. They ended up getting bought by DTCC. So one of the established players in the industry who said, hey, this is where things are going. And they wanted a space, and they bought that company. But we were using some of their tech when we first started. So some of it was made as an investment. Some of it is now building your own people. So we have a team of engineers who are building the app and adding features and functionality. So yes, you do have this sort of startup with inside the organization, but it's also so much overlapping, because so much of the functions are traditional fund world, traditional compliance and regulatory. And so you're dealing with what we use the word regulated DeFi. It's not just a group of startups who are not trying to go with the securities laws. I mean, our tokens they're securities. And there's no question about it. There's no questions which crypto is securities or not. These are securities. And, so I think we have a history of navigating through the regulation, through the front door. And so there is a nice synergy and overlap, but that's how we've thought about it. Is some of it's with investments, some of it's with building people and the technology, but it is leveraging our core competencies at WisdomTree.
Cool. So you probably have a proof of concept today, which means you have the product functioning, running. You mentioned you had 17 of these tokenized assets. The go to market though, give us kind of that elevator pitch of someone that's a customer of yours, they own WisdomTree, ETF XYZ, and you're walking in and saying, now I have the same thing but in a different wrapper. Just trying to understand, what is the benefit to the end customer that is, can give them that aha moment that I'm, number one, I'm probably going more and more to WisdomTree if, you guys are so ahead of the curve. And then two, what does it do differently versus, some of the more traditional, means that, ETF wasn't traditional that long ago, but now it is. So, your elevator pitch that, maybe the channel's talking about.
I mean, the demo I show people when I show off my little wallet, the way I personally have used it, the vast majority of all my cash is there. So this is a better way of holding cash. If you're gonna have any amount of cash, instead of having it at a bank, I basically fired my largest banking relationship. I'm sorry to them. I've had it since college. So in Philadelphia, you figure out who it was. But sorry, I fired them. And literally all my cash is there. So I'm paying every bill, my car, my house, all my credit cards. There's an ACH number. I'm paying through the ACH. Through that, I have direct deposit going there from my WisdomTree checks, get deposited automatically, and then I'm paying the bills through the ACH and through the auto, just like you had a regular banking account. But the thing now, we need to connect the ACH to the money market fund. Right now, where it is today, only the debit card is tied to the money market fund. ACH will be tied to the money market fund eventually, but you could tie stuff to gold. Let's say you know people are buying these gold bars at Costco. Well, you could eventually, like we have gold in the app. So eventually you could spend off of gold if you wanted to. You know, you could spend off of equities. I mean, I'm using it for my cash. So most of my money in Prime is in the money market fund and short-term bonds. There's 6 different bonds. You could buy long-term bonds, you buy tips. There's a short-term model. So you could, there's 6 different ways of owning bonds. There's the money market fund, there's equities, there's crypto, there's gold. There's the models. I talked about the Siegel model. It's hard for me to go execute the model portfolio that we run with Siegel. It's got 10 different ETFs. We rebalance it. That's a little bit hard. So I'm buying that. I think a traditional equity is probably still just as strong, if not better, in ETF. So I'm not buying the equity part of it today. For me personally, I'm buying the basket, the Siegel equity, because it's 10 different ETFs in one wrapper. And I'm buying bonds in the money market fund. And I'm spending, because I'm earning 5%. Well, you know, rates are coming down, so you're earning a little bit less than 5%. But you're spending off of a money market fund. That is the exciting thing. You know, you hear about we talked about the direct to consumer. There's the institutional version. You hear about these stable coins. The stable coins, you hear about somebody like Tether, right? Tether made more money than, I mean, I think there's a meme going out there that they earn more money than Goldman Sachs with like 50 employees or 100 employees, because all the money in Tether, they're going and buying the treasuries, right? Well, here's for the crypto world, the stable coin that earns the 5%. And we're going to make that available through WisdomTree Connect to the world at large. People want to use these tokens with that feature, so people can sign up, the institutional people who were in that crypto community and want some tokens, but tokens are earning 5%, 4.5% to 5% today. That's the kind of thing that we're trying to make available.
Got it. Do you see this more of an active player or a passive player, both?
It's funny. So when we started WisdomTree in 2006, it was 13 years after the first ETF. The first ETF came in 93. BlackRock got there. They bought iShares. That came out in 2000. So in a way, we think we were still somewhat early, but it was pretty late. We're definitely the first to market through this channel the way we've attacked it so far. So when we came to ETFs, beta was already well covered. In the tokens, we did offer. I said we offered 6 different treasury products. You wouldn't do another set of treasury beta today because that's really well covered in ETF world. But in the token form, we're first through those new rails. So we do have tokens on that. But so we have beta today, so some of the big building blocks, and eventually you'll have other more active strategies. But sort of taking the playbook of how ETFs develop to how we're developing the token lineup is we started with broad access vehicles. This is where the technology was transformative, not the exposure at the moment. And over time, we'll add more choice as you build a client base that wants more things. You'll definitely add more choice to it.
Got it. And it'll have, very similar, tax advantages as, some of the ETF market has, or does that, start to change a little bit?
Well, I mentioned, I'm buying the things that are tough and using it for the cash and the spend and that money market and for the model. The ETFs still have the beautiful taxation. The rebalancing that ETFs can do is a better structure today. I'd say, for equities, the token won't be as tax efficient as the ETF. The ETF is special. And so I think over time, those things converge. But for equities, I'd say the ETF still has some tax advantages.
Got it. Okay. Shifting a little bit here to, what's actually going in and how you're thinking about, what to own and buy and such. More the macro, obviously, the last couple of years has been something where, rates spike at a pretty dramatic rate. That you have this dual mandate of which, 2 years ago was a single mandate. stop inflation at all costs to some degree. We remember the Jackson Hole conversation, and then you fast forward to right about a year ago, year and a half maybe. We kind of went on this talking hard, but at the same time not raising rates for quite some time, and speed that up to here in the last couple months and quarters. You're now at a point where the other side of the mandate has come into question, both from the markets and from the Fed. And we're sitting here in an economy that is, good enough, I think, for the sake of, market conditions. Valuations, margins are all, pretty elevated. We can slice and dice, small cap versus mid caps versus large caps. What's in large caps, what's in small caps, and what's working and what's not. But in general, what's your generalized view, today? And then, again, I don't like to make 12-month predictions. It's very difficult, but at the same time, the kind of your own, insights and vision over the next, 12, 18, 24 months.
That's great. And I'll outline how we think about where the markets are in the world and the opportunities from that. From just the Fed and the inflation, the macro, that high level. There's probably been nobody who's been more vocal in criticizing the Fed over the last few years than my boss, Professor Siegel. He was very vocal, and people think of him for his book on finance, and like he's always on CNBC talking about the markets, but he was trained to be, his PhD is in monetary economics, so he has some background from MIT in being the monetary policy commentator that he is. And he had saw the inflationary problem as early as May of 2020. So right after the pandemic, with all the huge burst of pandemic relief measures and the money supply exploded higher, the Fed sort of lost sight of the money supply. And anytime they asked them, like, was there any relation between money and inflation? They forgot that was sort of a central identity, that when you have a huge burst in money that you're going to get inflation. Now, there was a time the money supply was declining. Like last year, the money supply was declining. That's a problem. And now we would have thought it would be a bigger, that might have been signs of recession, and we were able to avoid that. It's actually growing again, which is a sign, hey, maybe the Fed's not quite as restrictive as they say they are. They say neutral is 2.9. We've been saying their neutral might be 3.5 to 4%. We would like them to be there immediately. So we wouldn't be doing this slow and deliberate, hey, we're going to eventually get to 4%. We get to 4% quickly. That was part of where Siegel was making in August when people thought he was freaking out. And he was just saying, hey, you're past your measures of unemployment, inflation's coming down, be it neutral. Neutral's 3.5 to 4%. Don't delay. Now they did the 50 supersized rate cut to start. That was positive. It's still slower than we would like them to go. But people say, should you give them a lot of credit for landing the plane? Well, they created the inflation in the first place. He really created part of the problem. He didn't tighten as quickly as he should have. He was saying inflation was transferred, but it's coming down. They're on the right path. We're as least critical as we have been in the last 2 to 3 years. So they're getting there. You see no signs of recession now. I mean, the economy is holding in there. We would like them to get there to lower rates to remove the risk, but or lower the risk even further. But they're going to keep following their slow and deliberate way. For the markets, the S&P, the way we look at things, 23 times forward earnings. That's a below 5% earnings yield, called 4.5 to 5 earnings yield. That's a indicator of real returns. So you had 2 to 3% inflation on top of that. This is like not a 12-month, but sort of a long-term, like a 5-7 year type outlook is how you would say. It's sort of like a 7% type market real for the S&P. Unless earnings growth magically for tech can be better than ever forever. They've been in this run where tech has really outgrown everything else. And so tech's at 30 PE when everything else is like 17, 18 PE. But they've deserved it because they've been able to grow their earnings at such above average rates than everybody else that they've warranted it. So the question is, what can the S&P do better than if you just took that 4.5 earnings yield, you add 2% inflation? Can it do better than 7? For it to do better than 7, tech has to keep growing at above average rates for a much longer time. And so that's possible, but less likely. So, 7 is probably the S&P, but there's parts of the US like profitable small caps at 12 to 13 PE. So 10 points cheaper. You can buy Japan at 12 times earnings, in terms of the way we do it at WisdomTree. So there's parts of the world that are definitely not as expensive as US tech. We wrote a piece on our website this week, 3 ideas motivated by Buffett. Buffett's been raising cash, 320 billion of cash, all time. Well, you could say there's a percentage of market cap and percent of AUM it's not really an all time, but 320 billion is a huge amount of cash, selling Apple, selling Bank of America, raising cash. Part of it was he thought tax rates were going up. Well, now he's got longer on the tax rates going up. So that's interesting. But I think part of it was just on valuation. So where else should he go? He's been buying Japan. That's one of his ideas, has been buying Japan. We put in small cap quality in that piece, again, that 13 PE. And you could buy high dividend buyback funds with a 7% shareholder yield versus below 3. That's sort of dividends and buybacks together, getting you close to 7% yields today versus sub 3 in the S&P. I think there's definitely pockets of value that are not just the S&P tech stocks.
Yeah, no, I agree with a majority of that. And that's kind of our view here is at Avery. But a couple questions, right? So you have the small cap complex that is, cheap, right? And, you can dissect it. You can take out biotechs. You can, you have the banks in there, and some of them are regional focused and have kind of their own headwinds at work here. But then beyond that, you still have, some of the other sectors within that are still cheap. You talked about Buffett. I think that's pretty interesting commentary, and a lot of people are focused on, what is he seeing? My view is just simply that he is too big to dabble into some of these other areas, the small cap qualities that don't really move his portfolio. And therefore, it may not be a sign of him saying that, the broader market is expensive, but, large caps certainly are, where he has to fish today. And we've seen that over the last several decades. Anything he's bought has been of scale and size. He's had some peripheral investments here and there that are much smaller, but again, they don't move the needle. I think he's mentioned that a couple times in his event in Omaha. And there's that aspect of it. But, we get a lot of questions on, because today we're probably a little bit more skewed. We have our premier growth strategy, high conviction, 8 to 25 companies, and it's definitely more tilted towards, small and mid. But that was a destination, not kind of a goal. But we do get the question that can securities, small or mid-sized securities that are big in scale, right? You can still be a $7 billion company and be considered, not that impressive, I guess. Can the market itself or those companies do well if, the large caps suffer? Generalized views on that. So it's the Buffett thing and small caps do you think it's more a reflection of his size as opposed to his views on the markets? And then the other side is kind of in combination, the fact that can your portfolios of small and mids do well despite an environment where maybe the large caps are either flat to down?
Well, you did see that in the aftermath of tech in 2000. And this is actually when I first started working for Siegel, as he was becoming famous for his op-ed, Big Cap Tech Stocks or Sucker's Bet, March 14th of 2000. I was at Penn right when the article came out, and then got to work with him shortly thereafter. And small caps did do well, actually, as sort of money moved from tech towards everything else. You say, who's going to benefit from the question will be, will this administration do what they said they were going to do? And so will they lower taxes? They said they want to lower corporate tax rates. Right now we're at 21%. They talked about 15. Is that possible? Well, who benefits the most? Small caps benefit the most. Sort of like 4% would be the earnings boost for large caps. Tech already pays a 15% tax rate because they move things to Ireland, and Microsoft moves up to Puerto Rico. Like, they do all sorts of games. Small caps in the U.S. don't do that. Small caps just have revenue in the U.S. And so they are the most levered to actually a decline in tax rates and the sort of regulatory stuff that they talk about. We'll see what happens. But I do think Buffett on Apple in particular he bought it at 12 PE, it became a 30 PE. He thinks it's going to be one of the best businesses he ever will own, but it's just got more expensive than when he first bought it. So there's more risk than when he first bought it. But he has been buying Japan at 9, 10 PE stocks. The 5 stocks he bought in Japan still on average are only 10 PE. So, I think there are places where you can find good value. I do think he definitely can't put to money work in that full small cap basket, but that's not your problem. It's not our problem. It's his problem. He can't it won't move it for him, but everybody else can look at those places for opportunities. You're absolutely right on the predominance of biotech and banks. I often wonder, based on my early comments, I tend to be less bullish the banks, but that's largely have a horse in the race as we talk about trying to destroy the banks. So in some ways, we've got a play, and I don't know how much my bias against them is because I've got an idea that I think makes them much less profitable. But so I'm with you. But you could buy that small cap quality strategy I talked about doesn't have a lot in the regional banks still at 12 times earnings. So I think there's still good opportunities there. And they are arguably, they got a lot of things positive. The negative for them is that they're the only ones paying the higher rates from the Fed. And if the Fed's higher for longer, that's negative. They've got positive corporate taxes, positive valuations, positive on regulatory, negative on higher for longer. But I still think that's a good place to be.
Yeah, and you mentioned Japan. You guys have spent a lot of time in Japan in terms of strategies. Why is that? Is it this is just a even almost a personal question, trying to understand some of the underpinning of WisdomTree's generalized focus. Is it just trying to be where other firms maybe aren't focusing and covering? It's a obviously massive developed economy, so calling it niche is an understatement. But just in general, like what's the rationale?
Well, I like that I'm in good company with Warren, so that he said Japan's his number 2. That I'm one of the few people who talks about it. I felt like that's good company. But no, when it comes back to when we started back in 2006, we launched 20 funds in one day, and we had the idea of going from cap weighted to fundamentally based dividend weighting. We launched 20 funds, and 6 of those 20 funds were U.S., 14 were international. We had some of the first international small cap funds, the first emerging market small cap funds. We still have the largest emerging market small cap ETF in the world, believe it or not. Like 20 years later, almost 20 years later, because we were first, and actually when you did dividend weighting in EM, it outperformed cap weighting. So the beta has never taken over actually for EM. So it's sort of interesting. But to the point on Japan is we were the first firm to do currency hedging internationally. And actually, again, Warren's been currency hedging is Japan. And so we did this 15 years ago. The first fund was in 2009. And I remember I live in Philly. I was commuting to New York. I was taking the CFA, reading the CFA textbooks. And we talked about currency hedges. Like, why hasn't anybody done this for ETFs? And really, we were the first firm to do it. And at the time, the euro was getting toward, when I first started working on it, the euro was like 140, 150, 160. And I said, hey, the euro might not go up forever. The euro might actually go down. And hey, these actually might make the stocks more attractive if the euro went down, because what happens to the U.S. earnings when the dollar's going up? When the dollar's going up, our earnings go down. Like when you have Apple and Coke and Pepsi, that's a headwind. They report their earnings. The dollar going up is a headwind to their earnings. And
bunch of constant currency reporting going on there when they do that.
Yes. So I think most people do this entirely backwards, and I'm happy that I'm like one of the 5 people who cares about it, the only one who talks about it. But I think most people do currency backwards when they come to international, and so that there's like 3 ETF firms who do it. I was the first, but nobody really has the passion. So I think it's an opportunity. I think most people do it backwards, and you got to have this. Our original funder, Michael Steiner, talked about you have to have a variant perception. You have to have something that you believe that's different than the market and is right. Not just that it's variant, but that is right. And I do believe we're right on this take, that most people do this backwards. And so it's a opportunity.
Awesome. I'm getting notes here that we're running into the next session. So I'm going to stop there, but I appreciate, some of the time today. I wanted to give you 1 second for people to, find, anything you're doing. Obviously you have, the Sirius XM channel. You obviously are doing great things at WisdomTree. Number 1, obviously congrats. I've, got to see you a decade ago, and, now you're, have continued to progress. The firm's very large and you're doing pretty interesting stuff with tokenization. So hopefully that is, a wild success. But finding more information about everything you're doing, either personally or business, where can they find some stuff?
Yeah, so I try to engage on Twitter, X, Jeremy D. Schwartz. If you can find me there, I've made good contacts, friends. That's how we got reconnected there. I do try to use it, maybe too much, but as a platform, it's definitely useful. So you can find me personally there, LinkedIn as well, but I do post a lot more on Twitter. And then I'd say, so the show Behind the Markets, you can do it on podcast every week. It starts off with Siegel, first 10 minutes, and then we have sort of roundtables or guests. And it's been a fun thing. We've been doing that for a decade. And then WisdomTree.com, we've got a lot of great reports and blogs and dashboards, a lot of interesting tools that you can follow along. And so find us there as well.
Awesome. Jeremy Schwartz, Global CIO of WisdomTree. Appreciate you coming on today and joining our session.
Everyone please welcome Michael Halen from Bloomberg Intelligence.
All right, on to our next session. We're here with Michael Halen from Bloomberg Intelligence. He covers the restaurant space. I've talked to him quite a bit over the last several years. Great guy, great mind, knows everything about restaurants. So we're more than happy to bring him here today to Avory Idea Day. Welcome, Michael.
Thanks for having me.
Yeah, so you would think, Avory Idea Day, we're an investment firm. Where's the world headed? Investing where the world is headed. Restaurants, how does that play in the mix? We're under the impression that, there's a potential sea change happening both in the front office and in the back office, driving efficiency. Companies like Chipotle with their avocado, robot thing that's going on over there. So, there's different technologies that are actually coming into the space. But having you on here today, I think you can help distill maybe some of the facts and, maybe some of the fictions. What's the state of the restaurant category more broadly? This is the consumer at the end of the day, and they vote with their wallets. There's some different emerging brands that exist out there, the public ones like a Cava or, someone like Wingstop that, we mentioned or you have been mentioning for quite some time. So kudos to you. And AI, what's the role of AI in this category? So that's kind of like, the topics of discussion today. But before that, just give us a little intro of yourself and background.
Yeah, sure. Equity research analyst covering 19 or 20 restaurant and food service names at Bloomberg Intelligence. Across the space, primarily the larger cap names, but we're moving, into some of these emerging brands that are really rocking it right now. I've been in this business for about 14 years. Before that, I traded equities. I ran prop trading desks for 11 years, man. So I've been in the markets for quite some time. And I love the space. I love the restaurant space, man. I'm blessed to be in it. It's filled with great people. I've been on the conference circuit the last couple months, just ran into a lot of old friends that are just good people and great to spend time with. So yeah, man, blessed to be in the industry. Love talking about it.
Yeah, we just missed you personally in Phoenix. We were there visiting certain restaurants or whatever, and investors, but you were there for a different conference. The one thing I wanted to spin to you just before we even get into it, you have a podcast. Name of it, just wanted to let you hype yourself a little bit.
Thanks,
there's a lot
man.
of good stuff on there.
Yeah, I appreciate it. Chopping It Up by Bloomberg Intelligence. You got to stick Bloomberg in there. I didn't realize how many podcasts are named Chopping It Up when I named it. But we have a lot of restaurant CEOs and a lot of restaurant tech CEOs, and I kind of interview them like I would be interviewing them if I was interested in investing in their company, right? So if you want to kind of get a view, kind of see how analysts think about things, you want to kind of get a sense for how these management teams are running their companies and think about their companies. I think it's a pretty good listen. We put them out every 2 weeks or 1.5 to 2 weeks.
Love it. I listened to it, so just wanted to throw that out there. State of restaurants. So give us from your purview, what's the state of restaurants today? However you want to frame that.
Yeah, we'll start with the bad news. And the good part is the bad news is I think mostly behind us, but we've been in a restaurant recession this year. There's been macroeconomic analysts out there talking about rolling recessions. And I think that's kind of what we've seen is, when there was an industrial recession back in 22, early 23. 2024 was the year of the restaurant recession. Sales have been bad pretty much all year. We talked a few years ago during the pandemic. A lot of investors were saying that quick service is recession proof. Not this year. Sales are down for a big chunk of the year at quick service restaurants as well this year. This was the year that low income consumers pushed back. They broke. They were tapped out. It's just the price increases that they've seen, not just in restaurants and the food store, but everywhere, quite frankly. Rent, automobiles, you name it, has just really, really hurt their spending. And so they push back, and low income consumers make up, about, I think it's about a third of transactions at quick service restaurants. So a big part of their business, kind of fell off, cut back pretty significantly on transactions throughout the year. They also, cut back at all sorts of restaurants, and we did see a trade down. Even some higher income consumers were trading down and out of fine dining this year. So it's been a pretty crummy year. So that's the bad news. The good news is it looks like we're starting to come out of it. We're going to be lapping these crummy results next year, which is a good thing. January was an abomination last year. And so I think a lot of restaurant operators are looking forward to lapping over some easier comps. On top of that, the economic data we watch is getting better. Our concerns have eased a little bit about low income consumers. We don't think they're going to come back in full force, but some of the signs are looking a little better. So credit card balances are still rising, but at a much slower pace than they were earlier this year and late last year. Credit card delinquencies actually dropped in the third quarter, which was a great sign. Auto loan delinquencies just kind of crept higher in the third quarter, but it was a rate of change improvement. Consumer sentiment, it's a survey, so it's like you have to take it with a grain of salt, but it's improving. It's still not at expansionary. University of Michigan still isn't at that 80 expansionary level, but it's at around 76. But it's creeping up towards that level. So that's a good sign. So the economic data that we're looking at is looking a little bit better for the low income consumers. Also, upper middle income consumers, higher income consumers are feeling great right now. People with assets, right? If you own stocks, if you have a 401k or a pension, if you have Bitcoin, if you own a home, you're feeling pretty good because all of those asset prices are at all-time highs or right near all-time highs. And so those consumers, I think, will pick up the slack a little bit more in 2025 than they did in 2024. So things are looking better.
That makes sense. Cool. So just to be more explicit, when you say quick service, what kind of brands are you referring to? And then, some of the high end stuff, just so the audience has a feel of, some of the brands that we're referencing here.
Sure. So yeah, I'll give you all of them. So, first is like fast food or quick service. That's going to be, the McDonald's, Wendy's, Jack in the Box of the world, right? That's going to be fast counter service. Most of the sales are going to be driven at the drive-through, typically about 70-ish% driven at the drive-through at those chains. Then we're moving up to like fast casual, right? And so they position themselves, and they continue they're doing a really good job right now of taking share again. They've kind of positioned themselves in the last like 15, 20 years in between full service dining and fast casual, where it's an elevated food experience. It's more expensive than quick service, but it's cheaper than casual dining because you're not paying a server and the tip, and you're not buying as many drinks, appetizers, and stuff like that. And so the food quality is comparable to a full service, maybe even a little bit better at a lower price. And so that's, think Chipotle, Shake Shack, Wingstop gets lumped in there. Cava is another one. Some of those brands have been doing really, really well over the last couple of years. And then you're moving into full service. We cover a bunch of casual dining names, Darden, which owns Olive Garden, and Longhorn, Texas Roadhouse, Brinker, which owns Chili's and Maggiano's, and a lot of those brands. And so they've had a really tough year this year. but not everybody. Some chains are absolutely knocking the cover off the ball. So, a lot of people have been saying that casual dining is dead for some time, but I don't think it's dead. I think some of the legacy brands are in trouble. We've seen, Applebee's shrink year after year after year. Outback has had a really difficult year this year, and so we've seen brands struggle. But then we've seen chains like Texas Roadhouse, they're outperforming pretty much everybody but Wingstop since the start of the pandemic. Chili's has crushed it, and so you're seeing kind of mixed results there. But we think that segment should see some improvement next year for sure.
Cool. Yeah, Chili's salsa and chips give me some college nostalgia. Speaking about some of the trends in this category, tech operational, you know, there's you're seeing robots on the streets, doing delivery. There's the DoorDashes, the Uber Eats. There's obviously the robotic avocado cutter at Chipotle. More and more of that is likely to be the case. They have like their Chipotle lane, which is their second make line. You're seeing more of these shelves inside of these, fast casual or quick serve restaurants. Technology is being infused across all of it. Just talk about like what you're seeing on the ground when you do speak to these, CEOs or industry experts that you're often talking to, whether it's on your podcast or just in general. What are you seeing from the back office? Whether it's AI or some of these other tools that that continue to grow.
Sure. And well, what's funny is like everything is called AI now. So a lot of these technologies that have been around for 15, 20 years, were at one point considered big data, but now they're being called AI because I think they get better multiples. But in fairness, AI is being used to improve some of these things. So just some of those that come to mind that have been around a long time is just like sales projections, right? Staffing, food costing software and ways to cut costs in the restaurants, including food waste. But then there's, a lot of technology to your point that, chains are investing in and testing and really hope to get an ROI off of some of these things moving forward, right? Chipotle is a fun one to talk about because they're a leader. They're testing a lot of different technologies. Some of them have worked or seem to be working, like the avocado, right? So it cuts, cores, and peels avocados so that the employees then can hand mash the guacamole, right? That's a task that was pretty miserable and time consuming, right? And so when you watch this machine work, man, they can cut open some avocados pretty quick, and so it seems to be working so far, right? It's just a small test. It's expensive.
I need that in my house. They need a consumer product for that. I got a couple big avocado trees out here, but obviously peeling those things are, in quantities. I can make a lot of guacamole, but continue.
Yeah, it's cool. I love guacamole. So I make a lot of guacamole here. So I'm with you, man. And that seems to be working. They're expanding the test. And then they also had the chippy automated fryer, which really didn't seem to add much value, right? A lot of employees said, well, it's really not a hard job. It sucks standing in front of a hot fire, but it's not a difficult job to do. So they kind of pulled back on that one. They were doing some AI assisted hiring programs so they can free up the GM to work in the restaurant and not work so hard in terms of fishing through resumes and contacting potential employees and answering questions of potential employees. And so that's something that they're excited about. What else? They have the second make line. I don't know if that's really AI powered, right? But, underneath the counter, they're testing a system that can make all of the digital orders without the use of any human labor. And so a lot of these are really great technologies that are going to allow them to take labor out of the restaurants. And, they have a pretty good exposure to places like California where, a minimum wage is $20 right now. And so, that's definitely a mission of all of our restaurant chains, whether they admit it or not, is trying to reduce labor hours and cut some of those costs, and maybe reinvest those savings back into the food, right? Because, people aren't happy, right, with right now with with the prices of the food or what they get for what they pay, right? So if you can maybe take some labor out of the box and reinvest it in the food costs, people may see more value at the restaurants and start frequenting more. Because, even though sales have been, up post-pandemic pretty significantly, traffic's down pretty significantly, right? So the difference is that, restaurants are charging 30% more, but traffic might be down, 20. So, and I'm just throwing those numbers out there, but,
Sure.
so these are all things they're looking at. There's more though. I mean, there's some cool stuff out there. There's technology that helps with all the third party delivery ordering, whether it's marketing on the websites, whether it's dealing with chargebacks and things of that nature. There's back office stuff like inventory, back of the house stuff like inventory and purchasing. There's even stuff that'll check the orders before they go out for delivery, right? There's cameras that are fixated on the bags
That's pretty
and
good.
making sure the orders are right, which is pretty cool. And then another one that's always bandied about is the voice stuff, right? And it's had varying degrees of success. Yum Brand seems to be pretty positive on it right now, but McDonald's just got rid of their tests. I think this is something that Domino's has been working on for a very long time. And I think what we've seen is that it's a little more difficult than people had anticipated, just dealing with different dialects, accents, for not even for, foreigners. It's like a lot of times it's also, Americans in different areas of the country that the systems are having trouble picking up on. And so, those are some of the fun things that we've been talking about as of late.
Yeah, cool. So obviously, taking that a step further, going too far on technology could obviously be a negative to your business. I think of someone like Starbucks, right, where the math you just shared, transactions up, pricing, or transactions down, pricing up. I think that's the exact equation that's been happening, several quarters in a row at Starbucks. And part of it is pricing, but part of it I think is a little bit of trying to move too fast and getting that throughput inside of your stores, your locations, and kind of taking that charm away. I think that Starbucks originally had. And some of that kind of charm has migrated to places like Dutch Bros. And again, we don't have to talk about specifically about these companies, but it's more about, basically over rotating on technology for technology's sake could be a hindrance. So how are you seeing, I guess, companies navigate that kind of like balance of making sure they're present? Someone like a Shake Shack that still has the kiosks, but then there's somebody, handing you your food. Or some of these other. So I'm just trying to open the conversation up to over rotating. There's obviously Starbucks. We can go down that lane and talk specifically about them. They just brought in Brian Nickel from Chipotle. Just anywhere you want to go with that one.
Yeah, I mean, you make a great point, and I think that's been a huge problem with Starbucks, is right. It's become very transactional, and so the allure of those digital sales, allure of the third party delivery sales, is very strong, right? Especially incremental sales have a much higher margin than right than otherwise. So Starbucks, yeah, man, they've gotten away from the core essence of that brand, which was like your community cafe. And I think new CEO Brian Nichols is going to try to restore that, right? It's about going in there, your barista greets you with a smile, knows your name, knows your order. That's what it's all about. And I think that's what they're trying to bring back. And so, yeah, with the technology piece, I think these chains have to be true to the brand, right? Like the technology they bring has to make sense, right? You're not going to put a Ziosk tablet, in a fine dining restaurant or an upscale casual restaurant. Like that's not going to happen. But this go round, it could really work well for Chili's. It didn't work 10 years ago, but we saw the same thing with kiosks. Kiosk Jack in the Box had over a decade ago, and got rid of them, and now they're bringing them back. So sometimes you can be a little bit early on the technology too. So it's like getting the technology that makes sense for your brand is key. And I don't think you want to be too early. I think some of these technologies that Chipotle are doing, I think make a lot of sense. But some of these chains that are fast followers, I think is kind of isn't a bad way to be either, right? Like I don't, Chipotle has the balance sheet where they can make the investments, and it's not going to hurt their bottom line, right? Because they absolutely crush it. But some of their other competitors, maybe it's a little smarter to be a fast follower, see what works for some other chains, and maybe try to improve on that.
Yeah. What is your thoughts on Starbucks. Like, what you think they get this right? Obviously, there's a lot going on there, and it's a brand that I think everyone desires to be good. To be part of your life to some degree. And over the last, call it 5 years, I think there's kind of been this push away. Some of it's societal, meaning people trying to shift more towards less more authentic brands that are maybe local, and that local coffee shop I think has at least blossomed here in Miami. And I'm assuming that has been much like a bigger national trend as well. But again, I don't have any data to support that view. But your views on Starbucks, what can they do? And again, the point wasn't buy or sell. These aren't recommendations, but it's more from an operational standpoint. Can Starbucks kind of get back to its luster, get to unit growth, get to traffic growth plus pricing? I don't know where that lays out, but just trying to pick your brain on a specific issue.
Yeah, so I think Brian Nichols laid out a really good plan so far, right? It's always like these turnarounds. It's typically the same playbook. It's like first fix your operations, right, and then you move on to the marketing, right? Because you don't want to do marketing first, because if you bring people in and the experience sucks, then they're not coming back, right? So first, it's about nailing down the operations. He's on a mission to make the baristas' lives easier, right? He visited tons of stores before he accepted the job. And then after he accepted the job, he talked to a bunch of baristas, talked about what they enjoy doing. How can we make your lives easier, right? What can we, and so, what can we do to help you, right? And so by doing that, he gains the employees' trust, right? And then the employees are in a better mood and they're happier, and it's a better work environment, and they provide a better experience for the employees, right? And so whatever it's going to be, right, it's going to be some menu simplification. That's definitely going to be one of the first things they do. There's going to be a lot less new items being launched on an annual basis. This last management team just inundated the stores with new items, and it just makes it so hard to execute for the baristas, right? They're going to have to figure out how to split up some of these digital orders versus people ordering in the store, and maybe having a dedicated area of the store just for the digital orders. They're bringing back the milk bar, which is good, to let people do their own customization a little bit, decrease some of the chaos right at that front counter, especially when people are getting drip coffees and stuff like that. And so by improving that operation, it's going to, he's going to tighten up that operation. And then from there, they're going to start spending more on marketing. Marketing has always been a place where Starbucks has underinvested. Frankly, they didn't have to, for much of their existence, but things are different right now. And so marketing is going to be a big piece. And so part of that marketing too is also going to be communicating value, right? Part of it is they're going to stop charging for plant-based milks. Right. And so a lot of their customers are going to receive, a discount there, because they're no longer going to have to pay for their almond milk or oat milk. There's also going to be some sort of price restructuring, right? Because I think what they found out is that a lot of customers get kind of sticker shock when they get their 3 pumps and certain type of milk and whatever it is. And then all of a sudden, your $4 or $5 drink is like $7 or $8. And so I think there's going to be a complete overhaul of the pricing structure. And anyway, that's what Brian Nichols said. And so, I think that'll be a big piece, and maybe communicating to customers that, listen, man, it's not all like $7, $8 unicorn drinks and whatever else is selling at any given moment, right? Like you can get in and out of there with like a great $3 coffee. And so, to your point, there is more competition in the cities for sure. I mean, we've seen it for years here in New York. But in a lot of places in America, man, Starbucks is probably the best cup of coffee you're going to find. And so it's still a great brand that a lot of people love, and I think they're definitely have a good chance to regain some of that market share that they've lost here in the U.S. I would say the bigger concern, the tougher piece for Brian Nichols is going to be overseas, right? He's worked for Yum Brands and Chipotle, 2 chains with very little international exposure. I don't that doesn't bother me. I think he's a leader. I don't think he's going to be in the weeds deciding about Chinese strategy, menu strategy, right? He's going to hire great people that are going to do that work for him. In China, they're talking about franchising either part or all of that business, refranchising either part or all of that business, bringing in a partner. And I think it's smart, man. International is tough with regulatory issues, with just a different culture and different app menus and different appetites and preferences, menu preferences, drink preferences, taste preferences, profiles. And so, handing it over to experts in that country is never a bad idea in my opinion. So that's something that has been talked about a lot over the last few weeks. And probably the biggest concern is still, the Middle East and Muslim countries. That there's definitely a pretty significant drops in sales volumes in the Middle East, Malaysia, Indonesia, and places like that. And so, they're starting to lap the beginning of the Israel-Hamas war, which will ease some of that same-store sales declines, some of that pressure we've seen. But it's going to take some time to rebuild sales in those areas. But overall, we think they hired the right guy for the job, and so far we think he's got some smart plans. We'll find out more in the coming quarters.
Cool. So obviously that's one that is transforming itself in our right now. Wanted to speak about not necessarily emerging brands, but brands that are doing things well. Some of them are more emerging than others. I think you have, again, you've covered a bunch of companies, but any that stick out to you that, are doing things well, and maybe the why. Why do you think they're doing things well?
Yeah, I think there's a few drivers. One interesting driver is like bringing in more Gen Z and millennials. Like the chains that are attracting more Gen Z and millennials are not going to cover off the ball. And so Wingstop has done a good job. They're marketing, starting to offer the chicken sandwich, which younger generations really like. Has really enabled them to bring in some of these younger consumers, right? Chili's, they've been able to bring in a lot of younger consumers. I think part of it is the work they've done on TikTok, right? And they've been able to see when things have gone viral, and they've done a good job playing in that space and bringing in younger consumers. Kava has gone younger over the last few years. I confirmed it with management, but I noticed this at my local Kava, and when it was like, a few years ago, there was no teenagers in there, and now the place is packed with teenagers no matter what time you go. And so their ability to bring in those younger consumers, I think, has helped them. And then steak was another thing that's really helped them in recent quarters. But so what is it about those chains? I think part of it is healthy. Obviously not all of them, but healthy, being able to eat healthy at a place like Chipotle or Kava is attractive to these younger generations. And then also tech, right? So these younger generations are very active on their phones, right? They're more likely to use mobile apps to order their food and have it delivered or go pick it up. And so these chains all have done a good job in terms of growing their digital sales over the years. So that's a big one, being able to attract those generational cohorts. Another interesting tidbit, Gen Z is the least financially concerned, and they're the only group that expects to increase their restaurant visits next year. But they've also never lived through, they don't remember the Great Recession, I should say. And a lot of them have never had a full-time job yet because they're still pretty young. I think they're just, feeling pretty good because they're using their parents' credit cards. Interestingly enough, millennials and Gen Z parents are millennials and Gen X parents who are the let me start that again. Millennials and Gen Xers, who are also their parents, are the most financially concerned, and it's because their kids are ringing them up on the credit card. So, but it is interesting, and chains that are catering to those two younger generations are doing really, really well. Another thing we're seeing is pricing discipline. So Wingstop, again, they've increased their prices about 15% since the start of the pandemic. Their peers are at like 30 or 35. And so, and then another one is Texas Roadhouse. Is always very disciplined about their price increases. Both of those chains continue to attract consumers because there's value on the plate. All right, people, we're cutting back in 2024, but not at those two chains. And that's because they knew if they went there, they were going to have a good experience. They were going to get good food for good value. And so people being more discerning this year are sticking with chains where they know they're going to have a good experience. And in that same vein as Chipotle, in our opinion, they did better than everybody with strategic pricing, right? And so now you can price down to the actual restaurant level. Each restaurant gets a different menu price. And so Chipotle, I think, did that better than anyone because they increased their prices as much as anyone and yet didn't get any pushback. And so that's a sign that their strategic pricing was ahead of everybody else. And then marketing, man. Chili's turnaround was a great one to see, and it was similar to the Starbucks thing. It was like first was operations, right? It's like pairing that menu, better service, better food quality, and then really pushing on the marketing. And they're really pushing hard on the marketing, whether it's TV, social media, whatever it might be, and they're absolutely crushing it. Their same-store sales have been up low to mid-teens in each of the last 2 quarters, and so that's been a fun one to watch.
Yeah, no, fascinating. I mean, to some degree, it sounds like, going back to the basics, good quality, good locations, pretty good throughput, but at the same time, complementing that with, where you are in the generation, and, what are they doing? What do they want, from, how they order things, to the basic level. In our opening keynote, we basically highlighted how, 40% of managers today are millennials and 10% are Gen Z, the younger one. So 50% are, of managers are now, managers in their respective fields. And ultimately, they're starting to make some money, and they are where consumption's happening. It's the first time that millennials have surpassed Gen X. Again, having the problem of, figuring out all these different generations. But anyways, stopping there, I think, we have to head to our next session, which is Placer AI, which will continue on the dialogue around,
cool.
Retail. So anyways, appreciate you coming on. Where can people find more about you before we exit, and then we'll move on?
Yeah, sure. Placer AI, we have Placer AI data on the Bloomberg terminal. So, obviously Michael Halen, you can bio me on the Bloomberg terminal. Feel free to reach out to me on LinkedIn, or Twitter, Mike Halen or Michael Halen on both of those. And yeah, man. Thanks for having me. This has been fun.
Yeah, Michael, appreciate you coming on, joining Avery Idea Day 2024. We'll have to do it again, maybe a single session, but regardless, everyone go listen to Chopping It Up. Bloomberg chopping it up. Good stuff out there. Appreciate you coming on today.
Thanks.
Providing insights on foot traffic data, please welcome Ethan Chernofsky from Placer AI.
All right, here we are, our next session. We are with Ethan Chernofsky from Placer AI. Congrats to Placer AI. They just had a funding round this summer. You can see it right here. A valuation of 1.5 billion, 75 million in funding, according to TechCrunch. Welcome back. We haven't seen you in quite some time. Placer AI is one of those platforms that, I get excited about every time I see it. It's, foot traffic data, and I'm sure you're doing, plenty other things there. You've been there for quite some time. So, kudos to you and the team for, building what it seems like a pretty successful company in a landscape that hasn't really necessarily seen a lot of, up rounds in the private market. So congrats to that, and welcome to Avery Idea Day 24.
Thanks so much, Sean. It's great to be here. Always excited to do this.
Yeah, so let's just get straight to it. So tell us a little bit about Placer AI. Obviously, it's been a while for some of the listeners or viewers that haven't seen you, but just give that quick elevator pitch on what you guys are doing.
Sure. So location analytics company, very, very simple version. People vote with their feet. We show you how they vote across the United States. We do that by analyzing tens of millions of devices. Critically, it's all aggregate data that's been stripped of identifiers like MAIDs. We then use AI and machine learning on top to make estimations on visits to retail locations across the country. And we show that all in our platform, everything from visits, true trade areas, cross-visitation, and a whole lot more.
Nice. So AI, that is in your name. It's been in your name since generative AI, pre-generative AI. Mm-hmm. So I like to go to those companies that have had that in their title for, before the hype really took off, and, just talk about how AI is, embedded. What is new? Obviously there's generative side of the equation, which I think is the new aspect of AI. You guys have been doing AI to kind of triangulate, trends and such using some of the data points that you get, but somebody that has been there for quite some time, what are those general trends that are, or not the trends, but how is AI generative AI versus, pre-generative AI craze? How's things changed at Placer?
Yeah, so I think the bulk of it for us, and it certainly was this way in the beginning, is AI is a technology that enables us to do what we need to do effectively to create the product. So dealing with vast amounts of data very efficiently, being able to make those estimations, process that information, it was AI as a means to an end. Really, and so I think most of the focus externally and internally needed to be on like, hey, what are the solutions I'm looking to solve? And we were providing one of those solutions, but leveraging this really important technology. I think what's interesting, and it's even for us, is AI kind of moving to that front end perspective. So it's not just enabling technology companies to process data more effectively, to do these other things more effectively, but it's actually starting to come to the forefront and it's changing the user experience in a much more direct and tangible way. And that certainly impacts us. We're trying to bring that into the fold. We have some really exciting announcements coming in the very near future about ways that this is going to change kind of the way folks interact with our data, the way they interact with our platform. So I think that transition is really interesting. That move from, driving that back end technology to now being at the forefront of the front end.
Got it. And I'm assuming, without getting ahead of any of your product announcements, I'm thinking, natural language to, query some of the information you're looking for as just like a, basic use case of, how you then, if I'm looking for, and we'll talk about this in a little bit, Dutch Bros versus Starbucks, traffic trends. I'm assuming the method of doing that is less, point and click filter based and a little bit more maybe natural language. Am I at least down the right, track?
You're absolutely there. It's how do we make that journey and that process and that discovery process for the customer as quick, as effective, as engaging as possible.
Got it. Okay, cool. So obviously the beauty of what you guys do is you have a lot of information. We love a lot of information here at Avory and data points and try to track those to make decisions on the investment side. But and those are generally, you have customers that range from investment firms to real estate developers to, probably owners of many of these corporations that are trying to get a competitive dynamic or point of view of the landscape, maybe where to build the next Planet Fitness, something like that. So, having you on here is incredible because we can gauge, from using data and less so earnings, the state of, call it retail. We recently got someone like Walmart, which had a really good earnings report from a traffic trends and price per transaction trends as well. Guided pretty optimistic here over the next year. So I want to point that back to you. That's obviously a single company, a big company, but the state of retail, what are you seeing? Kind of what are some of the nuances that we should be thinking about?
Yeah, so I think let's start broad and we'll go into some of kind of the specific trends that we're seeing that are kind of rolling out as we talk. So one is, I think overall retail's in a really strong space. There is a lot of demand, there is a lot of opportunity, visits are in a strong place. So I think when we think broad strokes, things are in a very good place. And this isn't, as much as we take it as a given sometimes, it's important not to, because we've talked about this ad nauseum, but it's important to reiterate. 2019, we were talking about the retail apocalypse. We were talking about the death of stores, a handful of retailers surviving and everything moving online. And that hasn't been the case. And so much of that is the power of these retailers offline and what they're able to accomplish. There isn't enough retail space. So the competition for that space becomes more significant. Retail, especially in the brick and mortar environment, is in a very, very strong place. And it's hard to imagine that changing. With that said, there are some really significant market shifts. So kind of we highlighted 4 that we think are really fascinating, right? So one is a really important conversation that needs to take place around the importance and role of convenience within the retail space. So I think there was this very kind of classic retail headline of in retail, convenience is king, right? This was this Forbes headline immediately post-pandemic. And the honest truth is that notion is absolutely not true. And that's not to say that convenience isn't important, but it is to say that it is not the fundamental or most important thing. It is not the king, right? It is much lower down that list. And there are things that we're seeing in the data that really prove this out. So for example, cross-visitation is rising. So people are going to more locations within a single vertical. So if, I used to go to 2 grocery stores a month, now I'm going to 4. They're driving further out to go to specialty retail or specialty grocery or a Trader Joe's. So when I want to go to that place, I'm going further, I'm making more trips, and I'm driving farther away in order to make that purchase. All of these things indicate to us, by the way, visit duration is declining as well. All these things indicate that the consumer is valuing different things than we maybe had assumed they value in the past, or that kind of balance of weights that we put on these decisions is a little bit different than what we had previously expected. And convenience is lower down. It's not moving the needle as much as seeking out value or seeking out kind of this ideal product. So this is one thing I think is important. And by the way, it tells us a lot of where retail innovation and strategy is going to be over the next few years. So it's going to be less on how do I drive the visit and more on how do I maximize my kind of share of list, like the amount of things that you buy within my four walls compared to what you'd buy overall. So it's not just like basket size. It's if I'm going to buy 100 items in the course of a month, each retailer is asking how much of that 100 items can I make sure happens within my four walls. So that battle for loyalty, in-store customer experience, boosting basket size is so much more significant than maybe we had previously expected, especially in that immediate post-pandemic environment where if you got the visit, you got this huge basket alongside of it. The second thing we're seeing is what I think is fundamentally the next step of the bifurcation of retail. So the bifurcation of retail said things are going to shift towards the high end, towards luxury, and towards the low end, towards value. And there was this kind of death of the middle concept that came along with it. Now, the problem is if everything starts moving to those two lanes, you start getting saturation. And we're seeing that, right? So dollar store players that have been performing incredibly well started seeing visits decline or visits per location decline, some sort, earnings that weren't as positive. They're starting to close stores. And it's not because their orientation or the value or the offering that they bring to the table is less exciting. It's because there's just only so many stores that a market can sustain and give kind of value to. And so you see these declines. And what that's telling us is not that, again, not that dollar stores are some weak position, but that there is a ceiling on growth. And if there's a ceiling on growth in the value lane, and by the way, we're seeing the same thing in luxury too, then where is that attention going to go? We think there's going to be a really significant rebound of the middle. And that you're already seeing elements of that. Dollar General launching Top Shelf, super smart. You're going to see, I think, luxury chains start offering more value-oriented offerings that kind of bring them down a little bit. And I think some of the best positioned retailers are those that aim for the middle. Now, the middle doesn't mean not value or not high items. It means the right mix of them. So it's a little bit more nuanced. It's a little bit more challenging. But for those brands who can really hit it, there is a powerful opportunity there. The third one we wanted to hit on is retail media. Now, think about the things we've discussed, right? Not enough retail space. We've talked about kind of the caps for some retailers on the amount of locations they can have. In some spaces, there's real challenges with margins, and there's only so much you can do in grocery. Like it's a challenge. And so retail media is a really exciting thing in the brick and mortar environment because it basically says, how do we introduce this high margin revenue opportunity into retailers that already have a massive amount of space available to them? They're close to the consumer. They're reaching the consumer when they're still in discovery mode, when they're more open to new ideas, when they're close to the point of sale, when they have high intent. This is a really powerful advertising channel that, while, again, if you talk to a CPG brand, end caps have been there forever. This isn't something new. But the way that retailers are thinking about it is fundamentally different, and it's introducing a totally different dynamic into the mix for retailers to kind of avail themselves of. And it's also kind of the direct consequence of this growing appreciation of the role of the store. So again, think pre-pandemic, the store was a place to go in and buy things. Then we introduced buy online, pick up in store. We introduced delivery from the location. We think about it from the ability to uplift sales online. But this idea that it is actually an advertising channel too is really important, really significant. This space it's not going to hit this crazy tipping point most likely in 2025, but the foundation is being set for an explosive channel that could drive lots of revenue. And you're going to see which players really position themselves well to own a big piece of that market over the coming years in terms of who's going to benefit most in the long term. And then the last bit, I think, is a really important reflection on that digital physical combination. So if we think of the classic terminology we've always used to talk about, it's omni-channel retail, right? But what does omni-channel retail mean? Omni-channel in its most base form means like every channel. And that's actually what guided a lot of how retailers approach digital and physical, was how do we have as many channels as possible so we can be wherever the consumer wants us to be. The problem with that mentality is it was never about how do we create the best experience or maximize the channels in kind of together as effectively as possible. It's how do we have all of them? And very often what was happening is retailers were launching more and more channels. Those channels weren't really living harmoniously together. And as a result, they weren't bringing the full value. Instead, I think what we want is, and I'll steal the terminology from our friend Steve Dennis, harmonized retail, which is a retailer saying, these are the channels that work for me. And this is the type of experience I want to create so that I can maximize lifetime value. So let's take two examples of what that could look like. Let's take grocery. You walk into a grocery store and you do a huge shop, right? You get fruits and vegetables and meat and fish and cereal and dry goods and all that. And then you pick up one of those big things of paper towels, it's a gigantic, stack of paper towels. You put it in your cart, you go through, you get ready to leave. And there's a pop-up on the screen because you're doing self-checkout or whether you're going through the cashier, and they say, hey, do you want this paper towel thing? Would you like another refresh next month? And we'll deliver it to your door, right? Smart, because all of a sudden the things I still want to buy in store, I can buy in store. But this thing that I don't really need to choose, I'm not really being like, oh, is it this package or that package of paper towels that I want? I know I like the brand that I love, and I'm good with it probably next month as well. But then when that delivery comes in a month, it's not saying, hey, do you want to order it again next month? It's saying, how do I get that person back in the store? So they'll get those other complement of items in the physical location. And it's a digital loop concept of how do I do the things that benefit the retailer most when I buy them online when I'm not in the store? And then how do I use those digital touch points to drive me back to the store for the things that I'm going to buy in person? Even think about, I'm a huge fan of a brand called True Classic. They make t-shirts and like polos, awesome clothes, right? The first time I bought it, I walked into a store to find the right size. Since that initial stop at the store, I have not gone into a store again. I just buy it online. But when they launch a new product, I want to go in and try it on to make sure I get that right fit and then continue doing those purchases online. But that's still using the physical store to drive lifetime value and then the digital to keep me engaged and eventually get me back to the store so I can have that other channel of lifetime value with new products. And so I think that kind of concept is super important because it asks where the innovation is going to go or where it should go, where the strategic decisions are going to go where they should go. And it gives us this sense when we hear retailers trying things, do we feel like this retailer really gets where things are moving, or are they still stuck in maybe an outdated mindset that might not work?
Wow. Okay, a lot there. Pretty insightful to say the least. The last part, the looping, I think makes a lot of sense. And it's probably art and science to try to get someone like you to get back in that store. Some sort of discounting and or incentive that gets you continuing to build this kind of habitual loop of purchase intent. I wanted to spin back to the very first part and maybe work my way down, which is number one. You talked about the value. You obviously broke it up into 3 tiers just for the sake of the conversation. The luxury, you kind of the lower end, let's say, and then the middle. And how do you factor in some of the online players? The Sheins of the world and the Temus or Temu of the world, and how they are potentially the ones that are actually impacting the Dollar Generals and such for some of the cheaper goods that are cheap, and they're going to show up to your door at some point. And then on the other end, when you're thinking of luxury, and this isn't part of what you guys do, but this is more brand strategy. It just sounds like there is some risk of, if luxury is moving into that mid space, there could be brand degradation that happens due to that. Again, that's not a factor that you guys are necessarily paying attention to, given that's more of like a financial analyst thought process on margin. But just more importantly, the first one, you have Amazon shipping, getting stuff to you, between 5 and 10 p.m. if you find the right item. So they kind of like check a box of convenience to some degree. But then you have also the other ones that are really, really cheap. Just, how are you guys thinking about, the online players?
I think the online players, first of all, a lot of them are doing things in the physical world. I mean, Amazon's a great example. Shein's a great example. They've done pop-ups across the country and have seen a lot of success with it. I think the idea of online only and offline only are both the extremes. It's going to be very few players who are large and successful who do either or. The overwhelming majority are going to have to do both and figure out what does both look like within their unique context. So it could be for Shein that they never need to open a full-time store, that it's always going to be this kind of pop-up perspective. It could be they need, 10, 20 locations, and it could be they decide for 200. The point is each brand is going to have to figure out what that mix is for them. To that second point, I agree with you. I think brands need to ask, what is their USP? What makes them special and different? And then how do they reach their market? There is a challenge, though, if you have said, and again, it could be having a different brand. Like Dollar General is a great example. We have a specific expectation of what we're going to get when we walk into a Dollar General. As a result, they launch Pop Shelf, which is something different. It's not the same thing. And I think every retailer is going to have to ask this question of, why do I expand? To what extent does that dilute my message and my brand promise? And do I need other kind of mechanisms to reach audiences?
Got it. So you did highlight some emerging trends within retail. I don't know if there was anything else that you believed was maybe more new, I guess,
Yeah.
and more emerging than even some of those. Anything that you had in mind that you could share?
I think we're in this strange back to basics moment. Strange isn't the right word. It's a great back to basics moment, right? I think a lot of the conversation around technology over the last few years has been technology for technology's sake. Like, oh, I'm doing AI or I'm doing blockchain or the metaverse or drones or kind of insert other technology fad in here. But the reality is technology is a means to an end. And I think a lot of retailers are asking, how do I drive loyalty? How do I increase basket size? How do I ensure the right products and the right messages get to the right audiences? Those are really important questions. And then asking, all right, what technologies help me get from point A to point B? That's a much healthier process. And I think the return to that fundamental perspective is going to help retail, and it's actually going to help the technology companies too.
Sure. Let's spin to coffee. How about that? There's been a lot of discussions around kind of like Starbucks. Obviously, Brian Nickel from Chipotle is now taking over at Starbucks. We have our point of view there that they're likely having, anytime you have these transitions where you kind of overextend yourself, whether it's price point or, trying to be too fast and too much to too many people, you tend to have to get smaller before you get, try to get bigger. But then you have, a fast growing Dutch Bros, which is more drive through only. And, they hired, the head of, I think like food and beverage from Starbucks to help develop, some of their potentially, I guess, food, at least here on their last earnings call recently. What are you seeing in that? It's probably a little bit too soon to say it's a direct competition to some degree, just given the scale and size of Starbucks relative to the size of Dutch Bros. But
Yeah.
what are you seeing? Is there anything that does suggest that? Is there anything that's saying, these things are, somewhat doing things independently of one another, and it's more of, they're just doing a really good job versus, taking share?
I think Dutch Bros growth is amazing. And if you look at where they're so consolidated in a few regions, there's ample room for them to grow. The crazy thing is, every time we do an analysis on Starbucks and they talk about regions where they are going to expand locations, they are not that saturated. Like there is still room for growth and development for Starbucks as well. I think the key thing for Starbucks, and the thing we've always admired about them so much when we look at the data, is they really own the calendar, and they're very strategic about decisions. So we think about things like pumpkin spice latte and when it's launched and bringing that high season earlier. Genius. We think about elements like, I don't know, how they handle kind of opportunities that fall in their lap. So like Black Friday visitation for Starbucks is amazing. Like it always pops, right? It's a day where people are out there and they know how to take advantage of those. They also know how to launch kind of concepts that bring other value. So free red cup day. One of the barriers that you need to cross in order to get said free red cup is signing up for their loyalty program, which is genius because they know once you're in their loyalty program, you're going to get coffees there, right? We're going to grab some of that coffee spend for you over the course of the year. And so utilizing these promotions, not just for a single goal, but for multiple goals, and having kind of the widest possible net of how do I ensure success here is brilliant. And the last bit is they understand their calendar. They know when are their strong periods and their weaker periods. They know how to utilize the right tactics at the right times. And so, yes, sometimes you're going to have more stores or less stores. But when you have a retailer that has that kind of brand equity and that type of understanding of how to leverage it to drive the multitude of values that it's looking for, I think you're very well positioned for the long term.
Got it. Without putting you on the, with some sort of expectation for the audience, Starbucks, do you think, not from an investment perspective, but just from a business, as a fan, right?
Yeah.
Someone that watches it regularly, what do you think, Brian Nickel can, essentially turn this thing around, or, do you think it's kind of like
turned around? I think it's this is not something that's like, oh my God, it's going into the dumpster, like everyone get out. This is the thing that's good. It has had some bumps, but I would be very, very bullish on its potential in future moving forward.
Got it. Cool. All right. Now, picking more of your brain, winners and losers, obviously any category, anything you can share. Again, you have a wide net, everything from, fitness studios to restaurant chains to, department stores. What are you seeing? And migration trends, not to, totally, filter it only to actual physical locations, but you guys get to see migration trends nationally. And during COVID, that was a pretty interesting, data points that you were sharing back in that time, which you were able to see, where people were moving and where people were staying, dwelling. Winners and losers, just from your point of view that you're seeing, I guess, today.
I'll give you two, and it'll back off of that last point. First is kind of the Costco, Sam's Clubs, BJ's of the world, those wholesale membership clubs. Not just that they're strong, not just that they see kind of each visit maximized. They're able to kind of get you to go over that cliff. Like once you sign up for the membership, you're more likely to come back. And because they do such a good job, you're likely to keep on renewing and staying with them. But also the fact that as millennials moved from the cities to the suburbs and then finally had a house large enough, a pantry large enough that they could take advantage, they're close enough to these locations, they're falling in love with these brands too. And it just shows this kind of almost inevitable long-term success for these chains, as long as they stay focused on those fundamentals. And the second one is specialty grocer. And it's unfair to call them specialty, but I'm throwing them in this category for a specific region. Trader Joe's. Trader Joe's, we see the visits up. We see the distance people are willing to travel up. We see visit durations in a strong place. And essentially all this happening while cross-visitation is up. So meaning people are not just going to Trader Joe's, they're going to multiple other grocery stores too. And what it tells us is that people love that experience. They love products that they get there, and they're willing to make it a part of their mix, even if it's not the only place within their mix, which is a powerful asset to have currently in this market.
That makes a lot of sense. You can count me as one of those data points that loves the value plus the the type of quality or type of products they have in store. We'll end there. I know we're running up on time. You shared a lot, so it's pretty dense of but in a small time, which is what I love bringing you on here. Appreciate you coming on. What I wanted to do, before you jumped and we head to the next session, was essentially give any place to find you personally and or Placer AI as a whole.
So you can find me on LinkedIn. You can also find us at placer.ai. We have a free version. Send us any messages, concepts, contacts. Try out our free tools, and we look forward to seeing you there.
Awesome, good stuff, Ethan. Thanks for joining, and we'll jump to our next session.
On to our next session. Now let's welcome to the stage Summerlin from the AI investing firm Autopilot.
All right, we are on to our next session here with Will Summerlin from Autopilot. You probably know the name Will and his partner at Autopilot, but Autopilot is focused on AI, specifically in venture capital. So we're pleasure to have you here today talking about all things AI, the state of AI. You mentioned earlier ago, you made some recent deals. So want to learn more about that. And, again, just everything AI from your point of view, but welcome to Avory Idea Day 2024.
Yeah, thanks for having me, Sean.
Yeah, so let's start there. A little bit about your background, just for the sake of, some of the listeners or viewers that haven't, followed your story and Max's story. It's a successful story, and now it's kind of, this is, the 2.0 of both of you.
Yeah, for sure. So I will go back a little bit in time. I started my career in San Francisco, started an AI company in 2015. So back before AI was cool, built that company up over a few years, and we ended up exiting that business in 2019. So it was part of kind of the first AI wave, which has been a cool perspective because I've seen the ecosystem build from this kind of little niche thing in San Francisco to what it is today. After that, I ended up joining a firm called ARK Invest, Kathy Wood's firm. Initially joined to cover AI and software in the public markets. And that's where I met my current business partner, Max. He was leading fintech coverage on the public side. And he had actually started his career in venture capital as well. And so the two of us got together and said, hey, at ARK, we're spending a lot of time on top-down research, really trying to understand how technology is going to shape markets over 5 to 10 years. And we felt like that research is not only applicable to the public markets, but arguably even more applicable to the private markets. And so we went to Kathy and said, hey, we really think ARK should have a private market strategy. And Kathy is awesome because she's entrepreneurial and likes to build new things. And she said, great, let's do it. And so we ended up building and leading a private fund inside of ARK, the ARK Venture Fund. Made 16 investments from pre-seed to pre-IPO out of that fund. And the fund has done well. We were early in companies like Anthropic, which is one of the big AI leaders now, Replit, which is really the dominant AI coding platform, and a handful of others. And at the end of last year, Max and I both had this kind of entrepreneurial itch to build something. And we said, okay, we love ARK, we love Kathy and what ARK is doing. But we want to build something from the ground up and build our own firm. And so we decided to spin out of ARK and launch our own firm, Autopilot. We're entirely focused on AI and entirely focused on the private markets, taking a similar stage agnostic view. So we invest from early stage up to pre-IPO and really try to find companies that we think are going to dominate these large growing industries.
Got it. Makes a lot of sense. Why AI? I guess obviously your background was AI. I used to collaborate with Max, specifically around fintech. That was his kind of specialty at the time. Just why AI and just like a sheer focus on AI. I know, again, at your prior landing spot at ARK, you guys really carved out certain areas and went after them. So, is it some of that playbook? Is there something around, AI that you think, specifically around generative AI? I forget exactly the timing of the launch of Autopilot. Was it before or after? I think that's a good question. And then two is, just specifically, what do you see about AI that you think you can build an entire firm around?
Yeah, we launched at the beginning of this year. And as we looked around at the opportunity set and what's happening, I think we're at a very unique moment in history. We're getting to a point where AI can do much of the cognitive tasks that humans are paid to do, not only cheaper and faster than humans, but in many domains, AI can do a much better job than humans. And, to give you an example, if you go back in time a little bit, there was a program called AlphaGo that came out of DeepMind, which is the research lab within Google, and it was able to beat the best Go player in the world, which was thought historically to be a very, very challenging game for computers, something almost impossible for computers to master. And that was kind of the tipping point where now we've started to see AI become superhuman in many domains. If you look at Tesla's full self-driving technology, it's driven 1 billion miles in autonomy, and it's 6 times safer than human drivers. And so across many domains, we're seeing AI outperform even the best humans. And if you zoom out and try to think about that opportunity set, human knowledge workers are currently paid about $32 trillion a year to do knowledge work, to write software code, to review contracts, to do things that AI is increasingly automating. If you look at software engineering as a case study, AI has gotten to a point where it's roughly as good at writing code as the top 10% of software developers. And it costs $40 a month for an AI agent that writes software code. You have to pay a software engineer $400,000 a year. And so you're seeing this differential where AI is just able to automate much of the economy and much of the knowledge work that's currently done by humans. And so to us, this is an opportunity that's not bigger than just the internet or mobile, but this is something that we think is going to rival the Industrial Revolution. And it's probably going to be one of the key inflection points, in the economy over the next 100 years. And so for us, this is the only thing that matters, and it would be crazy to focus on anything else.
Yeah, no, I think we echo the idea that this will be everywhere, with probably everyone to some capacity, similar to the internet or something like that, where, it may not be the infrastructure that is ultimately, powering it per se, but the actual output has much more meaning, I guess, than, what the internet's doing at the base level. In general, though, talk about, I think you gave a little bit of the generalized state of the AI, today, but you have a portfolio of companies, going to your website, Autopilot, I think, .vc. Correct me if I'm wrong. Yeah, APV.vc. There you go. On there you have your portfolio companies. You just mentioned you've signed your 6th deal here recently. Just talk about what you saw, the why you kind of made some of these investments, and then we can probably discern your point of view on AI.
Yeah, absolutely. So we invest across the stack. We invest at the infrastructure level with kind of the core primitives of data and compute. We invest at the foundation model layer, and so companies like xAI and Anthropic, and we invest at the application layer, companies taking this technology and building products around that. And so we've made investments in all of those categories so far. The first investment we made was in May of this year in xAI, which is Elon Musk's new AI company. And other than it being Elon Musk and that alone being a reason to take a bet,
Sure.
What we've seen is that in AI, there's this concept called scaling laws, which essentially hold that the more compute and more data you use to train a model, the better the model performs. And so if you really want to distill this down into the most elementary elements, basically, if you have more compute, you're going to have a better model. And so there's been this race to build out more compute capacity. And most people have been partnering with AI clouds or with hyperscalers to try to get GPU compute. And Elon looked at this and said, well, let's just vertically integrate and do this ourselves. We're going to build our own data center. We're going to do it faster and bigger than anyone else. And in typical Elon fashion, he said, we're going to start with 100,000 GPUs, which at that time was 4 times larger, 4 times more compute than anyone else on Earth had. And he said, we're going to start there and we're going to scale up to 1 million at some point. And everybody said, that's crazy. It's going to take 3 to 4 years. And from when Elon got the shipment of GPUs to when the computer was live, it took 19 days, which is just incredible. I mean, he did something in 19 days that should have taken several years. And so it's a testament to Elon and his abilities as an entrepreneur, the team that he's built around him. But we really see xAI as the company that we think is going to dominate in the foundation model space. And so that's where we made an investment. We made an investment after that in a company called Scale AI, which is really building kind of the data infrastructure for all these new AI models. That company, this is public information. They're at $1 billion in ARR. They're growing 300% year over year, and they have 90% market share among the model developers. And so really dominating in that data space. And we think data is going to become increasingly important, especially as we move into synthetic data and different forms of proprietary data. And then we most recently made an investment in a company called Wilson AI, which is a very early stage company that's building an AI agent for internal legal teams. And so a lot of internal legal teams are swamped by legal work. And you see this represented in outside legal spin, because when the internal legal teams get oversaturated, they go push things to outside counsel. And outside legal spend's been growing at about 30% a year for the last couple of years. And so you see this pain point within companies, and they want a solution, but it's hard for them to hire more people. AI is a great tool for them. It allows them to do their work more productively. Often you can double or triple the capacity of an internal lawyer if you have the right AI tooling around them. And so Wilson's a great company. It just came out of Oxford, Cambridge, founders from D.E. Shaw and Clifford Chance, which is one of the premier law firms in Europe. And so we really look for both the infrastructure and foundation level, and then look for applications where we think a company can monopolize a given vertical.
Nice. So we know the infrastructure layer, at least over the last couple quarters, I guess, years. It's been quite a while now since we started to hear from the Anthropics and whether it's Llama 3 and many of the other, whether open source or commercial private businesses. So it sounds like you've migrated maybe somewhat to the application layer, at least, to even the vertical layer. You talked about something around, specifically focused on attorneys. Do you think, somebody that is laying investments in the space specific to only AI, how much more infrastructure layer do you think you guys have left? Or, some of the names I referred to before, add in the Anthropics and some of the other smaller ones. Do you think you're mostly done there? Is that kind of area somewhat already accounted for from a, who's going to win and who's winning market share? And more of your future investments will be kind of middleware, where you talked about like Scale or something like that, and connecting the data sources to the models, then to the, the consumer, the enterprise. And then vertical, right? So like, I think that's the natural progression of industry, is build the infrastructure, build the guts, and then, start to build applications and then verticalize that, similar to what we saw in like CRM or anything like that. So what's your views on, where you think the future investments are coming from, as opposed to, where you've been so far?
Yeah, I think that's a good framing. I think in the infrastructure layer, and you could say this is true for the middleware layer as well, the winners are going to be absolutely massive in our view. But those winners have already sort of been solidified, right? And so if you look at a company like Databricks or Scale or XAI, like in our view, those companies are the dominant players in their markets, and their markets are going to continue to grow at a very rapid rate, and they'll continue to maintain dominance and market share. And so they're great businesses, but they're not early stage companies. And so when we look at the early stage side of the spectrum, we see companies that are trying to compete with Databricks, that are trying to compete with Scale. And I think that's a tough position to be in. Those dominant players have market share, they have distribution, they're very innovative, they're releasing products at a very rapid rate. And so I think it's a tough place for early stage companies to play. And so when we place infrastructure bets now, for the most part, we're placing bets in later stage companies like Scale AI or a Databricks. On the early stage side of the spectrum, that's where we're getting much more excited, the application layer. And there are some industries, I think this is actually a mistake a lot of people are making in venture. People are placing bets in markets with obvious use cases. Look at sales applications for AI, right? Using AI to help you clean your CRM, things like that. Well, there are literally hundreds of well-funded startups in that market, and the incumbents like Salesforce are pushing down very aggressively and releasing features that are competitive with those startups, leveraging their distribution advantages and often giving away the features for free. And so, we think those are actually difficult markets to build a monopolistic multi-billion-dollar business in, just given the level of competition. It's very hard to develop pricing power. And so we're getting more excited about markets that are maybe a little bit more off the beaten path, where if you look at something like manufacturing, you have this backdrop of reshoring to the US, but that's only going to happen if you have high levels of automation. And the incumbents in that market are not technology companies, right? They're going to struggle to actually build and embrace AI. And so that's great, because it creates an opportunity for a disruptive startup to come in and break up that market. And if you look at some of these markets or subcategories like tool and die making, huge market, 200 billion a year in spend, massive labor shortage. And there are probably 2 or 3 interesting startups building in that space. And so you have this disruptive catalyst. It's an opportunity for a startup to win the market, but those markets tend to be much less competitive, and those winners can develop a lot more pricing power. And so that's where we're currently getting excited, avoiding those kind of oversaturated, overhyped markets and looking for these verticals where, I can do something 10 times better, cheaper, and faster, where there's not as much competition.
Got it. Makes sense. The infrastructure players too, they're seemingly trying to move to the application layer. historically we saw the applications, the Amazons, the Microsofts, the Googles, which were consumer facing to start, migrate backwards into the infrastructure. And obviously those are some of the biggest, profit drivers for these businesses today. You're seeing quite the opposite here, where you have, the call it OpenAI, obviously, trying to mimic maybe some of the current state of applications, whether it's Google search. You have Perplexity focused on that, but again, they're not necessarily a infrastructure player. But how do you view that, where you're investing, you're choosing an infrastructure player or a couple, then you're also making bets on the application layer, like facing consumers and enterprises and employees for the most part. Like, what's your thought process around, I guess, the risk of the models themselves and or the model companies themselves at the infrastructure layer owning the compute to some degree? They're all playing for NVIDIA today, but you can imagine, depending on how well funded they all end up becoming, how deep they go on the infrastructure side, and then what that means ultimately to these mass distributed, call it language learning models, that they could essentially disrupt many of the applications that will be coming out if these models are horizontal enough. So any thoughts around that? Again, I'm thinking openly here, but
yeah, it's a great question. I think what we're seeing is the foundation model companies are playing in the really big, obvious markets like search. And so you've seen ChatGPT now evolve into a search product or a search feature, and they're going head to head against Google and Perplexity. And so the foundation model companies are placing their bets in these really big markets, often that are more consumer oriented or kind of prosumer oriented. And so, again, I think that's a tough place for early stage startups to play. And Perplexity is now a later stage startup, but they're kind of the one that broke through. But if a company says that they're going to build an AI native search tool, good luck. It's going to be a really tough market to play in. You have the traditional search incumbents like Google that are competing to defending their turf. You have the foundation model companies that are really aggressively competing in that market. And if you're, Sam Altman, it makes sense because it's such a massive market. That's where you want to attack. That's where you want to get 3, 4, 5, 10% market share. And so from their perspective, it makes complete sense. And again, I think this solidifies the thesis around vertical applications of AI. OpenAI is not going to go play in, tool and die making, right? And building models to optimize the design of an injection mold, or tools to optimize the design of a printed circuit board. It's just those markets, while they're 30, 40, 50, $100 billion markets, they're not big enough for OpenAI to really care about. And so that's where we see an opportunity for early stage startups. And I think the reason I might be wrong, and the counter argument here, is that if we really do get to AGI, artificial general intelligence, a single AI model or a series of models that's able to do pretty much every cognitive task better than any human on Earth, then the foundation model companies are just going to win everything. But I think I tend to be a little bit more bearish on that. I think we're going to have domain-specific AGI, where AI is better than humans in a given domain, a specialized model is better than humans in a given domain. But I think that the vision of having a single model or a series of models that's just superhuman at every single cognitive task imaginable is still a bit of a pipe dream.
Got it. Yeah, no. At least here now, right? I think everyone's asking those questions to some of the industry experts, and most of them punt the question. But those that do answer it, I still think have confidently articulated that we're still a little bit away, from AGI actually existing at scale. Now, there's always the question of using it myself in different ways, feature versus an actual product. We've seen that time and time again, where you have something that comes out, some sort of breakthrough innovation that seems like something more than a feature, and then ultimately what you see is every company here in the last, at least in the public markets, articulating an agent. You have the Salesforce agent. You have Boxworks. Box just had their Boxworks event here recently, and the big announcement was their Box agent. And in some ways, and I've talked about this online on X or Twitter, the fact that many of these platforms like the Mondays.coms and many others had these automation tools that existed, and you could do stuff. You could actually automate some of the tasks. If I click this, it'll lead to this and drive this. Now, what you're seeing, I guess, more and more is that all these other companies are starting to build these call it agents or automation inside their platforms. And I guess the question for you is multi-tentacled, but it's, do you think, does this end up just being a feature? Do you see a standalone? I think ChatGPT is clearly defining itself as a full-blown suite of services you can possibly do in there. But as I see more and more of the announcements coming from the incumbents, to be specific, it's more focused on an agent, which I think is just a step function a little bit better than some of the automation tools that were already embedded inside. I do think it opens up the surface that my agent can talk to your agent, because now we both have agents. That's maybe where things differ. But then again, you have the Snowflakes and Databricks and Zapier and Make that are API connectors that have allowed data flow to occur. Anyways, it's a little bit of a ramble, but the root of the question is, how do you know this isn't a feature?
I think there's a big difference between the competitive landscape in the internet age and the competitive landscape today. If you go back to the internet age, a lot of the incumbents were structurally disadvantaged. If you look at Barnes & Noble versus Amazon, Barnes & Noble had this massive physical infrastructure that did not really give them an advantage when it came to the internet. And Amazon, in many ways, had an advantage because they had a blank slate. They didn't have the baggage of the physical infrastructure of Barnes & Noble. Whereas today, I think a lot of the enterprise software incumbents are structurally advantaged. If you look at a company like ServiceNow, they have significant data advantages. They have data across their platform. All the customers use them as a system of record. And they have distribution advantages. It's really easy to go to a customer and say, hey, just click this button and enable this AI feature. It's a much easier sell than convincing them to rip out an old system and replace it with a new system. And so I think in many cases, the incumbents are actually structurally advantaged. We spend a lot of time talking to CIOs and CTOs of large businesses, trying to understand how they're thinking about buying behavior. And most of the feedback we've gotten is the first place they go is their existing vendors. Say, hey, do you guys have AI features that we can turn on? That's the preferred approach. And I think this is where you get into some of the nuance within the enterprise opportunity set. Some of those incumbents are innovative, right? ServiceNow has been very aggressive in rolling out AI features. Some incumbents are not so innovative, and they're not building AI features, or they're not doing it well. And that creates an opportunity for a startup to go in and disrupt the market. But in general, I think broadly, like good enterprise software companies, the incumbents are pretty well positioned. And so I think for startups, like you have to look for markets where, again, going back to the point I was making earlier, there's not as much competition, right? Where you can really disrupt the market and create a monopoly. And I think from our perspective, we're getting more excited about industries where the incumbents are not technology companies. So I mentioned manufacturing as an example. In manufacturing, one of the interesting observations we've seen is that it's actually quite hard to sell AI technology to mom and pop tool and die makers. Like most of them are not using, CRMs, like let alone AI. And so to go to somebody who's in their 60s, who's been running their business the same way for 30 years and telling them they should redesign it in an AI native approach, like they're just going to say no, right? And so that creates an opportunity for startups to go and vertically integrate. And instead of selling software to the incumbents, they can actually build an AI native tool and die making company and vertically integrate and go everything, manage everything from the initial design all the way through manufacturing. And it's a totally different business than what most people are used to funding in venture capital, because it's not pure software, right? There's a hardware element to it, and it might be lower gross margin, might be 60% gross margin. But we think in many markets, that's the way to compete. It's to vertically integrate AI and go compete with the legacy stale incumbents. And so we're seeing more and more of that. And that's something we're getting really excited about.
Yeah, ironically, the biggest players today that, started decades ago, the Apples, the Netflix, the Amazons were all low gross margin businesses to start to some degree. And then, obviously they've added services and subscriptions and all these other, obviously their marketplace business is low margin, but, the cloud business is super high margin. So nice. Now, a couple more questions before we spin off and head to the next session. It's really around, if the incumbents, let's say the public markets, are advantaged both in capital, both in data intensity, combined with technical potential prowess as well. Like, how do you think? How do you manage that risk? I guess. Obviously, you mentioned going to the areas where maybe the incumbents aren't necessarily tech focused. which is why you're heading to some of these other industries. But how big is that opportunity when you start to carve out, maybe the have-nots of technology as opposed to, those that have? Because most companies today, generally, at least the biggest ones, and again, they don't have to be big to make money. How are you thinking through that of making sure you're not going to get squashed by some of these incumbents that are already, enabled to, potentially succeed here?
Yeah. So we have a pretty good blueprint for the markets that we're excited about. And we spend a lot of time trying to understand the incentive structures in those markets, the competitors, et cetera, before we make an investment. And I think one of the advantages that we have, given our background coming from the public markets, is we know most of these enterprise software incumbents really well. We know their businesses, we know the management teams, and Arc is a relatively large firm, and so in terms of assets under management, so we were among the largest shareholders in many of these big public software companies. And so I think most early stage investors don't even pay attention to the public markets at all. And we're coming from a place where we know these businesses intimately, and we know what the CEOs are thinking. And so that gives us an advantage. And so when we look at a market, we look at the incumbents in the market, we have a pretty good idea of whether or not they're innovative and whether or not they're going to be able to capture the opportunity set. And so I think that's really the starting point. But broadly speaking, as I mentioned earlier, like we love markets where the incumbents are not technology companies, where they're structurally disadvantaged, where a startup can go in and really disrupt the incumbents and end up owning most of the market. And we see a lot more opportunity outside of the traditional enterprise software categories. And going back to the numbers, today, humans are paid about $32 trillion a year to do knowledge work, but the global enterprise software market's only $1 trillion. And so there's a massive opportunity set outside of IT software management or IT service management or CRM. And I think that's where we're getting most excited. Love that.
Employment. So obviously you're looking at startups to some degree and late stage, but let's just focus on, we can focus on both. There's always the idea that, AI will eat, that $30 trillion of knowledge work, and, where it lands, nobody knows. But, what's your views on, AI as it relates to employment?
Yeah. So I think what we have to believe is that the disruption of human knowledge work is happening. And we're already seeing this in many cases. If you go talk to some of the CTOs of the big tech companies, they're hiring far fewer junior engineers than they were 3 years ago. And they're basically looking at this and saying, okay, we can buy an AI copilot for $40 a month to help our senior software engineers produce code. Or we can pay, a junior engineer $200,000 or $300,000 a year to generate the same amount of code. Of course, you're going to spend $40 on a copilot versus $300,000 on a human. And so we're already seeing the impact of this. And I think it's only going to accelerate. The question then becomes, over the next 5 to 10 years, what happens to knowledge workers? And I think there are basically two arguments. There's the techno-optimist argument that throughout history, every innovation cycle has led to more prosperity, wage growth, more opportunity, lower cost of goods and services. And so it's been a net positive for society in that sense. But there's also an argument that this time that might not be as true. And if we're getting to a point where AI is better, cheaper, and faster at most of what humans are paid to do, I think we're going to enter a new economic paradigm. And if that's true, it's going to be great for asset owners, right? If you own a business, your business is going to be more efficient, more profitable. If you are one of the companies building the technology, you're going to do incredibly well because you have that $32 trillion pool of spend to go grab at. But if you're one of the just regular employees who's getting disrupted, it might not be so good in the near term. And so I think it's too early to say exactly how it's going to play out. But I think the indicators are suggesting that this is going to be a new economic paradigm. And I think it's going to happen a lot faster than most people anticipate.
Beautiful. Before we jump to our next session, just wanted to ask one question. Which of the babies of the 6 that you so far have owned that you guys made investments in excites you the most? Again, to preface, that doesn't mean he does not like the other ones. It's just simply, and you can punt the question, it doesn't matter. But, any of those that, really excite you, and maybe just, a 1 or 2, sentence reason why.
Man, I can't pick my favorite child. I talked about XCI, which is incredible. Which is incredibly exciting. Just given the mission of the team. I think I'll highlight another one, which is a company called Skyrise, and they're building an AI native operating system for aircraft. And I'm a pilot. I fly planes for fun, and so to me, it's something I hold close to my heart. But right now, aviation is very dangerous. If you look at general aviation, over 80% of accidents are caused by pilot error. And it turns out, if you look at the most expensive aircraft in the world, like the F-35 fighter jet, the Gulfstream, G700, it's actually not operated by a human. It's operated by a computer. And the human is simply providing an input to say, hey, I want to go left or I want to go right. And the computer doesn't let you crash. It's called fly-by-wire. Historically, that technology has been very expensive, millions of dollars per aircraft, very heavy. And so it hasn't been accessible to general aviation. Skyrise has taken that same technology and principle that sits in the F-35 fighter jet, made it a lot cheaper, a lot smaller, more modular, so that any general aviation aircraft can be equipped with the technology. And to give you just like a 5-second example here, I fly fixed wing aircraft. I don't fly helicopters. I took a flying lesson once in a helicopter and I almost crashed. And I was like, I'm never doing that again. This is insane. These people are crazy. Well, Skyrise equipped their technology in a helicopter, a Robinson R66, which is the same one I flew previously. And you control the entire helicopter with a joystick. No pedals, no cyclic, no collective, just one joystick. I got in the aircraft. They trained me for 5 minutes and I was able to take off, fly commercial maneuvers for 30 minutes, come back, hover taxi, land, which to me is absolutely incredible. And I think it's going to democratize aviation. More people will be able to fly and do so much more safely. So that's one we're super excited about. And I can't give their numbers, but they have some very, very large contracts with aircraft manufacturers you've definitely heard of.
Yeah, so we actually have a couple companies here, in the eVTOL space. So that'll be an interesting conversation combined with some of the stuff you just mentioned on AI and piloting. So pretty interesting. We'll end there. Autopilot, apv.vc. That's where you can find more information about their firm. They're doing amazing stuff there. I've known some of you for quite some time now in your ARC days. But if I just to leave it for you to let people know where to find more about you specifically. Obviously, I'll have the team add the website link to Autopilot, but to find more information about what you're talking about and doing.
Yeah, check out the website. We publish our research there. We also have a podcast. Great guests. We just had the CTO McKinsey on. And always feel free to reach out, Will at apv.vc, if you have any questions or cool companies.
Awesome, man. Will Summerlin from Autopilot. Thanks for joining us today, and we'll head to the next session.
Thanks, Sean.
Now welcome Seth Golden from Finom Group to discuss macro and micro views.
All right, on to our next session. We're here again with Seth Golden. He often, visits us, and we get him on webcasts to talk about micro and macro. One of our favorites to come on here today. Again, the focus will be really around what you're doing today. How you're thinking about 2025, both at the macro and micro level. Some ideas around companies that are of interest to you and your group. But before that, obviously, welcome to Avory Idea Day 2024 and joining us today.
No, I appreciate the invite. Always glad to jump into the macro conversations, the micro conversations. I try to stay away from the politics. Most people do. So appreciate the invite, and hopefully we can get some good dialogue for the audience going. Maybe even some ideas.
Cool. Yeah. So let's just step back real quick for those that haven't listened to you speak. Obviously, you have Finom Group. You have a pretty strong following across many of the platforms out there that are the FinTwit universe or something like that, X or Twitter, whatever we want to frame it as.
I don't know what to call it anymore.
Just really good information. We've collaborated in the past on different things. And obviously, I think, Avory Idea Day is really around the idea of, bringing unique ideas to the table, some thoughtful, interesting information around, where we think 2025 is going and beyond. So Finom Group, just tell us a little bit about what you guys are doing there.
Yeah, so at Finom Group, we high level macro market research. We get into some investing strategies, investing ideas. Basically, digesting all of the information flow throughout the week surrounding what's going on in the economy, what's going on in the markets. We get down to the brass tacks of what we believe is value added and beneficial for the active portfolio manager. You had mentioned all the different social media platforms out there, and there's a lot of either misinformation or information overload that the average investor is trying to digest on their own. So at Finom Group, we narrow it down with fact-based evidence-backed research on the economy, on the markets, market breadth, individual stocks, ETFs, all of that good stuff. And we deliver it in a weekly macro market research report. We do a lot of quantitative analysis as well. In fact, I've done a workshop of quantitative analysis. I call it the quant almanac, if you will. A lot of traders and investors are familiar with the Trader's Almanac from Jeff Hirsch. We've created our quant almanac this year that will help. It's kind of like an investor's guide. Every year, you look for these particular happenings in price action in the market, and this particular quant will be attached to that and can give you a really good idea of what you should expect or anticipate as an investor in the market going forward. So a lot of really, I would say the average investor, the novice, up to institutional level investors, there's something for everybody at Finom Group.
Cool. Yeah. And for those that don't know, Seth's out of Ocala, which means he's highly independent in his research and thoughts.
Yes.
And I love that idea. Sometimes you get this group think, obviously, when you're in places like New York or something like that, and you have the crowds and the different circles that you're running in. So anyway, that's a pretty interesting thing because we're right down the road in Miami, or a couple hours away, 4 or 5 hours to get there, and interesting place with a lot of horses. We just talked about that offline, but in general, let's get into the more substance discussion here, which is really around macro. To start, let's go from the top down. I'll lay it off just from some of the conversations we've had in the past with you. I remember going back to some of our prior webcasts, podcast sessions, and I think there was a very small size of group of people that I think were articulating that inflation was coming down, that rates were somewhere around where they should be, that they necessarily weren't going to be pushing higher too much, or if they would, that would be a mistake. And that the economy was in a pretty good setting. You had savings rates that were still pretty elevated. If you took wages and adjusted for real-time inflation, you actually got positive much earlier than some of these indicators were suggesting. And as that accumulates, obviously you get consumption, and that leaves us to the tail end of 2024, where we sit today. New president coming in January. Your thoughts on the macro? Obviously, there's the inflation stuff, and wherever you want to focus, wherever your attention is today, as we lead into 2025. So I'll give you the floor.
Yeah, so you laid it out perfectly. If we go back to late 2022 and 2023, I think you and I were one of the few people that were recognizing the real-time inflation data was coming in or coming down nicely. And that's not to say that prices were coming down, but the rate of change within those prices was definitely decelerating. Fast forward, you get into 2024, and I was of the opinion that progress or further disinflation was going to be the landscape here through 2024. We had that pause, if you will, or that temporary trough in the inflation measures, whether it was CPI, PPI, or PCE, all in the first quarter. And then people started to, social media, especially even on financial media, started floating the ideas of a reflation or stagflation scenario, for which I've always been of the opinion. I say opinion because, the data that I have, the data that I study regarding inflation, regarding macroeconomics is never foolproof. It's not going to predict the future, but it gives you a good idea. If it worked this way, throughout history, more than likely it works this way in the future. And we were modeling what had happened coming out of World War II. You had this really rapid disinflation, similar to what happened once we peaked in 2022. June 2022, CPI, PPI, they all peaked out. And then we had a real rapid descent through the end of 2022. Throughout all of 2023, but then in the first quarter of this year, hit the pause button and people started with the narrative again. But we saw the same thing in 1947, 1948. All of a sudden, the base effects, whether it's inflation or deflation, there's always base effects. So we were, disinflating at a rapid pace, making the prior year's comparisons difficult. And in the first quarter of this year, we simply had to digest those tough disinflationary comparisons, for which in 1948. Then you rolled down another level in all measures of the inflation data. And that's exactly what has happened here this year. After the first quarter, we took another leg lower in all of those inflation metrics. So if I'm fast forwarding now to 2025, and as you mentioned, new president, new White House administration coming in, and we kind of have somewhat of a playbook for the new White House administration, given the first term presidency from 2016 to 2020, and the trade wars, the tariffs, and I know that's kind of top of mind with a lot of economists and market participants. So I would say, we'll see exactly how policy unfolds probably by Q2. I doubt very much we're going to get a lot of policy right, in the Q1 period, policy initiatives or implementation. So I'd say, we at least have the first half of the year where the lay of the land for inflation, as well as just the broader economic tailwinds that we'll be carrying into 2025, should persist. And then when we start seeing some of the policy implementations around possibly tariffs and or cutting the corporate tax rate, cutting the net, the income wage rate, things like that, we'll just have to kind of play it, month by month to see what can get passed through legislature, what can't, and what's the progress look like getting those things through Congress. But for now, the lay of the land is it's pretty good. I mean, you got low unemployment, although decently off the lowest levels of the cycle. You got jobless claims that are just barely above 200,000. Retail sales are quite robust. Consumer spending is quite robust. Housing, I wish that could be a little bit better. But the main component that I continue to track, follow, suggesting that all is well, despite the transactional bear market that we're in for housing, is construction employment. And as long as that's still strong, because it tends to be a bigger part of the overall employment data, more than likely the economy will just keep humming along in 2025.
Yeah, tend to agree here. Obviously at Avory, and one thing that's fascinating, I think, over the last couple of years is really the fact that we've kind of had continuous rotating taking place within the economy.
Yeah.
And the bigger question is that going to happen again in this, call it next, several years, where you highlighted how housing has been, weak on one side, which is really around transaction volume in the existing homes, which is impacting things like realtors, mortgages, refinancing, things like that, which are big cohorts of the economy. But at the same time, construction for new homes because of undersupply has been pretty good. Now, the question obviously is if inflation is further moderating, over the next 18, 24 months, does that lead to a gradual decline in overall rates, which then leads to a decline in mortgage rates, specifically attached to like the 10 or 30 year treasury? Would that then suggest we would potentially then get existing home sale transaction volume to pick up again? Just the amount of homes. I'm not talking even about pricing. That's obviously
Right.
supply and demand at that moment in time.
Right.
But then the knock-on effects of that starts to impact, the Leslie's pools and starting to impact
yeah.
Restoration Hardware, which has been stuck in mud for several years. And those are specific companies, but I'm trying to point at those to talk broader around that. But then, is it at the expense of the cruise lines, where we got data recently just showing continued booking demand, continued pricing growth? And, you hear things like recently with Target and Walmart having diverging trends.
Yep.
Groceries doing pretty well, but then, some discretionary space is not doing well. Then you have On Holdings doing incredibly well. So that's pretty discretionary. And yeah, that's I guess pointing it back to you with those thoughts is, do you think we continue to be in this two-way economy where you have kind of this yin and yang versus historical cycles used to be kind of one way? Housing and banks, financing, all credit conditions all went in the same direction and all evaporated just as quickly at the end of the cycle. So, any thoughts around, that idea, I guess?
Yeah, I'm an old man. So, I've been around since the 80s and I've seen all kinds of different economies. I've seen all kinds of different economies, but the one thing I've never seen is a perfect economy. So there's always these puts and takes. There's always certain segments that are doing really well and certain segments that are doing poorly. And then it's perception as well. When we think about the United States and we look at the economic data on a weekly and monthly basis, right? We've been in a manufacturing recession, according to the surveys, for what, 2 years now? The ISM Manufacturing Index down, 2 years. But the reality is most of that data is centered on refining, right? It's mostly crude oil, it's refinery. That's our major manufacturing here in the United States. There's very little in the way of textiles and very little, although growing, so far as computer parts, electronics and stuff. That's really growing. Building materials and supplies, really growing. And when you look at total manufacturing, we're at near record levels. But when we consider ISM manufacturing, which has a different component, and it is just a survey. How do you feel? What do you think? What's the future look like? That's kind of soft, squishy data. And that's why I say it's about perception when it comes to, some of these things. But what I think you touched on is exactly the way that I would encourage most people to look at where we are today and the potential for the future. A lot of people are not really reflecting on the fact that the Fed fund rate is still, 5%, give or take a quarter, and coming down. That's a lot of levers for which the Federal Reserve can pull in the future to catalyze economic activity, whether it's to support housing, falling rates, falling mortgage rates would be a tailwind to all aspects of housing, pending, existing, resales, and new home sales. And when people buy homes, the second thing that they do is buy a lot of crap to go in those homes. So yeah, maybe Walmart's doing great because they got the consumer staples, the grocery. But if we get these levers pulled that lower mortgage rates and people got to buy a lot of crap to go in these homes, forgive my French, crap's not French, but then maybe Target does better. Maybe, some of the other home goods suppliers and knickknack, shops, Kirkland's, which is a really niche, small type of home goods retail. Maybe they do a lot better because you have the transactional volume that starts to pick up for homes. So I think the way that I look at it is, and what I had said in 2022, it feels bad for investors in this moment. If we flash back to 2022, but this is actually a good thing. The Fed didn't really have a lot of maneuverability when it came to supporting the economy, other than taking its balance sheet that much further into the red prior to 2020. But with the opportunity to raise rates as much as they have, now they have so much maneuverability. Not only that they've raised rates to the extent that they can drop them 500 basis points if they absolutely needed to in an emergency, but they've also had lightened their balance sheet over the last, call it 2 years, to the point where, if they need to take on assets once again to support the economy, they can do that as well. This is one of those periods of time where we really have, a good path forward. And I know saying that is kind of, like whistling past the graveyard, or the graveyard of those fiscal deficit hawks. No, they don't like to hear this.
Right.
But yeah, I think we have all that we need, should we falter, a little bit here and there, to keep us on the straight and narrow so far as the economy is concerned.
Yeah, last little segment on macro, and then we can jump into, not that the macro is not interesting, but it's, sometimes digging into the actual underlyings can get pretty interesting. But, speaking about the hawks, right, the deficit hawks, there's a lot of people out there, not to name names, but just in general, that explicitly discuss the idea that we're in a structurally higher inflation, therefore higher rate economy. We have our view, but I definitely wanted to leave it to you to, explicitly say yours, and then, we'll either obviously, counter or, confirm or agree.
Absolutely.
So anything you have on that?
Yeah, the first, it's a question that demands greater definition. What's higher, right? What is higher inflation? What is the higher neutral rate supposed to be? these are things. It's like transitory. Yeah. Was the
Sure.
Fed right or wrong? I mean, what's the definition? What is the time frame definition of transitory? Because
Sure.
2 years later, we're looking at sub 3% on the core PCE. How wasn't it transitory? But there's no. So, are we in a higher inflation regime than we were the previous decade? So from post GFC to up to the COVID crash and whatnot. Yeah, I mean, that's just what the data says. Will we be for the foreseeable future remains to be seen. You could easily make the argument, given deficit levels and just the lack of, there's very little appetite for recessions. So I would be of the opinion that North Star, or the Fed's North Star, their neutral rate, lends itself to a higher level. And that's not to say the Fed's neutral rate, which was widely believed to be 2% in the prior decade, was a real number. But they weren't able to hit that number back then either, with fiscal deficits ever growing. So is there really a true correlation between the fiscal deficit and inflation? We couldn't get to 2% to save our life from GFC up to, through 2019. Couldn't get there. Now, we did in 2018 for 3 months. That's it. 3 months and more than a decade. So, I hesitate to prognosticate about, whether or not we're in a higher inflation regime or will be in the future. But I think it's safe to say the path seems to be leading in that direction, but it's not harmful. I think that's the most important aspect. Is it harmful inflation? As long as wages are growing faster than inflation, then it should not be harmful.
Sure. Yeah. Look, we tend to agree with, the idea that, time and place also matters in terms of how you articulate your views on things. And, we may be, this may be the new normal to some people, but the question is this the new normal for now? And then it normalizes back to,
right,
longer secular trends. When we think about it, you go back to the 80s to today, and you have, a massive secular decline in rates, of which an economy has been built on that rate structure, of which, your mortgage, your car, things like that have all been built and financed on a lower rate environment, which makes it much more difficult to push things higher in terms of your cost embedded inside of a household or a corporation. And that'll lead, higher rates will eventually lead to slower growth, will then eventually lead to lower rates. And so it's kind of this yin and yang. And, the question is, can you start some would call it a bear market for bonds and rates? Can you actually get into that? And it would have to be some sort of, inflationary consistency. And is it going to be energy? And, you have, the new administration saying, drill, baby, drill, which in theory is net negative for energy producers, but positive for energy consumers. Again, it's an open question. And by no stretch do I think we have it all figured out, nor do we have to have it figured out, between now and thinking about 10 years from now. And companies that can outgrow inflation, I think, matter more than, trying to figure out, some of these more nuanced questions that really have no true answers, and they're more guesstimates than
speculative
than anything. So anyways, we'll then spin back to then the companies or areas, sectors, sub-industries, whatever, is piquing your interest, at the tail end of 24 and 25. I'm sure maybe some of it starts with an A and ends with an I, but we'll see where you're thinking.
The industries that I favor, I should say, going forward, because today they may not be likable, but the path forward, given recent trends, are why I favor them. I favored and liked and invested in healthcare for a goodly portion of the last year. And I see the path forward for healthcare from a quantitative and a fundamental perspective, performing well, or at least better, in 2025. And one of the main reasons quantitatively is healthcare has never had this kind of underperformance for 3 consecutive years relative to the S&P 500, let alone the NASDAQ, which has a lot of biotech stuff, or small caps that have a lot of biotech stuff. So just from that quantitative perspective, I say to myself, what are the odds? Well, the odds, if it's never happened before, I probably want to lean in favor of outperformance in that arena, in that industry for 2025. I've always favored large cap growth from a discipline standpoint, from again, an outperformance or at the very least market performance standpoint with my portfolio, because that is what has worked. I think what I find is a lot of investors are trying to be stock pickers, and don't get me wrong. If somebody has that kind of acumen and has the kind of time, because you do need to dedicate time. If the majority of one's portfolio is going to be made up of stocks rather than ETFs, you need a certain amount of hours every quarter dedicated to understanding the fundamentals of the companies, looking at corporate transcripts, listening to the corporate transcripts, so you can gauge the tenor of the executive team. It sounds like BS, then your gut instinct is probably right. But if they sound confident, you'll know. So doing all of that work, I try to strip a lot of that out, and I don't do a lot of stock picking, but certain of the stocks that I have invested and continue to hold as long-term holdings include the NVIDIAs of the world, the Amazons. And I go back to 2022, where everybody was, bear market, and it's going to go even lower, and they're sitting on their hands, and they have the investor rigor mortis, if you will. And I said, well, it's not the end of the world. We have a bear market. These particular stocks, these Magnificent Seven, they have high beta. They're going to get hit the hardest. They're a source of capital for many institutions that are looking to raise cash. These are the heaviest price stocks. They're going to get hit the hardest. And that's where I was buying a lot of these names, the Meta platforms, the Amazons, and I've been holding on to them throughout the entirety of this bull market that started in October of 2023. Another industry that I do like is semiconductors. Again, just thinking long term. And while they've been way underperforming for the last several months, again, discipline trumps all. For me, as an active portfolio manager, I use these periods where you see underperformance in these types of tech-heavy or forward-looking companies as opportunity. And then, last but not least, tech in general. Tech has underperformed the S&P 500 this year. And when you say that publicly, you don't know what you're talking about. Look at the magnetic. Like, no, tech is Apple, Avago, it's formerly Broadcom, it's NVIDIA, it's Microsoft, which has gone nowhere. That's tech. It's not Amazon, which is discretionary. It's not Tesla, which is discretionary. And when historically, and thinking quantitatively again, when tech has underperformed by one standard deviation or greater, underperformed the S&P 500, 75% of the time, it has outperformed over the forward 12-month period. So, the history says that barring a recession, barring bear market conditions, tech is set up quantitatively to outperform once again in 2025.
Got it. Yeah. A lot of little things what we can dig into here. We only have 3-4 minutes left before we have to get to the next session. But I'll give you the elevator, or allow you to give me the elevator pitch. So there's always this question around specifically NVIDIA and the semiconductors around where is the cliff for AI compute demand. Also what you mentioned before, I think it's also important. I just wanted to make sure I highlighted this, was a lot of investors get a little bit confused about or categorize things somewhat improperly. I always use the example of Zillow. Yes, it's a tech-enabled business, but at the end of the day, it's really tied to real estate transactions and the health of the real estate economy. And yes, they're doing things on the edges to, obviously dig into mortgages, and that's, driving growth, and or a rental business, which is a little bit more less cyclical to some degree. And then they obviously have the purchases from premier agents. But your notion on someone like Tesla, which it's a tech-enabled, obviously, car company, but it is still a discretionary purchase.
Right.
I just wanted to make sure I highlighted that because I thought that was an important point in your comments.
Yeah.
But the cliff for demand for this stuff, I think that's the biggest fear for people that are still on the sidelines.
Right.
And even for someone like us, where we've seen the explosive growth. NVIDIA reported recently, and they had 117% or so revenue growth in their data center business on 75% gross margins. All that is beautiful. some of the best things you could imagine in
High
corporate
comps,
history.
high comps.
And eventually you're going to run into high comps plus potentially not factoring in some of this push or pull forward of demand. That's still in question. No one really knows, because there could be an aha moment on the consumer enterprise business that ultimately start to unlock even more demand. And I guess the thought is, if you go in history, we've seen companies where they've created change, Netflix of the world, Amazon's, Meta's, everything. They've all had these 60, 70, 80% drawdowns, even in, when it was very obvious that this business was taking over the world. And the question is, can you wait for that moment again? Do you think that moment will ever happen again? Obviously that's a loaded question, and, the answer is probably yeah, then no. But anyways, just trying to get, pick your brain on your views on, how you can, somebody that's looking at NVIDIA now, that maybe hasn't made an investment or has a small investment, but sees these massive growth profile that's taking place, and also sees the vision of AI. What does someone like that do, and how do they think?
I would say, if somebody has a small position, you ride it, you make plans,
and not recommendations for purchases, guys. Obviously, that's fully disclosed at the beginning of this stuff, but just wanted to make sure. We're talking single positions now, so anyways, keep going.
So, I'll just use myself. I don't have a big position in NVIDIA by any measure. And I have designated levels for which I'm looking to trim. You're right about considering where's the cliff, right? It has incredibly high comps. It's making ever high comps in 2024. We already see the notions of future deceleration based on the company's guidance. Right, their raised guidance is less and less with each passing quarter. So either the analysts are catching up with NVIDIA, or the laws of large numbers are catching up with NVIDIA. So can you prepare for that 60, 70% drawdown, which I fully anticipate? Like I expect it. As I've often said before, when stocks go parabolic, and I use a 12-month benchmark, if a stock goes parabolic in 12 months, the history of markets, there's no stock in history that has ever survived that without at least a 50% haircut. That's, again, just quantitatively speaking. So that's why I say I anticipate something like that. Now, is that going to be the end of NVIDIA? Will all of its best days be behind it? The media will tell you that, social and or financial, they will tell you that. But that's the benefit of what you're doing here today and in these questions, Sean, is because knowing that this is supposed to happen alleviates the concerns of, are the NVIDIA's best days behind it? This is a new era. We've gone from just email, at the turn of the century, we've gone from email to basically all different verticals of, mobile connectivity, mobile search, mobile internet. And this is a new vertical. And this one will have the legs that, past verticals have had, software as a service. This is a bolt-on to software as a service in many respects. So it should have a long history of, development going forward. And maybe that is what finds software in favor next year, more so than the picks and shovels this year, i.e. NVIDIA and semiconductors, fab chip manufacturers, et cetera. But make no mistake about it. There's going to be a pivot point. I prefer to call it than a cliff. It's just obvious. And investors are going to, be in a reckoning moment, which is why it's not a bad thing if you only have a small position right now. Just think about your personal risk appetite. Think about the inevitability. Think about history. No stock has ever done this without having to compete with the laws of large numbers. And ultimately, the market is not going to deliver the same price to earnings multiple or price to sales multiple if you're decelerating. It's just not the way it works. Multiples expand when you're accelerating. Multiples contract when you are decelerating. And that's where NVIDIA should be, unless it's a unicorn, like Tesla, kind of a unicorn, they happen. But if that, if it's not a unicorn, then it should be decelerating probably by the Q3, Q4 period next year.
Love it. Just to throw a stat out there, the average drawdown for Amazon throughout its history is roughly like 30% annually, with several 90% drawdown. So it comes with the territory. People question things oftentimes, but obviously, if this is truly something that is a secular multi-decade winner, it comes with those type of nuances.
Yeah.
Before we run, our next session is, with Autopilot, the venture firm with Will Summerlin and Max Friedrich, the old ARK Invest team on the venture side, and, Fintech. So we'll move to that and shortly here. But, before we run, I think one, that's a good compliment with the ending of this conversation. But two, where can people find more about what you're doing at Finom Group or personally in, your investment world?
Yeah, our online website is finomgroup.com. That's spelled FINOM group.com. Again, weekly macro market research, all the quantitative data that you could want at your fingertips and throughout the course of the year. You can find me also on X at Seth CL. And I post all day, every day. My portfolio, I run a multi-million-dollar portfolio called the Golden Capital Portfolio. And a lot of times I share what I have going on with the Golden Capital Portfolio also on X, as well as what I'm doing in the real estate markets.
Awesome. Seth Golden, we'll have you back again in an individual one,
Sean.
but thanks for joining Avory Idea Day.
Appreciate it. Thank you, sir.
Lovely. Let's bring on the next guest, Ian Carr, a fintech specialist and founder of Arcana.
All right, on to the next session. We're here with Ian Carr from Arcana. What's up, man? How you doing? It's been a little bit since we've, spoke last, and happy to have you here on Avory Idea Day 2024.
Thanks so much for having me. Yeah, it's been a while. Great to be here.
Yeah, so as you know, in our prior sessions, we've been talking about AI, we've been talking about fintech to some degree, retail, many other things happening. Our goal, again, especially with this session, is really to gauge, the state of fintech from your point of view. Your background, dives a lot into that. I used to subscribe to some of the stuff you were doing in the past at Fintech Today. And, in general, tell us a little bit about what you're doing today, a little bit about, the state of fintech as we move through this conversation.
Sounds good. Yeah, happy to get started.
Yeah, so tell us a little bit about your background.
Yeah, so I've been in fintech for about 10 years now. I started my career in mortgage-backed securities as an analyst on a restructuring hedge fund. And I'm sitting there and realizing that my job can, pretty much be automated. I was just sitting there looking through different mortgages and trying to repackage all of them. So I made a nice little proposal in a slide deck, went to my boss and was like, I have a great idea. I'm 20 years old. I think this is like really groundbreaking. And they're like, this is awesome. We are definitely not going to do this here. And I sort of realized then just how antiquated and culturally anti-tech, if that makes sense, a lot of traditional finance was. So that kind of got me into a 10-year rabbit hole around learning and building around digital financial services. So after that, I actually spent 2.5 years as a journalist at Newsweek and The Atlantic covering fintech, which gave me a really good understanding of the early days of the ecosystem, when Chime was getting started, when Acorns was getting started, things like that. Understanding the pain points that banks had around different underserved communities and why they were underserved. So things like small businesses back then were not really well banked, and you couldn't, Square came up because they couldn't even process payments, right? So things like that, I think, were pretty greenfield opportunities back then. So it was great to kind of be on the front lines as a reporter. I wanted to kind of get more in the weeds, so jumped over to the product management side. Was a PM at Acorns, building out financial literacy. Also worked on new products like debit cards and IRA products back then. Great experience. And then, shortly after, I realized that there was a lot of, this is around 2020 when, COVID hit and a lot of people were trying to get into fintech. And there wasn't really any good place to kind of go and learn about what the ecosystem was about and why the opportunity existed in the first place. So built a media company around that, kind of connecting founders, operators, investors in the fintech space together to sort of learn from each other. Called Fintech Today, built that for about 2.5 years and sold that. Alongside that, also started privately investing as an angel investor in companies like Mercury, Unit, and in crypto as well. So was getting pretty active on that side as well. And then more recently, been consulting for the last 12 months for banks around Gen AI strategy and working with different fintechs that are, building in that space. and have recently started a new company kind of focused on enabling Gen AI development and experimentation at banks, specifically regional banks and some of the larger companies that are don't have the bandwidth to build out massive AI teams yet. So that's kind of my whole spiel, and excited to kind of go through what I've been learning about in the space, and then overall like the state of fintech as well.
Nice. Yeah. A lot there, a lot of the names that you've worked at. I think people in attendance will appreciate, where you've been, the Acorns of the world, the Mercuries in terms of investments. So a lot of, I think, insight that can be learned today from someone like you. Where are you today located?
You
bounce around a little bit.
For the last couple of months. I've bounced around. I've lived in New York for a couple of years, and then I was in LA, but just made it to San Francisco. So excited to kind of learn about this place a little bit more too.
Nice, man. Good stuff. So state of fintech, obviously you have decade now of some exposure to this. And, I've been following the same space for quite some time as well. And there's been a lot of changes. At one point, as you mentioned, in 2020, there was kind of this mushroom cloud of, people looking at fintech and kind of hypothesizing that it would take over the traditional banking system to some degree. And we have seen, a pretty good migration to fintechs, whether it's, Chime or SoFi and Square has done a great job. Toast has done a great job in the point of sale business and then creating a, Toast Capital business. But for someone that is, investing and building within this space, I think, that's the importance of bringing you on. And just give us your high level, I guess, maybe state of fintech. You can curate however you want, but, the state of fintech from me and Akar.
Yeah, I mean, I think to start off, it's been kind of a rough year. I think F Prime is a great venture capital investor. They're the VC arm of Fidelity, and they have a fintech index that you can search up. But year to date, their fintech index is around 11.8% increase over the past over 2024. Well, like Nasdaq is like 30.6, the S&P is at 26.4. So I think it's interesting to kind of dive into what has been sort of the headwinds against fintech over the past year. I think it'll all be summed down to regulation. I think a lot of there's been a lot more scrutiny in how these new bank fintech partnerships are evolving and developing. I think over the past couple of years, a lot of people in the bank and the fintech side have been kind of playing it fast and loose with like trying to scale partnerships aggressively as possible without really understanding the consequences to the not just the bottom line from a monetary cost perspective, but more of the operational cost of like staffing, these programs that are now like all of a sudden like spinning up like couple tens of hundreds of card programs a month now, right? So I think it's really interesting to sort of understand the repercussions there. I think structurally it's been a big issue in a specific case around Synapse, which is a fintech company that sort of was one of the first banking as a service companies that was essentially this middleware between banks on one side and fintech developers on the other. The idea was to basically build this ecosystem of APIs on top of bank infrastructure that would enable fintech developers and like more broadly any tech developer to just easily add a card program or an investment program with a couple lines of code. That being said, the underlying bank partner Evolve, basically took this opportunity to like just aggressively expand their fintech partnerships. And I think when Synapse collapsed, a lot of their fintech partners had a lot of capital issues. Basically, the money disappeared and no one knows where it is. And there's a lot of reconciliation issues. Evolve is saying that Synapse has it. Synapse says Evolve has it. Then Sheila Blair, who is a former FDIC chairwoman, is a trustee of Synapse, and trustee of Synapse. So like it's getting escalated more and more, but still like this is like a significant amount of money that's like not vanished in the ether, but definitely hard to find out where it is. And I think kind of attests to the fact that like if you don't properly do things like record keeping, like there's a lot of repercussions and like there are actual consumer funds at stake here. So I think that has been by far the biggest issue in fintech. Like where is this at both the event itself of like what is happening here, and like a lot of fintech companies were relying on Synapse and they're kind of in the middle of a rock and a hard place. But then also more broadly, like how a regulator is going to step in, because I don't think it's avoidable at this point. I think there's two sort of options. One is regulate banks more harshly for their lack of process, and like basically just blame the bank, which makes a lot of sense, right? Because they're already a regulated entity, so they already have that infrastructure of like, assigning blame to financial institutions. That being said, I think there should be probably a lot more scrutiny on the fintech side of things to make sure they can keep their house in order. It's really hard for the bank to be the regulator here, if that makes sense, because like that's essentially what their regulators are kind of forcing the banks to do. So I wonder if someone else steps up, maybe the CFPB. I think after Trump getting elected, I think it's actually probably going to be more the opposite, where we'll probably see a little bit in less scrutiny in the fintech world. So I think a lot of fintech people are optimistic now in terms of like the regular scrutiny kind of easing up a little bit over the next couple of years. So while the sentiment over the last year was kind of all over the place, a little pessimistic, I think things are looking up now. So yeah, and I think obviously things like stable coins are obviously really important and big, and AI as well. I would say on the fintech side of things from the private market, there isn't that much interest. I think that's much more on the larger bank side and the more international companies. And can go into more detail about why, but I think to kind of put things succinctly, fintech is already very hypey. I don't know if they want to add another hype into that ecosystem. It's sort of, I think they are very much taking a wait and see approach. I think there's a lot of experimentation, but nothing really panning out in terms of adding real value. I think until you look at like, the bigger players like Klarna, where like, they're essentially apparently replacing a lot of their customer service staff with AI. So I think there are, anomaly cases, but largely it's still pretty early days for fintech and some of these newer technologies.
Yeah, I think at least what we're seeing is, some of the quote unquote incumbents, just given the fact that they're bigger in scale now, the Squares, the Klarnas, the Affirms now and buy now, pay later. Even PayPal is, seeing some, little bit of stability. When, you look back, a couple of years ago, it was the fintechs that were starting to, come at the edges and take users away, take some of the transaction volume away, both here in the US, but also globally. Would you characterize, I guess, from your just point of view, is that, some of the regulatory burden / some of the macro, call it, concerns has led to more strength at the quote unquote incumbents? They were once at a time, the innovators to the banks, but I think now they've carved out their own lane. So they're innovating, but also, the best resource capital wise and talent wise. Is that, would you agree with that, I guess, to some degree?
I would say to a degree for sure. I think a lot of these, like, I feel like it's probably fair to call them like tech-driven incumbents, maybe, or something like that, where but they've been around for a lot of years. Like China's been around for a decade now, right? So definitely, yeah, I know. So I think it's definitely they've been able to get really strong talent that is looking for stability. They've been able to use that scale to sort of renegotiate and improve their margins. I don't think that I think customer growth in general is just getting so competitive. I think the scaled players have a lot of advantages just in terms of brand awareness now. So I think that's been able to help as well. I do think from like a pure technology perspective, I think that there is a real lack of innovation, I think, from like both from the scaled side. I think the only one really doing anything that's really interesting is probably Robinhood, and just like how aggressively they ship product. I think most of them are trying to figure out like, we have a really solid customer base. What else can we do with these folks other than how can we sort of rethink the ecosystem and sort of reinvent financial services? I think they're much more trying to figure out how to just build a stable business, especially as they think about going public and stuff like that. So I think there's a newer opportunity on the earlier side to sort of use these new technologies like Gen AI, like crypto and stable coins to supplant some of these incumbents. Has it happened yet? Not really, but I think I do think the next 18 to 24 months kind of opens up that opportunity, especially with things like, Trump coming in, things like 1033, which is a pretty big CFPB ruling that just got finalized. that is going to allow much more fluid access for consumer financial data to move around between banks and fintechs. And banks can't charge for it legally now. So it's actually much more, much more of a restricting rule that I think people expected, which is good for fintechs, bad for banks. So I do think the fintech competition is going to increase pretty dramatically over the next 24 months.
Yeah, and just to hone in on that real quick before we move to the next, is the ruling there is really around allowing the user, again, to one degree, to control their data that they had at one bank and allow that to seamlessly move to another bank. That's kind of like the overarching nature of like what they're trying to achieve here.
Yes, exactly. Yeah, and there are like countries like the UK have already had these policies in place. US is actually sort of not laggard, but like definitely in the middle of the pack. So it's about time we've definitely done this. But essentially, banks have been sort of like storing consumer financial data under the guise of security, but also like just as a moat to make sure no one else can get it. But at the end of the day, if the data is under my account, it's my data, right? So,
Sure.
The CFPB and other government regulators think that like that data should be owned by the people and allowed to be moved freely by people as well. Now that does cause a lot of like technical issues and security issues, which is what banks are very unhappy about. But I think this was sort of inevitable. I think it's just a matter now. I think it's a matter of like, how is that ecosystem going to play out around data aggregation? Is it going to be banks kind of build up their own APIs? Is it banks partner with companies like Plaid? There's also a bank-owned version of Plaid now called Akoya. Maybe they start, building better relationships through that business. So there's a lot of options there, but I think it's pretty important in terms of like the future of tech and finance that this data becomes unlocked and available for everyone.
Sure. Okay. Yeah. So, state of fintech, the generalized views of, some of the rulings that's taking place now, AI and Arcana. So obviously what I wanted to do today with you specifically was, speak with you, obviously, recently, we were talking about, some of the use cases within AI, within fintech, and that's ultimately what we're trying to, achieve in terms of understanding from someone's in the weeds. So tell us a little bit more about Arcana. And a little bit more about, beyond that, I guess, some use cases that you're seeing within AI and fintech, kind of commingled.
Yeah, honestly, the discovery on use cases has been like kind of finding a needle in a haystack. It's been very difficult to sort of find the exact points that Gen AI can have a really big impact. I think one clear area has been compliance. There's companies like Greenlight that are doing AI compliance operations that augment the human's ability to do a lot of research. So when you're doing like a KYC case, know your customer, where you're investigating a new user, there's a lot of research that needs to go in if it's like a potential fraud situation. So they look up a lot of information about you, where you lived, a lot of PII, right? And that research typically can take a couple minutes, but also like for more complex cases, a couple hours. So Gen AI can really seamlessly and fluidly solve that problem and just create a report, within a couple minutes. And I think that has been an unlock in terms of reducing backlog, making the employees' lives a lot easier, allowing humans to focus on the top 20% of the tasks rather than like the bottom 80% of drudge work, which is like often a lot of what compliance ends up becoming. So I think compliance is a great example of a space where there's a lot of manual work, a lot of drudgery, and a lot of like unhappiness with the employee and the areas that they're willing to offload. Now, the reason I started this company is because I think the fact is a lot of banks are sort of unhappy with the level of products from their traditional vendors. And I won't name any names, but I think most of them are public companies, and have been experimenting with AI like around the edges is what a bank executive told me. It's much more around, can we like do document gathering and things like that. No one is actually really trying to say, can we use a voice assistant to start answering customer service calls for us and like transcribing that, recording that, summarizing, and then feeding that information back into like the product team, things like that. Something really transformative. I think these sort of point solutions are going to be really impactful over the next 12 to 24 months. I think these organizational level changes, though, are still pretty far away, probably like 48 months plus. I think that we're definitely a couple years away from seeing real big changes. This is not just in banking either, like across the board. That being said, I do think there are things that we can do to speed it up. For instance, unlock innovation inside of banks. Right now, banks can't even experiment around different AI models that are coming out, different frameworks that are getting released, different apps that are coming out that improve the productivity. So our goal at Arcana is really to unlock that new ecosystem of AI products and services and infrastructure for bank teams, both on the developer side, but also across other departments like marketing and compliance.
Got it. Okay, cool. How are you guys like what kind of call it tools, models are you using? Are you using more traditional like ML machine learning, or are you using some of the more newer kind of generative AI stuff that's popped up here in the last couple of years? Like obviously those are two distinct things. One's more like semi-logic based, and then the other one is clearly some sort of neural network that is spinning. And with the models that exist today, and so that's kind of like the dual question, which is are you using the combination of maybe more traditional, I guess, things we've seen in the past, plus the outbreak of Gen AI, and then the second question is really around the models that call it a fintech or someone trying to sell into traditional banking system are allowed to use or are using.
I think that's a great question. I think that so far most companies have tried to basically use existing structures like decision trees, some of the other stuff you mentioned. I forgot what you mentioned, but mainly like not the neural networks, but machine learning and some of the more basic things to solve things like fraud and real-time detection there. But I think with Gen AI and some of the LLM stuff, first of all, a lot of the more basic AI functionality is already baked in at banks. Like banks are already using fraud for like machine learning and stuff like that for real-time fraud detection, for instance, right? So I do think if you're a startup, you sort of need to be thinking about the Gen AI and LLM areas first, rather than like sort of thinking about how to augment existing systems. But then I think you sort of realize after kind of getting into the space a bit more, that a lot of these workflows are fundamentally just going to change, right? When you have agents that can kind of interact with each other. Like I built this thing. It's actually getting a lot easier to build stuff too. So I built this thing that's like basically searching information for me and creating like a custom newsletter for me every morning, right? But the task is just find all pertinent information and create a newsletter, right? When you can go into banking and say, let's say, figure out the top 20% of people that are going to churn and create an engagement campaign to attract, to get them more excited about our product. The AI agents can essentially systematically figure out the strategy and like then go and execute it as well. So you're really acting as a manager and have these basically a team of employees kind of working under you. And then, they're reporting to you all the changes and developments, and you're sort of setting strategy while you sort of wait for this AI multi-agent ecosystem to sort of execute a task. So I think a lot of what we expect with like how things work right now is going to change fundamentally. And I think that is like the big organizational change that I think we want to sort of figure out. So definitely trying to stay more focused on like what isn't being used on the technology side and how we can implement it, rather than like, kind of augmenting existing systems and improving, the way things are right now.
Sure. Obviously this isn't an AI, event per se, but AI is obviously, a threading through everything at this point. Talking to people in retail, understanding how retailers are, using AI to, enhance or not enhance, what they're doing. One question I have asked some so far is, do you think, some of the new AI stuff, specifically Gen AI, when we talk about agents, is, do you think personally, is this going to be, something that impedes job creation versus, be a, some sort of catalyst for, job growth, I guess, let's say.
So I think
what's your, the big question that I think everyone's been asking for the last 2 years. And I think we're in year roughly like 2 of this.
Yeah.
What's your overall like thought process on this? And again, none of this was like communicated with any of the guests, but I just wanted to get personal insights here.
So I was an econ major in college. My wife is a econ PhD as well. So I spent a lot of time thinking about this. It's really interesting. I think my perspective has shifted a lot. I initially came into this thinking, for sure, a lot of these manual rote jobs are going to be disrupted. Like, there's no buts about it. There's no way around it. You're just going to bite the bullet, and you sort of kind of see where the chips land, whether it's around like re-education or something more, kind of freeing up time for people to do other stuff more creatively. Now, after playing around with these agents, I think it's going to be. I think the jobs are going to fundamentally change, where humans are just going to be required to think really only creatively and strategically, and a lot of the execution is just going to be done by AI workforce. I think the best way to think about it, and this is what a mentor told me, and he's big in he's like a leader at a management consulting firm in the Gen AI space. He was like, the best way to think about this is that you have a really, really, really great coworker, and like you could have like an infinite amount of really great coworkers. So if you can sort of, that I think unlocks a lot of tasks that and projects that just sort of get under prioritized, like data migration from moving from the mainframe to the cloud was his example. So I think like you will see a lot of those sort of things. The thing is, they're not being done by people in the first place. They just weren't getting done at all. So it's not really job economic displacement. It's really you're just now sort of unlocking this value. So I don't think that we might actually see as much disruption as we may, as long as people can sort of shift from the execution phase to more like strategic thinking and creative thinking about what am I going to ask this like really cheap labor force to do for me today.
Right. I think the easy way to maybe even think about it is that everyone's going to be kind of a quasi product manager with a bunch of agents, that are kind of facilitating some of the work, and you're kind of redirecting as a quarterback, this and that. And, the ones that can creativity, easily put this all together, I think are going to be the bigger winners here. And stepping back as, a society, I think, possibly the average person wants that more so than being, the one filling out the spreadsheet. They want to be the one directing what's happening in the spreadsheet and getting the output as opposed to being all of the input. So yeah, I mean, like the last little section is really around Arcana or any other use cases that I think you have ran across, over the last year and a half. Anything you could share, with our listeners and viewers around AI, fintech more broadly before we head out.
Yeah, I think one of the more unique insights that I've made over the last couple of months is that everyone's really focused on the back office and no one's really thinking about customer-facing consumer products. And I think that is actually a huge unlock. For instance, one of the first projects we started was to build a GPT-4o chatbot that connects into Plaid to analyze people's consumer data if you give it permission. And the level of insight's pretty comparable to a financial analyst. The thing is, it's just no one has actually set that up. And I think it's something that I learned at Acorns, where 80% of people don't really have that complex financial situations. They just kind of need to be, get advice on what to do next. And I think AI can absolutely do that based on best practices. So I think there's a lot of interesting innovation to unlock on the consumer side. I know that folks at Intuit and things like that are thinking a lot about recommendation and personalization, but I wonder if you can take it a step further and just sort of automate a lot of, the personal financial drudgery of is this a business expense or a personal expense? And all the checkbook stuff that, after I'm married now, my wife is forcing me to do. So I think there's a lot of interesting stuff that I think, consumers can get from Gen AI in finance. And I think there's a really strong demand. There's 70% of Gen Zs have used chatbots and Gen AI for personal financial management. So the stats are kind of insane. Everyone I know that's, under 30 is using ChatGPT for some sort of budgeting purposes. So I think there's a really untapped demand that there's a good opportunity to build something for.
Awesome. Well, there it is. Founder, CEO of Arcana, Ian Carr, Fintech today, founder back in the day. Appreciate you coming on today. I think overall, it was a really good conversation around, some of the topics you discussed. I'll summarize real quick just for the state of the audience. Number one is you're seeing a lot of activity in the AI space, and as it relates to fintech, what could happen, not necessarily what's happening so far, focusing more on the new technology versus the old instead of iterating. You're trying to, you think the better strategy is really around developing net new. You just highlighted around the consumer, which sounded pretty interesting in terms of the stat you gave on Acorn. Lastly, the regulatory side, as we push forward, is likely going to be more of a catalyst than a headwind, as it was here in the past. And then, obviously I had my point of views on maybe, the state of fintech, the incumbents, or, maybe not the best word for, the blocks and PayPal's and some of the ones that are actually just large in scale, but also innovating, on the edges, are performing pretty well, just given the fact that regulatory burden has been a hindrance to maybe some of the others. With that, though, we got to jump to our next session. Where can anyone find you and learn more about what you're doing before we jump?
Just mainly on Twitter right now and LinkedIn. Just look up Ian Carr. And thanks for having me. Really, really appreciate you guys having me on here.
Let's bring on Lyte Aviation's founder, Freshta Farzam.
All right, here we are, our next session for Avory Idea Day 2024. We're talking eVTOLs, electric vehicle takeoff and landing. It's an interesting space for us, but we're lucky to have Freshta Farzam, the founder and CEO of Lyte Aviation. Interesting stuff having at Lyte Aviation, but I'll let you take the floor to talk about all the things you're doing. But welcome to Avory Idea Day.
Thank you, Sean. Thanks for having me. I really appreciate it. I'm Freshta Farzam. I'm based here in Hamburg. We are actually, my mission, I guess, the way I see it is now to disrupt the aviation industry next level. So, which means like from the 2-seater air taxis that we've known so far the last decade. Since last year, we came with our 40-seater eVTOL into the market. So that is giving us completely new opportunities with regards to use in business cases and technology. So that's where we are heading towards.
Yeah, we'll bring up one of your your models or the vision and or actual product of the vehicle you're referencing here shortly. But just talk about eVTOL more broadly. Let's just start at a very high level of why now? Like what problems do you think exist that you guys are trying to solve, or just the industry more broadly is trying to solve? And then we can highlight, pinpoint a little bit more about Lyte Aviation.
Sure. Well, I think about 4 or 5 years ago when we started to actually analyze the market and understand what's going on, because we understood that there is a huge hype around the eVTOLs and the air taxis and the drones. So the opportunities are there because I think worldwide the markets, whether it's passenger or cargo traffic, is increasing year by year, and the demand is there. So we need the traditional infrastructure that we're having is we have a high same day on demand pressure that traditional infrastructure is sort of a bit behind when we look at trucks on the roads, at the railways, the waterways. So that's where, of course, why now or 10 years ago, the cargo drones, the air taxis. So I think it's a good timing that they started doing that, disrupting the market. And the why now us, actually scaling it up 10x in capacity and range is because we think that so far the world has now adapted the infrastructure, the preparations for the infrastructure for air taxis, the whole business cases, the partnerships, the investments, when it comes to also looking toward that energy storage, like battery as an energy storage solution, and the AI, the autonomous air taxis that are out there. So I think the industry has progressed the last decade, and now we're just having the opportunity right now to actually use the experiences that and I guess the weaknesses and the strength that we've been observing and watching, and now we maneuvered basically the last 3-4 years towards exactly the sweet spot that the market is requiring, because we were hearing, of course, about the prices, air taxis are maybe just for the rich people. So how do we do it with the range? So that's when we were okay, the only solution for us as we see it is, which needs to be also feasible and certifiable, is the solution that we put together as a tandem tilt wing hybrid hydrogen propulsion system. So that's what we came up with, and throughout the last 4 years.
Before you keep going, what are we looking at here?
That's it. That's the baby. So that's that's the aircraft that we're working on. So it's, you can imagine, it's 20 meter in length, and around 19 meter in wingspan. So that is that we have two tilt wings. So we didn't choose the tilt rotors only. We chose to actually go with the whole tilt wing solution. In the middle part, you see 4 turboprops, and the wingtips, you see the electric engines, 4 of them, and they run on hydrogen, and the other ones, the turboprops, on SAF if it's available, or kerosene. So yeah.
Got it. So why hydrogen? We follow some of the publicly traded companies that are trying and vying for this space. The two that I know, Joby and Archer, they don't use a hydrogen from what I know. Just talk about maybe the differences and why. Maybe I don't know if you know exactly what they're doing. You're probably in your own lane doing what you're doing, which is what true entrepreneurs / innovators do. But in general, like, why hydrogen versus maybe some of the other alternatives?
Yeah, I like the question. We had to actually, in the beginning, do our market studies properly to see if we can go with batteries, if we can go with even ammonium, or if we should go with the other solution. But Joby and Archer, for example, or even the European ones, for example, they're all mainly focused on batteries. So if I want to go with a 40-seater, I can't. I mean, there's no way I can actually take off that weight of 4.5 ton, or I mean, totally 17 tons of an aircraft with battery technologies of today. So maybe tomorrow, definitely. So probably another 5 or 10 years. Hopefully, then our battery technology is going to be far enough that we can hopefully use that. But Joby actually, when I heard about their test ride with the hydrogen, I was very happy about that. So because that is actually proving our point. So we're going with hybrid hydrogen, because we cannot go fully hydrogen at this point. Going fully hydrogen, that would be impossible. Looking at the tank sizes that you have currently, etc., that would be also insane. Battery would also be completely going fully battery would be insane for the weight that we have. But the Joby, I was happy to see that they were actually doing the test flight with the hydrogen. So that's, I mean, there you have Zero Avia. They're also focusing on hydrogen aviation. We also have unfortunately some failures in the market, like Universal Hydrogen in the beginning of the year. But when we heard about that, of course, it's not good to hear. But we have those stories as well, the failures, but we also have the successes. So we're also seeing that eventually the chances for green hydrogen actually to become the next fuel source for in the aviation industry is quite high. So because my background was more in the green hydrogen upstream market, I just know that there's going to be some supply, and we just need to create the demand, the downstream market for it. So that's what I'm heading towards.
Got it. So you guys plan to manufacture this where exactly?
Well, for now it's in Germany, but we are in discussion with a few partners outside Germany or outside Europe as well, looking towards the APAC region as well, and the Middle East.
Got it. And talk about safety, because obviously I think from listening to some of your peer group, one of the things, obviously the status quo, right, is planes, cars, buses, helicopters. There's different pros and cons of each. One gets you there faster, one gets you there slower, one gets you there with a lot of noise, one doesn't, one gets higher, lower. In some ways, this whole space feels like it's somewhat displacing shorter commutes, which are like taxis, Ubers, buses, but also at the same time, more regional stuff, which would be, some of these private helicopters. Just talk about that concept of like of those different, players in this in transportation. I listened to one of your prior presentations, and you highlighted, your goal really is to work with and create more transportation, as opposed to, sucking out some of the demand for some of the other alternatives. But at the end of the day, I think what's going to happen, whatever's easiest, providing the most value, gets there the quickest, most convenient, is going to win the day if they can do it cost effectively. So just talk about, the different, players out there from a transportation type. which one's like the lowest hanging fruit that you guys can go after, and why, I guess?
Yeah, it's a brilliant question, because that is exactly the fun part of our business right now, because we were looking at different opportunities, and I have been actually opening up the gates, the doors for different use and business cases since last year, since we announced it. So it was interesting that we had requests from regional airlines actually to have a look into it, but to cargo. So I think the way we have analyzed it now, after a year collaborating on different projects, we are actually, I think the one that would actually make most sense at this point of time, it would be the cargo version. So if you actually take out the seats, the 40 seats, and you have a cargo, a sky truck. So which means in that case, we would be the largest drone worldwide with 4.5 ton cargo capacity. So that would be the logistics market that we hitting. And but if you keep the 40 seats, that's a sky bus. So that's where you're thinking about, okay, what do I do now? Actually, I have access to a completely different market. You can actually take off and land right at your doorstep with 40 passengers. So what does that mean? I don't need a runway anymore of a kilometer. So what does that mean for me? So that means even what does it mean for regional airlines? So
to do the airports.
Exactly. So, and now that's why we're collaborating with the airports, especially in Europe, to see which routes we can actually lay. So one of the routes that's very, very interesting to actually showcase what we're doing and where we're heading towards is Twente Airport in Netherlands. It's a small regional airport, but they have all the corporates and their 10-minute radius. And all these corporates, they need to usually drive 2 hours to Amsterdam International Airport, then take the commercial flights to Paris, let's say, and then from Paris International Airport, drive to the head office. So that means 6 to 8 hour travel time. So let's say we have the Sky Bus, and you drive 10 minutes to the small regional airport, hop on to our Sky Bus. Let's say it's a corporate bus, and you can actually fly anytime you want. It's your private corporate bus. Then in the future, you can actually fly straight to the business district, like let's say Paris and La Défense. You just land there with all your team members and the employees. You're just there. So, and that is the vision that we're having. This is the opportunity that we're having right now. So this enables us to actually have the collaboration and conversations right now with the airports, the existing infrastructure, the airports, but also with new vertiports to actually create new routes whether it's inside the cities or actually more in the remote areas, for example, in Africa, even in the US, for example, any region that is not well connected, because as we know, infrastructure on the ground is quite capital intensive. So that's where we come in. We can actually connect now points for mass transit, passenger mass transit, much faster. And then if we're looking towards the islands, if we connected the islands, that means, let's look at Bahamas, for example. 98% of Bahamas is not inhabited. So that means why? Why not? Because they don't have the space for a runway, and it's not really there was not really the solution. So when they heard about our Sky Bus, that's when they actually saw the connecting dots as well. That okay, if we actually take the Sky Bus, and let's say people are working in Nassau. And where currently everyone is living. So, but let's say we want to inhibit the other islands. So we would slowly have a shuttle that flies back and forth, let's say 10 times per day. People can work there, and then they can slowly live on the other uninhibited islands. Slowly, these islands become inhibited. And what are you doing? You're generating economy. So it's a bigger picture here that we're following and pursuing, basically.
Got it. The pilots, let's say, is it, do you view this to be, obviously, I'm assuming the goal is eventually all autonomous or remote controlled. Early days though, you envision obviously a pilot on there, driving these things, and therefore, one of the questions or the trade-offs. Obviously, you can fit more people or cargo in this, which is, I think, probably better than some of these small passenger ones that are one or two in terms of the cost per pilot relative to the value being created inside of the ticket prices, let's say. Just talk about that question that you guys are, looking to solve, human pilot versus autonomy, and then, what that does to your economic equation.
Yeah, we have, based on one of the projects that we have in Seattle, the Seattle pilot project that we started last year, we have actually estimated a seat price of $39. So
Wow.
compared to a ferry that you pay like $29 for the same route, plus you need to still take your car. Let's say it was from Bainbridge Island to Redmond, where the headquarters of Microsoft are. So that means for that route, I need 1.5 hours. But if you take our Skybus, you will only pay $39 to actually land right at the campus of Microsoft. So that, yes, is the manned version with the pilots. So imagine now in the future, yes, we are looking towards autonomous for the Skytrack version, for the cargo version, more in remote areas and in developing countries as well, in order to connect them faster. And that's where definitely it would make more sense, and it would be probably the cost would be even much lower.
Who would create the autonomy? Like, where's the autonomous come from? Obviously, we're seeing the battle take place in the car space today, and who's going to win autonomy? Whether it's Waymo from Alphabet or Tesla's, full self-driving, or Woot or Zook from Amazon. Like I guess in the airplane world or aviation world, specifically for kind of these quasi drones. I don't know if you're there yet, because obviously you're trying to get to the actual construction of these things versus who's driving these things. And first it's going to be a pilot, but then secondary, it's probably going to be autonomy. Is this going to be self-created and autonomy, self-created, self-funded, or is this going to be a partnership, joint venture, something like that?
Yeah, I mean, the strategy that I'm following is like really making sure that our aircrafts get out there. So if a partnership actually, if we outsource this and a partnership actually helps us to get there faster where we want to be, we're having those doors open as well. Because even with the parts for our aircraft, we're making sure that the main parts, which is the propulsion system, that's what we're focusing on. The rest we want to really like be as asset light as possible. So that goes also for AI and or the autonomous part of it. Yes.
Got it. Speaking of propulsion, safety, one of the things I like about this space, for me personally, I hate helicopters. There's obviously, I forget how many rotors are on yours specifically, but they come in all different shapes and sizes, some of these eVTOLs, and yours has a lot, it seems like. What does that do to safety?
Well, it actually we try to choose a number that is right at the edge, like there's not too much and not too little, also for certification reasons. So we have added not just looking towards the engines, but we have also added the wings, not just one wing, but also two wings, because of the safety reasons. So I think it's also looking from a passenger perspective. If you're actually creating something that, I couldn't go for passenger, the passenger version to Skybus. I cannot go with the autonomous one because I don't think anyone is going to step into a flying bus that is actually flying, like being or being guided like autonomously. So that's why we need, even from a psychological perspective, we need for the safety for the passengers, definitely the pilots, the human pilots for now. But that's why, but also for certification reasons. So that's the perspectives from which we're trying to like put the puzzle pieces together. And yeah.
Yeah. So you talked about some of the use cases, the Caribbean, those sounded, pretty interesting to say the least. Now you're very, very much like your starting point, you get this thing off the ground. What's that first, I guess, lowest hanging fruit that I think, you can go after? Is it, the Caribbean islands, or is there something, is it cargo in a certain region or a place? Just trying to understand where this is going to start.
Yeah, definitely. Cargo is easier certifiable, and cargo is much easier to actually test and
no humans, right? For the most part.
Exactly.
Or one, I guess.
Yeah. So for that reason, but also the market is there. So the logistics, like the cargo traffic, we have a huge demand there. So looking towards the cargo drones with a half ton to a 1 ton, they're thriving, which is amazing. So that's a good sign for us as well, or a proof for us that we're on the right track. But on the other hand, it's the regional airlines. So regional airlines understanding more and more today that, okay, eVTOLs are coming, air taxis are coming. What do we do with it? So either we actually ignore them and we're not playing, or we have to play, because another topic is sustainable aviation. So everyone is looking, I mean, the SAF congresses to hydrogen congresses, when I attend them, it's amazing to see like everyone is sort of like eager to know what's happening. What do I have to do as an airline? So now then there is also new aircrafts or like air taxis. What do I do? And people are trying to like put the puzzle pieces together, the airlines, and that's where we are actually introducing the Skybus to them, because that is where we see like a lot of their problems can actually maybe even not just be solved, but actually expand some routes where no one else can actually access. And that's where we see a lot of resonance there. And that's why we see them as low-hanging fruits, because they don't have to do much. They just have to basically be open for it, that this is the near future. It's not even like something that's coming in 20 years or 30 years. No, this is coming, it's happening. And just lay new routes with us and use your existing airport. Let's just lay a new route.
Yeah, last two questions. Obviously you have these publicly traded peers. They're doing different things, versus you, at least as of right now. But obviously they're incredibly well funded, at least at this stage. How does somebody like yourself and some of the others in the ecosystem compete against that? Is the path to a well-funded private to public, or is it just talk about your roadmap of ensuring or trying to ensure that you can in some cases outcompete cash, right? So there's the execution, that's one side, and then there's the cash to fund some of the initiatives everyone's trying to take on.
Right. Yeah, Sean, this is I think it was my own personal journey the last decade to understand what is it like really like where do I need to focus? Is it really just the funding, or is it what's the main quality that actually no one can disrupt once we build it? And that's I think it's a team. So we have team members that are with us from day one, when we didn't have any funding, until we got some private funding. So yes, the journey. We have, of course, a longer journey ahead of us. So, which means we will need funding along the journey on every step. So that's inevitable. And yeah, the journey is, yes, we're looking from private to public eventually, definitely. And so I think the core foundation is just really the team to build to have that, and that's what we're having right now, where. The journey is continuing, basically, even if the fundings and the next milestones like we need to hit, but they're still on board and continuing with the work. So I think that's very invaluable for us. And beside that, I mean, if you zoom out and if you look at the history of aviation, I think the billions and billions that have been invested so far throughout probably 50, 60, 70 years of normal commercial planes and helicopters, I think what we're investing right now into eVTOLs and air taxis, we're actually compressing it within a decade. A few billions have been invested, and we have actually accelerated technology and innovation in this sector tremendously. So that's why I know that there are like a lot of supporters of this journey to help us with this acceleration of innovation and sustainability in aviation.
Yeah, I mean, to some degree, just to echo your comments, which is, the fact that you do have, several publicly traded companies brings capital to the area, which brings excitement, which then brings capital, and then just more knowledge. And some of that capital gets to the next question, which is really around regulation, ensuring that you're properly regulated, that the regulators spend enough time to make sure you guys can get off the ground, literally. And, just talk about that. Archer and Joby, they're doing different things again, but I think they highlighted how, there's going to be some sort of approval, and there's anticipation of approval, at least for what they're doing, I think in 25 or late or mid 2026, that is. just talk about regulation, like maybe global. Obviously, there's the U.S., but then there's other regions as well that are, I think, what sounds like a little bit more lenient in terms of trying to drive innovation as opposed to compress it. But just talk about regulation and that'll be the last question of the session.
Okay, thank you, Sean. Yeah, regulation definitely is a big topic on our plate. So even when we started like having our designs, like in the first designs, we always had that in the back of our mind. So, but of course, even at this point where we're at right now, we're having advisors from, let's say, the EASA, the UKCA, from the FAA, to make sure that from all angles we are getting a bit of feedback. So we still it's an ongoing journey, and we don't know all the bits and pieces today, but we're roughly basically making sure that from a regulator's perspective, we're on the right track. So that's what we're having them basically consciously looking basically like watching us, what we're doing and how we're proceeding, so that way we make sure that we have a certifiable product. Yeah,
perfect. Yeah. So Freshta Farzam, founder CEO of Lyte Aviation, wanted to give you one moment to share with everybody, where to find more about you. Maybe you write in one place or have videos here or there, and can find more about Lyte Aviation or anything you're doing out there in the internet.
Sure. Well, we have our website, lyteaviation.com, but more updated information is also on LinkedIn on my page or Lyte Aviation's page. So yeah, we're
Cool.
somewhere all over the news as well with the press releases that we had. So even if you Google us, we're going to find us. Yeah.
Yeah. Cool. Well, appreciate you coming on, talking about, the whole eVTOL space and really curating some of the ideas and thoughts. Appreciate that. We're going to head to our next session here in a second. Appreciate you coming on for Avory Idea Day 2024.
Thank you so much, Sean. I appreciate it. Thank you.
Now coming to the stage, Saul Tarazona, the founder at eJet Aerospace.
All right, welcome back to Avory Idea Day. We're here with Saul Tarazona, the founder and CEO of eJet Aerospace. Another company within that eVTOL category to some degree. And, we're more than happy to have you here and talking about, what's happening in this category, this space, what's happening at your company. We're both here in Miami, which is pretty cool. So a lot of innovation taking place in Miami over the last several years. But first and foremost, thank you for coming on and how you doing today?
Fantastic. Thank you so much for the invitation.
Yeah. So talk about, let's just go high level, like introduce yourself, talk about eJet. What are you guys doing?
All right. So what we're doing is transforming the aviation ecosystem. So how we're doing this is we develop a new technology. Very specifically, this technology is the first cold jet propulsion in the world. What does it mean? It's an electric jet engine. So we don't use fuel, we don't use oil. This completely transformative, it's very innovative. We patented as a technology in 2013, and we got the award as the best technology ever filed from the entire continental America.
Got it. Yeah. So we'll show a clip here of your product.
Fantastic. Yeah, so the two things that we can do with this propulsion system is number one, we can retrofit on traditional jet aircraft, for example, a small business jet. What I need with retrofit is that we replace the jet engine that originally has and not convert that engine, but put ours replacing the engine that already has and making that aircraft 100% electric. So not many people can claim that can do this. So who we are to be able to say this? The inventor of this technology is an engineer, master in science, PhD physicist, and PhD in fluid dynamics physics. I am an aeronautical engineer, 18 years of experience. And what I have done most of my life is work in defense aircraft, implementing emerging technologies around defense equipment. So what I was telling you is one way. The other way is that we create our own aircraft. Although it might look like a helicopter, it is not a helicopter. And it is called an eVTOL, so electric vertical takeoff and landing aircraft. So it can vertically take off and land like a helicopter. featuring our cold jet propulsion, making that aircraft 100% electric and with a performance never seen in the history of aviation.
Got it. So you guys replace the existing, but also are creating net new aircrafts as well. Talk about the problem. Like why go down this route when, as a consumer or cargo, commercial, things work decently well. But what do you think is the great unlock here that you think this is solving?
You're absolutely right. So the safety in aviation is pretty high. We are aiming to have the safest aircraft in the world because our aircraft don't fall from the sky. They're always auto-rotate. The other aspect is the problem that we're solving is aviation is very expensive for good reasons. Manufacturing an aircraft is high cost. Actually, operating the aircraft is very costly. Certifying people to operate the aircraft is very costly, and the inspections and constant maintenance is a lot of money that goes into all those. Our aircraft completely changed that from the bottom up. Our cost to produce an aircraft is $250,000. Nobody can claim that. Our cost to operate 1 hour is $114. I'm paying $50 within that budget to a pilot. So my cost to operate 1 hour and carrying 500 kilograms or people or cargo is very, very low. How does translate into the normal people from the street that are driving their own car? And they're not able to be a pilot because they don't have $12,000 to become a private pilot license. That cost drops divided by 4 with our aircraft. So we can enable people to become a pilot with much less amount. We're going to be profitable, of course, with that as well. And if we want to sell the aircraft, we can sell at very high cost. But because of cost is very low, we can sell at a very high price. So problem number 1 is cost on aviation. The problem number 2, especially in defense, is that electric aircraft, so traditional drones that they use, are not stealth aircrafts. But with our propulsion system, we make those aircraft stealth. Produce very low noise, no heat signature, and which enables a few other things, which is very low weight, so you can carry more mission equipment. So that will be the problems that we solve.
Cool. So let me bring up a product diagram that you guys have nicely on your site. Here it is. Just walk us through what we're looking at from let's say just left to right.
That's right. So since the most important thing we have is the propulsion system, that is the cold jet propulsion system that I've told you, and this is the patent. We have a few channels to start. So in the upper arms, we have the civilian aviation route. Since we are a gyrocopter, and the gyrocopter's been in the market for more than 100 years, there's many that the FAA already certified for the last 30 years. We don't need to wait for new regulations to come out. So that would be one route, civil aviation with our own aircraft. The other route, the bottom part, is to retrofit on traditional aircraft, which opens in 2. One will be on civil aviation, for example, small business jets. And the other one is the drone that I was telling you. Once we replace on this drone, is a single engine drone. Drone means in this case it's not like the drones that people are accustomed to, which are remotely controlled like a toy. This is a proper mission equipment. So we can do that and make those aircraft stealth.
Got it. Okay, cool. So, obviously there's all the way on the right, you have different outlets of selling. How do you think, your go-to-market strategy will be much different if you're selling retrofit plus net new? Is that like, is that traditionally how, let's say, aviation works, or, can you be both?
We can be all of them. The thing is that, of course, we need to focus. We need to focus where the most of the money is. So we're looking into, depending who the investor is, they usually come with an added value, with a strategic intention as well, and a strategic value that they bring. So some of them will like mostly defense because we're talking with governments. For the civilian aviation, the people like Uber or all the apps that connect people with taxis, they will love to upgrade to air taxis. So, and the thing with when you compare our performance with the current market, with the current eVTOLs, is that our performance is 349 miles nonstop, while all the other eVTOLs in the market can do around 100 miles. Most of the other eVTOLs can do 35 minutes of flying time. We do 135 minutes. So, and faster because of the propulsion system. Everything goes back to why is the propulsion system.
Got it. Okay, yeah, you hear the same kind of concepts as it relates to space with like SpaceX, where propulsion is essentially, the core advantage that some of these companies have. Lowest hanging fruit. I think it's a question, that we think about here at Avory, which is there's a lot of companies gunning for this stuff now, going after the space. Now, I guess the bigger question is, I see tangible value, but what's the lowest hanging fruit? We've heard from others, things like cargo within the Caribbean islands, or consumers on the Caribbean islands. But from your point of view, what are some of the lowest hanging fruit that you think you can get started with rather quickly and provide incremental value immediately?
That's right. So actually, we should talk about one company that got bust, which is Lilium. They filed bankruptcy. The reason why they filed bankruptcy is because they weren't able to get certified, which is not a problem for us. So that's number one. For the second part, what is the low hanging fruit? For example, we can take, so you have it on your mind being here in Miami. I can take 3 people, paying, and my cost to carry those 3 people all the way from Miami to Tallahassee, which is the range of the aircraft. My cost to operate that route is $114 per hour. That's going to take us 1 hour, 135 minutes. So the cost is really low. I can charge these people 3 times that. I'm going to be very profitable. But if you have taken the trip from here to Orlando, you know that it's kind of boring 4 hours driving. So we can do that way faster, very close to your point of destination, because there's many helipads, traditional helipads. We don't need new infrastructure. With traditional helipads, we can land in traditional helipads. We can land in fields. We can land in unprepared runways, unprepared lands in farms or any kind of open air. So this is a possibility that with the other aircrafts are not, because every time they land, they need to charge the aircraft. We don't. We swap the batteries. The person is going to pull 4 batteries, which we're going to have a truck with the batteries already charged. The pilot will get out, replace 4 batteries in 3 minutes, and we go to the next range. So we don't have the limitations that others have.
Got it. Yeah. So in some ways you're extending cities, and instead of being cities, you can have in theory like regions. If this is cost effective for someone to go from here to Orlando for a day, they can do that pretty quickly and on a what sounds like a pretty value budget, to say the least. Obviously, there'll be amenities for certain things.
Of course, it's going to be luxurious.
Yeah, right. So I'm assuming, that'll be part of the stuff. But eventually, you can imagine, whatever, 15 years from now, where you actually have, the spirits of the world, also just getting you there as fast as you can. Mind you, Spirit just went bankrupt, so that's probably not a good analogy. But let's talk about, you said certification not a problem for you. Why is that? Why are you guys different?
So gyrocopters were invented in 1914 by the Spanish guy, Mr. de la Sierva. So we have so many, actually, it was the predecessor of helicopters. It's just helicopters took off faster than gyrocopters, but gyrocopters are safer. So with that, we have a pathway that is written by the FAA on how to certify our aircraft, because our aircrafts are not helicopters, they are gyrocopters. So the other aircrafts like Lilium and the other ones that call eVTOLs, they are multicopters. For multicopters, there's no regulation that you can follow to certify an aircraft. They recently just released something about how to certify pilots to become multicopter pilots. That's it.
What's the difference, just for the audience? What's a multicopter versus the other?
Yeah, so a multicopter is when you see a bunch of fans outside, that there's like usually 4 fans. Sometimes they put it on a line and they shift from pushing air downwards to forward so they can move forward, or pushing backwards if they want to move forward. Exactly. So that's a multicopter. It has more than one rotating device. We call it a propeller. It could be adducted, unducted, etc. But that's a multicopter. It has more than one copter. Like a helicopter has one.
Okay. And then the other, so yours is a single.
Yes, it's actually the what they call the rotor for us is a free wing. That's not where we create the lift for takeoff. The lift gets created on our own propulsion system. So that's another thing that how we make us different. For the first time in the history of aviation, from the jet engine, we do 2 things. Of course, propel the aircraft forward, and the other one is propel the aircraft upwards. Nobody in the world has done something like this.
Got it. And then you have a single rotor at the top. That's now. Let me ask about then safety, right? Because I've heard a lot in the space where having a multi-copter is actually safer because you don't have a single point of failure. How does that? How's that? I guess a negative to the single copter viewpoint here.
Yeah, so on gyrocopters, the rotor is a free wing. What do I mean with a free wing? There's no connection whatsoever between the propulsion system and the free and that wing or rotor. Yeah, so you can take it with your hand and flip it both ways. Okay, there's no gear, there's nothing, there's no reduction gear, there's nothing, no mechanisms at all. So what I call it is a safety feature. The safety feature is because it's a little bit tilted up backwards. So when the aircraft moves, it will always rotate. So let's say the engine turns off or the battery is drained and everything turns off. This free wing will continue rotating as long as we have a little bit of forward speed, and that will keep us gliding. This is a very light aircraft. It's 1,200 kilograms only. So it's not so difficult to keep it on the air for a very long, slow, safe landing.
Yeah. Okay. So there's money that has come into this category, a lot of interest. You have publicly traded companies like Joby or Archer. Speak about how does somebody like eJet compete in a world of where you already have these 2 players. Obviously, these 2 players create buzz and excitement around the space because they can explicitly highlight where they are, whether it's speaking to the FAA or the different certifications you have to get. So they help in that way, but at the same time, they are well funded. So, somebody that is trying to compete against those, and again, they're all doing different things. Some are going farther, some are going, shorter, some are trying to be inside the city, some are trying to be outside the city. So everyone can kind of capture their own, opportunity. But, how do you think about that? Like, some of these bigger players out there that are publicly traded and funded well.
Definitely, we respect them a lot. We would love to partner with them. But again, they don't have what we have. They have what is an electric motor with an attached propeller, which is a fixed pitch propeller. That means the blades don't change angle. So that has been done many years ago. There's not much innovation in there. The innovation part is on the batteries. What kind of batteries? Where do you arrange the batteries? How do you do the transition between vertical to horizontal flight? And honestly, we do not compete on performance. As I was telling you, we do 4 times to 5 times whatever they can do with their aircrafts. So we definitely not compete on performance. Of course, we're small, we're a startup, we're 0 revenue, 0 sales. And what will enable us to get into the profitable part and getting revenue, which we don't have, is to be able to build a full-size aircraft or just even a full-size propulsion system where a third party can come measure how much jet propulsion we have from an electric jet engine, which is ours. And with that, we have the world. Honestly, the applications are as many as the imagination can take at this point in time.
Yeah. So I guess where are you in that process, that journey?
We are fundraising. We're finished. Yeah. So we need $5 million to produce the full-size propulsion system and another $5 million to produce the full-size eVTOL. So that's the fundraising that we started a few months back. We are today in November, end of November. So we're looking to close that at the end of this year to start in January.
Got it. Cool. And then the space more broadly, there's talks specifically from the Joeys and Archer that you may start seeing some of this stuff be approved for commercial flights by 2025, whether I think it's late 2025 or early 26. What's your views on that? And like, when do you think we get to more mass adoption?
So I need to go a little bit more international to answer this question. EASA, which is the European Civil Aviation Authority, is a little bit faster than FAA at this point in time. They're providing experimental licenses. They're allowing to fly from point A to B. They're creating routes. They're faster. So that's the two biggest one. US is the biggest one with FAA. The second would be EASA. But there's other strategies that do not involve Europe, do not involve US. For example, Africa and India is a huge market. They do not have runways. They do not have infrastructure or airports or buses or trains. So this is a perfect solution for these kind of countries. And they're very willing to help. Australia is a great example. Canada is fantastic. They're giving 75% money back guaranteed for any project or any technology that needs to develop something. So they will return 75% money back guaranteed on the expenditure in research and development. So as you see, they see the need, they support a startup, they support technologies, especially in electric transportation. And the other part of the world will support it from a whole different reason, which is the amount of carbon that we save for not flying traditional aircraft. So Finland, Sweden, all the Northern European countries are very supportive with this.
Got it. So there's actual needs from some of the the more rural countries, but then there's also some of the call it eco-friendly pull that some of these other countries are focused on with like green energy and such. That makes a lot of sense. Before we go, I think we'll wrap up here and head to our next session. But in general, I wanted to give you a moment to have the floor to share where people can find more about eJet or yourself and what you guys are doing.
Fantastic. So our website is www.eget.tech, T-E-C-H. So eget.tech. I'm all over social media. eJet is all over social media. eJet Aerospace. We have a company in Delaware. That's our soul. That's we're gonna have everything. We're looking for investors. We're looking for strategic partners, people that operate aircrafts, cargo, people, trainers, anybody that wants to get into aviation. I couldn't do it before. We could be the pathway to get into aviation. Another thing, we're into the sustainability goals. We are a sustainable company. We're hitting more than 11 of all the sustainability goals, creating jobs, helping the world to be a better place. And we're looking any support. There's many people supporting us all over the world. So thank you so much for this opportunity. We're very proud and humble and grateful for this opportunity.
Yeah. No, congratulations. It obviously sounds really interesting. The space is, I think, here and now. So this is the time. Saul Tarazona, the founder and CEO of eJet Aerospace. Thanks for joining us today on Avory Idea Day 2024.
Please welcome Stephen Kaplan, the ROI guy and head of channel at Tessell.
Here live with Stephen Kaplan, the head of channel at Tessell. Welcome to Avory Idea Day 2024. We're so happy to have you here today.
Thanks, Sean. Great to be here.
Yeah, so we've spoken in the past, going back to the days of the Nutanixes of the world, and obviously now at Tessell, and you've had great success in your business life, both making investments personally, venture investments in things around AI or things around technology more broadly. You also have a couple of books. I'll let you share some of the books that you've done. You have your cartoon in the background, which is pretty cool. We were just kind of laughing about that. But in general, welcome to Avory Idea Day. Just for the audience sake, some that don't necessarily know you specifically, you're the ROI guy, as some will, call you, just talk about your background and we'll go from there and talk about the state of data management, AI, and tech more broadly.
Sure. I've always been focused on business and got my undergraduate degree in business at Berkeley and MBA from Northwestern. So then I, over the years, I kind of slowly moved into the technology field. In fact, when I started in technology, it was called MIS, and then later transitioned to IT, and ended up starting a PC clone business, and that morphed into Novell Networking, the first Citrix Partner of the Year, and sold that, and then ended up thought I was done with the channel partner business, but a friend showed me VMware and said, we got to do this, and started VMware business, became VMware Partner of the Year, sold that 3 years later, then joined a tiny little startup called Nutanix, and rode that through the IPO, and that was great. And then was advising half a dozen startups, and one of those startups was a little company called Tessell, and I got really, my whole background is ROI, TCO, and doing analyses for customers, and so they can help make the best strategic IT decision. And I got really excited about the amounts of money Tessell's able to save, small and large organizations from moving their databases to the cloud. So I went back to work full time, and now Tessell.
In general, let's talk about, the current state of tech. That's a broad question, but I think, understanding your background, both on the partner side, where you get to see, what's happening more broadly, what are customers asking for, what do they need, what are the pain points. You just spent some time at, Microsoft Ignite, which is a big conference out in the tech world. The state of technology from your point of view, like what is, AI is obviously the word of the year, let's say, and really the word of the last 2 years, generative AI explicitly. But you think of technology today, or, where are we? What is, are we at that inflection point where something like generative AI is transformative? We're continuing debate here at Avory, is it evolutionary versus, revolutionary? Your point of view and kind of what you're hearing from the field.
Yeah, I think that AI is definitely transformative, Gen AI. Dheeraj Pandey, the founder of DevRev, says that AI is going to become like oxygen, and really it's just going to be inherent in everything we do. But that doesn't mean that you still need the team and the execution and the agility and all the factors that go into making it successful. And I try and Benny Gill, who's the founder and CEO of a company called Cognitus, they're kind of displacing the RPG space. He likes to look at data as the gold, and I think he's got a really good approach there. And that's what I always look for, to see who's going to make it. Because if AI becomes like oxygen, then who is going to be the survivors? And so I like the companies that are able to build up a moat of data generated by AI. And a great example of that is, well, DevRev themselves do that really well with what they do. But another company that I invested in as a seed investor is called Horizon 3.ai. And so they automated the whole red teaming type testing, where organizations used to have to go out and pay hundreds of thousands of dollars to bring this team of experts, once a year, twice a year, who then try and penetrate their systems and look for vulnerabilities, and then they fix those vulnerabilities and do it all again next 6 months or next year. So what Horizon 3.ai did is it came up with this automated pen testing that just sits and on the network and looks for vulnerabilities in every possible aspect, and it learns as it goes along, and it gets better and correct, and helps people correct them. And so you end up with this virtuous flywheel type thing where the more it learns, the better it gets. And then, of course, the more customers they have, the more data they collect, bigger repository, they're able to get better and better still. And because of that, then more people want to use it, and they want to use it more often. And so more data comes in. And so they end up with this massive moat of proprietary data that's very difficult for somebody else to penetrate. And you see that in all kinds of fields happening. And so I like those companies that are going to build up those data moats.
Got it. So there's obviously the companies that are creating the data or have the customer base, whether it's enterprise or consumers, that are creating data. So think of like someone like Zillow, obviously, that has boatloads of imagery / computer or consumer search queries that are happening on there and filter queries. That's a level of data. But then the question more broadly is where do you want to be in the stack? Do you want to be, the data management layer where, you don't have to have the data per se. It doesn't have to be your data, but you're essentially allowing, a company like Zillow use their data to whatever method or whatever use case they want. Or do you want to have someone like Zillow where you actually own the data explicitly on your platform? And which one has kind of that more, I guess, longer term moat attached to it? Is it the actual underlying data or the data management? You come from this side of data management to some degree. So, both can win. Many will win. We recently heard from Snowflake, and, there's obviously Databricks out there and some others that, are sitting in between both the, the enterprise and whatever data is getting spit to the enterprise. It's an open-ended question, but it's really the idea of, where do you think the most value accrues to? Is it the data management layer, or is it somewhere, the actual, input of where the data is coming from?
I think it can. I think the data management is the clear example. It's just probably, if it's your own data, then nobody else can tap into that. But Zillow is a great example. I mean, if you look at the future potential, I was recently looking at buying a vacation home, a vacation rental in Costa Rica. And they don't have an MLS there. So, to try and find places, you have to know where to look and what type of price range you're going to go for, and does it have a view or not, and what size is it, and is it gated, what's the security like? It's all these factors, and there's no easy way to do the search today, especially without MLS. And I know Zillow's not in Costa Rica, but something like Zillow, what an opportunity to ask the user the questions. Hey, what are you looking for? What are you looking? All those questions I just named. And how new is it? How old? What's your budget? All those kinds of things. And okay, I'm going to find you a list of 75 properties that meet your criteria. And that way you don't necessarily need traditional real estate agents. They could certainly still play a role, but what an opportunity for AI companies to come in and do this type of disruption in the real estate space, title, insurance, just so many aspects of it. And that's just one small industry. Healthcare, oh my gosh. I'm speaking to a specialist right now in healthcare, and I know I'm driving him absolutely crazy because we go back and forth in the portal, but I use AI. I use multiple AI programs to analyze things. I want to make sure I'm getting the right treatment, and I really respect the guy. He's great, but he doesn't know everything in the world like AI does. And of course, AI makes all kinds of mistakes and hallucinations. So, it's a back and forth thing. But I know I drive the guy crazy diving into these things at kind of a technical level that, typically a non-surgeon would not be able to even have the faintest grasp, at least have a tiny little bit of a grasp. And at least I can verify or validate what he's saying against multiple AI tools. And same thing with legal. I was in a lawsuit, same thing. Using AI to check everything that the lawyers say.
Yeah, no, definitely using some of those use cases, throwing an X-ray inside of one of these AI models and seeing what it spits out, and then just showing it to somebody to see if does this even make sense, because I don't actually know the output, or the input. But going back to the question around data management, let's say it's a big field now. It's becoming more and more important. You have the public players like a Snowflake. You have the private players like Databricks that's going to go public. Obviously, you have you guys and some other platforms out there that are basically putting themselves out as data management layers. More so from less so on your company specific, but more so the more broad viewpoint of the data management companies. What is the state of that? If you go back years ago, you had the legacy players that were doing traditional ETL and getting the data into where they need to be, and then you could start to analyze those. It sounds like you guys are doing a lot of stuff in the cloud, which is a different ball game relative to, let's say, a decade ago. But just trying to understand, in the world of generative AI, what are you seeing in the kind of that data management layer that is kind of creating more of an unlock for these type of use cases that we've just talked about?
What was that last word you said? It's creating more of a what?
Use cases.
Okay. Well, cybersecurity is sure one massive area. There's a company, Lightbeam.ai, that I'm also was an advisor to, and an early investor. And they use, rather than using like pattern recognition, which is what cybersecurity companies used to use, which can give you lots of variable results and not very accurate and expensive and clumsy. They use AI, for example, to recognize that a 9-digit number is a social security number, and they can match that then to a license, a driver's license that's scanned in, and they can match it to the address and so on. So they can find sensitive information wherever it happens to lie in the internet or in the cloud. And so it really it changes the game in terms of management of finding this sensitive information. So and again, you see that across all kinds of areas, healthcare, in DevRev's, well, in Tessell's case, we're doing similar type things. We use, and you see this again with lots of data management companies, where we use the AI to do all the types of analytics and understanding your own data, and you're able to make best predictions about the future of that data, and then how to optimize it and so on. But then taking it a step further, for example, we're coming out with our own AI program that will also identify sensitive data, but then it'll automatically understand what the best masking scheme is for that data, and then apply masking so the data becomes sanitized as it moves from production to downstream environments like the devs and the QA people and so on. So the examples can go on forever of that type of
Sure.
management analysis.
Yeah, no, that makes a lot of sense. I think that's one thing you're seeing a lot now in this space, or specifically in the last year, is really around the idea of, being able to understand what the data is maybe trying to tell you, but then also having some sort of action taking place, using that data. And you talked about masking some of the information, where maybe you're understanding metadata that's happening, but then, creating action. And I think those are two sides of the world where, maybe the traditional RPA players say, they're the action layer and they can create action. And then you have kind of the more AI enabled, call it information gathering, platforms out there that are ultimately, finding problems or questioning things. And then you use the traditional RPA vendors like a UiPath or Automation Anywhere, such as that. At least that's what they're selling today, right? They've gone from, I think they've gotten blunted a little bit by the idea that you can throw these co-pilots on your computers. And in some ways, they can source new creative things for you. But then you have to take action and, send that invoice and send it to your box, registry, and tag it the right thing and do so in that way. But, spinning gears a little bit is ROI. You are the ROI guy, or ROI dude. And that's the ultimate question here. We got earnings from NVIDIA, and, while they have a, $36 billion quarterly run rate that, gets out to, 150 plus. When you extrapolate that out, a lot of revenue NVIDIA is driving, 75% gross margins. NVIDIA is driving, that's like software-like revenue, despite only, I think they called out on the earnings call, $2 billion run rate for software, which is, pretty small when you think of the landscape of software. I know it, you need the software to use the hardware. That makes a lot of sense to me. So there is the attach rate here. But more broadly, ROI in this space, I think that's the ultimate question. Like, who's actually making money? How do you make money? How do you actually get an ROI on this? If you're a company that's just adding an agent or a companion into your product. Like, what do you view? How do you view the ROI in this space?
Ultimately, I think it comes down to productivity and efficiency, but that's not always so easy to, model out, especially model out to somebody who's got a budget and has to make a decision. So what I tend to focus on in those types of situations is what is being replaced by using AI to automate it. And in Lightbeam's case, it's a lot of the traditional type of cybersecurity tools. In Cognito's case, it's traditional RPA cost. And more than that, it's, if you're using a traditional RPA to automate a work process and something changes, which it always will, then you have to go back in and hire developers and have them come in and change it all. And, it's extremely expensive and cumbersome, where generative AI can just detect those changes as they come up and then automatically change them on the fly. There's also kind of behind the scenes of all this happening. You went talking about NVIDIA. NVIDIA chips are hard to get at any price. And then, where do you put them and how do you spin them up? And so now you see these organizations coming out that kind of host NVIDIA chips. And one of them I really like is called Farm GPU, where it's a different model because instead of raising venture capital, they actually have people invest. As an investor, you buy basically NVIDIA GPU at cost, and then they rent it out through their environment, all automated. And so because of it, you can predict what the rental patterns are going to be. You can go back in time and see, you can go forward in time and see. And, investors are, can get 30% returns. And then the company can grow without having to, at least until they're ready, going to the traditional VC route and starting to dilute the company. So it's NVIDIA's spawned this massive ecosystem out there behind the scenes that, again, is going to open up all kinds of opportunities.
Yeah. So, it sounds like productivity there's obviously, different forms of productivity. You can get sales productivity and stuff like that, which then drives, it more drives margin than it does, absolute top line dollars. I think that's maybe the best way. That's what you're seeing today, right? Is, maybe you have, a PagerDuty, right? Where that's been AI this whole time to begin with, or CrowdStrike, right? Which is, analyzing the networks religiously and in the cloud and doing so using their versions of AI. Generative AI is obviously a new, version of all this. So yeah, productivity seems like a pretty good use case in terms of how you drive returns. The question, I guess, then is more revenue. I guess the new AI platforms that are allowing you to drive productivity is where maybe the revenue comes from. But if you look at the legacy ecosystem today, all the tools that we all use, specifically call it consumer facing, the Microsofts of the world, the Googles of the world, some of these other platforms that exist that we use day to day. Are you seeing ROI there, or is it, I guess one thing that we've thought about is at the very least, right? You add a companion to your platform, and all of a sudden it's summarizing everything you do and or giving you meeting notes and stuff like that, like Zoom's AI companion. As you use that more and more, and then you create a database of all your summaries. Yeah, I mean, you're likely or less likely to turn off, even if you're not paying anything for it specifically. It's not like an add-on feature. So maybe that's it. You're reducing churn, which I guess in theory you're increasing renewal productivity in that scenario. So just like it's an open question, open thought, and leaving the floor to you.
Yeah, and I think there's no question. I focus personally in a B2B type space, but I'm involved in the business to consumer. And you get companies like PeopleRain with an automated, AI agent that, specifically goes out to answer questions very quickly for employees. And they have ROI models showing the type of improvement in productivity you get. I know in my own personal case, I don't use AI to write a post. I don't like the way it comes out. It feels kind of plastic and stuff, but I will use it to edit it and fine tune it and pull in maybe anecdotes that I'm unaware of. And, I've cut my time down writing white papers and posts from days to, literally hours in my own use case. And the research you can do now is just so astounding. So I use it every day, probably every facet of my career. And I know lots and lots of other people that do the same. So it's hard to measure, but I think there's no question that it's out there. But now I'll throw it back, so CIOs know they got to go to AI, even if they don't have it quantified. They know it's inherent for their success. I think something like 79% of CIOs know they have to do this. But then the problem becomes, how do you control it? How do you safeguard it? What data is getting out there into the wild? What type of, how are employees using data internally to search for their salary of their boss? Things like that. So again, there's now an industry that's spawning to put guardrails around AI, and the company
governance,
is called SurePath.ai, another startup, former Cisco guys. So they have the kind of network background, and Casey Blinker talks about really this kind of AI paradox that you got to have AI, but you're scared to death put in AI, rightfully so. And so what SurePath does is they put in those guardrails and help CIOs feel very comfortable now that they have control around it, instead of everybody just going out to public AI whenever they want. And you can't just block AI internally, because that hurts productivity, and B, now you're just going to spawn shadow AI, where people
that's even worse.
Behind the scenes, just like shadow IT for all those years.
For sure.
You got to put in, you got to control it. So I'm really excited about what they're doing. They just raised 5.2 million, in their initial raise, and so it's pretty exciting.
Yeah, I like the governance side. I mean, we spoke with Comfer, which are the ex ServiceNow guys. I think he was the head of AI there, and then they started like more of a governance platform. And at the very start, that always made sense, right? Like, this is the Wild West to some degree, when it's saying things that in theory could not be true or not be right, or you don't know exactly. You're just trying to govern, just to make sure you have some sort of wrangle around, how people are using it inside of your organization. Not to mention that this stuff costs money, right? And each query costs $1, right? Whatever it is. And, you don't want these kind of overruns. It's kind of like the Tableaus and, Domos of the past, where you'd give your employees access to Tableau, and they were just spinning queries all day long, and then using, their compute resources at like AWS or something. And then they would get a fat bill that was, and then there you had to govern it. So AI, very similar, but even more expensive to some degree. Last little thing here is, I really wanted to ask around, obviously you see a bunch of these companies, you've spoken a bunch about some of the ones either you advise to or invest in, or just have seen in the wild. There's this conversation around AI and employment. And, I think there's no one better to maybe even, just think about it. Which is, you're seeing these companies develop. Are they using less people or more people? We talked about productivity, ROI. There's the fear that AI will disrupt jobs. Now, from what I've seen from my lens is, companies that are building, are still building and hiring people. And, there's plenty of people being hired, maybe for different roles or higher level roles. But what are you seeing in the field from the companies that you deal with? To, from the startups to the big B2B organizations you're talking about?
I think there's no question that AI displaces people, but I think there's also no question it creates more opportunities, for jobs and for higher level positions. And like I talked about, this whole, just NVIDIA alone, this whole massive ecosystem that it's spawning, you still need people to do all those different types of roles. So I just look at AI as a super assistant is maybe a good way to look at it. And it is going to eliminate a lot of the, just like technology has done since the beginning of mankind, it eliminates a lot of the manual tasks. But those also tend to be the mundane and the monotonous task. So the good thing is that then it focuses allows people to focus on higher level activities that actually add way more value to the organization, that are more self-fulfilling, that add value to their careers. And, I said, we've seen that from the early days. I remember the early days when we were pitching VMware, people would say, the application owners would say, you will never put my application into a virtual machine. And you just had that kind of resistance in IT, rightfully so, because they're kind of charged with making sure everything always runs. And so change is always a threat, but change is also inevitable. And AI is going to help facilitate that everywhere we look, in IT, out of IT, consumer, business. And, it's, you mentioned in the beginning, is it transformative? It's already transforming. In my opinion, AI is changing the world.
Yeah. I mean, most of the companies you've spoke to just now are, have been born because of this AI movement. So it's like, it's for all the people that are being left out or, maybe being let go or not hired because they don't need them, they're, the land of opportunity where you can, go out and create something. And now no code, low code is easier than ever. So you can build a website in 2 minutes. You can create all these different white papers, to build an audience. So I agree. I think opportunity is likely more, of what's going to happen here versus, the takeaway of industry. And then maybe there'll be some hiccups here and there in terms of, big layoffs of one company and people get spooked out. But more times than not, what we've seen is technology is a net positive for productivity and driving change. But, with that, we have a couple more minutes. I wanted to leave it to you so you could, tell people where to find you more. I know you have a big following on LinkedIn and maybe some other platforms, but, just leave you the floor so that you could give people a place to find you.
Yeah, best place nowadays is LinkedIn. We use that extensively. So Stephen Kaplan on LinkedIn. You can type in Stephen Kaplan Tessell, and hopefully I'll show up.
For sure. Cool, man. Well, Stephen, thanks for joining today. We'll do it again. And congrats on everything so far.
For our final session, please welcome Reagan Bonlie, founder and CEO of Nudge Money.
All right, we are back with our last session. We have Reagan Bonlie, the founder, CEO of Nudge Money, a fintech provider out there. I've spoken with Reagan, in the past, and he's building something pretty cool. So I thought it was great to have him on here, tell his story, what's going on in fintech land, how AI is being infused of their platform. But welcome to Avory Idea Day 2024.
Thanks for having me. Glad to be here.
Yes. Yeah. So tell us a little bit about, your background in general, and for the audience sake, and then also, we'll get into Nudge Money and what you guys are doing.
Yeah, absolutely. So I spent 12 years at JP Morgan, from working in the branch up to executive levels, and oversaw a team in wealth management. And through that time, I realized that a lot of the best financial guidance is reserved for the high end of the wealth spectrum and not available to the vast majority of the population in the United States. When you have about 2/3 of the population living paycheck to paycheck, not enough money saved for retirement, realize that there's a lot of those great best practices to leverage data and communicate with people in a better way to help empower them to do more. So I realized that there's a big opportunity out there to help primarily financial institutions better communicate to deliver that financial wellness and behavioral science at scale. So that's what we do. Essentially, we help credit unions uncover and convert growth opportunities while delivering personalized financial guidance that helps them basically achieve their mission along the way.
Right. So this is a B2B play right now. Talk about a little bit about how the consumer interacts, or the end customer, let's say. Who is the end customer? How do they interact with your software?
So right now we help credit unions primarily. So the end customer is their members or their customers. And oftentimes they don't know that we're working behind the scenes, but what we do is basically we help the credit unions better analyze the data to understand financial goals, financial behaviors, challenges. That way, when they make a recommendation, when they communicate with their members, they're doing that in a more thoughtful way. And that's it's personalization is an increasingly important topic, and especially when you have credit unions, financial institutions of all size that may or may not have that ability to leverage the data and the marketing solutions, people want it. Whether it's customers of banks, members of credit unions, people that have insurance policies and insurance agencies, they want that personalization. They don't want to get bombarded with a ton of different recommendations and products that are just not relevant to them. So that's the primary application of how we support and how the members interact with us behind the scenes. We also offer some digital tools and things like that to personalize the experience, but primarily on the data and personalization side through marketing.
Sure. So obviously fintech in general, we've had a couple different conversations and sessions so far. Ian Carr, who has been in the fintech space for a while, building his own company again, and then we had an AI VC platform or firm where the founding team was mostly fintech analysts at heart, and you're seeing this fuse of AI and fintech, specifically obviously around transactional data and what that means for things like credit risk and, call it management of money. Talk about how, Nudge Money is incorporating, let's say, like the legacy AI, but then we'll also bring it to the forefront of what's happened in the last 2 years, which is really around generative AI. So if you could just discern like the distinction between the two, the generative aspect of maybe how you're incorporating that, how you're not incorporating that in other ways of using AI, but also, what are you doing with AI more broadly?
Yeah, absolutely. So there's a lot of ways that AI is being used currently in financial institutions, from helping with efficiency, things like back office tasks, productivity, so helping frontline staff dig through policies and procedures more effectively, growth, so being able to leverage AI to better understand data and market to members. So we leverage a number of different types of AI, including what you had mentioned, which is digging through transactions, because that's still a big hole in the industry, is that sometimes for certain financial institutions, you can go buy something at Walmart and the financial institution won't even know that that was a Walmart transaction. It might as well, been at a gas station, or that could have been a check. But so those are some of the fundamental things that we do. And the first step for us is understanding the member or the customer. So we leverage a number of different tools for that, all the way from the most basic, like deterministic algorithms, to understand, just calculate, how much they have in their accounts or how much they have in their emergency fund, all the way to machine learning, which will then help us sift through transactions, recategorize things, start to pull out behaviors and insights. Then we'll leverage NLP to then understand spending propensities, what's actually going on in the member's financial life, what are financial goals that we can pull out from that, what are behaviors that we can understand through those spending transactions and product adoption and things like that. And then where it gets really exciting is that we take those insights and we actually craft the messaging that's aligned with their behaviors. And we are the first company to do that, which is helping connect the dots between how they perceive information and their data, what's actually going on in their financial lives, so we can speak to them to empower them to act on a product that's right for them, or empower them to improve their financial well-being.
Got it. How much data do you actually need to actually make an impact, you think, from your point of view?
So yeah, that's where it's exciting, because we can over time provide a lot of value to multiple financial institutions as a network to pool data in a very safe and secure way. When we help a financial institution, we create models uniquely for them in helping understand product and financial wellness opportunities. So inside of the financial institution, we're helping them really level up what they're doing. But then over time, as we start to bring on more and more credit unions, and then ultimately different types of financial institutions, we can say, okay, well, based on these types of customers or members, this is how they actually react to certain types of messaging. Have you ever done the coin flip test?
I have not.
No? If
I don't think so.
If I flipped a coin and it landed on heads, and I gave you $150, you'd be excited about that. But would you take that bet if it landed on tails and you had to give me $100?
Oh, I don't know. You're gonna get me on air. I would not. I would take the bet, right? I think so. Yeah, I would take the bet.
Okay. All right. So you're not as adverse to loss. Mathematically, it makes sense. We're on the same page because, you're at a game statistically. But most people, 52% of people, will not take that bet because the pain of losing the $100 is much more than the possibility of winning the 150. So that's what we're getting down to is, how do you speak to that person based on the way they perceive information? That's just one behavioral technique, but there's many more, like social proof and other things. So, ultimately empowering that person to take action and then improving their financial well-being over time. So, once we have this large group of financial institutions where they can learn from each other and learn from spending patterns and behaviors, then broadly, we can start to make an impact by delivering more effective messaging.
It's funny. It almost sounds a lot like, if I just stepped away and then, didn't realize what you did for a living, fintech and, money management, some of the terminology being used or some of the thought process would be like a social media and a platform and understanding behavioral traits and behavioral, characteristics of somebody to then drive an outcome. It sounds very similar. And again, I think you're doing it for the state of good, right? You're trying to drive financial well-being, but doing so in a way where it's less about the numbers crunching it. And it's more about, how people feel and how they'll react to a certain feeling to then, make their lives financially, improve it a little bit more from time to time. So how much time, I guess, are you guys spending internally thinking about psychology? And how much time are you thinking about actually, just the logic of like, if he does this or she does this, then we do Y, we do X. How is that being, I guess, incorporated in kind of your models that you're running to then help assist some of these users?
A lot of that is automated. So we've incorporated most, if not all, of the most important behavioral economics techniques into what we do. We're constantly going to learn from that, but a lot of the AI does that for us, is that we could pull out the insights and analyze it and then improve. What it really comes down to is the technology stack of financial institutions. It may not be as easy for a certain financial institution to personalize to the level that we really want to personalize. Thinking of a message like, how would you feel if you could achieve your home ownership goal 1 year early? The how would you feel and speaking to their particular financial goal of buying a home, that's fairly easy. But when it comes down to us actually doing the calculations and understanding that it's 1 year early that they're going to achieve that goal, that includes a lot of work from the marketing side of things and data side of things and tying into different technologies. So we're constantly learning from, how can we get more embedded in the technology stack, help make their lives easier as financial institutions, and then deliver that really powerful personalization that helps them adopt products, that are relevant for them. So it's I know that was a broad way of answering your question, but we're constantly thinking about it. The AI makes it easier for us to do our job.
Yeah. No, I'm just fascinated with the psychology aspect of this. Previously we spoke with, the team at Duolingo. Duolingo tries to get you to learn language. Not something that the average person wants to sit down and do every day, but somehow they have 100+ million users doing this every single day, trying to win streaks. People ask them their success, why they're successful. And Louis Vaughn, the founder CEO, often says, we just A/B test everything. And, we A/B test our way to, kind of outcomes. It sounds like financial well-being could go down that same path where you're asking a certain question in a certain way and it's getting a certain result. So you put that across your whole platform, and then you're constantly, changing colors, doing this to try to get people to react. When you said the 1 day or 1 year ahead of time, emotionally, I felt, positive towards that question. And you're more likely to act. So how are you embedding things like, how are your systems running, training, then running A/B tests, or maybe not? Maybe that's a future path for you guys in the roadmap, which is, again, incorporating everything you've learned so far, running A/B tests, and then making the model even more refined over time to then drive outcomes. Like, again, it's an open-ended question. It's not really a question. It's more of a conversation starter. But how are you thinking about, that?
Yeah, we absolutely do ABC testing, and and there's a number of different things that we're doing there. Is testing the content itself, and then aligning it with the data. So if they're and we're the only company to do that, is actually say, okay, well, we believe that this person, like you, Sean, is less risk adverse. We can speak more to the positivity and, show the benefits and the positive outcome of achieving this based on what we see from the spending data. But, obviously we can get that a little bit wrong, and we need to tailor that messaging, not only the benefits, but to social proof, like other people are doing this. And then, constantly realigning the data, and that data becomes stronger and stronger as we bring on more financial institutions. So yeah, it's a constant learning process, and, being at the forefront of this, I would say candidly, we're earlier on in our journey, but what we do today is really help financial institutions level up what they're doing, because it's an old, antiquated system. They just don't have data and marketing right. So we can provide a ton of value, just at the same time help them be at the forefront of the behavioral economics research that we're doing.
Got it. And then the generative side of AI, obviously some of the stuff we've been speaking about, you're talking about text, emotions, vocabulary that drives some sort of outcome. The last year and a half, the last 2 years since, ChatGPT came out and Llama 3 and, all these other models, it's really been focused more around text than it has around audio or even visual. Obviously that's on the way. We know that, to a level of proficiency that will probably be, mimic reality. But for now it's been text, but it sounds like that would benefit you guys, tremendously over the last several years. So as that has developed, progressed, gotten better, what has that opened up for you guys from your product roadmap?
Oh, yeah, absolutely. Big time. So where we started was we had former executive marketers of financial institutions and credit unions and behavioral economists that were actually writing these every single nudge. And we've built a repository of over 2,000. We were customizing it for each institution. And then what our AI would do was select a nudge off the shelf. That way it's pre-approved and compliant, but it was handwritten by us. And while that was a, very innovative process that we were doing, now we can incorporate a lot of the different styles in which the financial institution wants to deliver, meaning they have their own brand voice. They want to deliver a message in a certain way, with more excitement or more emotion. They want to have a specific type of call to action. So basically our system can help that marketer while they're sitting there, instead of trying to rack their brain on what's the best way to craft this message, they can leverage our tools, which incorporates Gen AI and LLMs, to then help them construct a message that's behavioral based, data based. So it's really helped us take it to the next level. But certainly there's not an LLM out there that's pre-built for something like what we do. There's a lot of best practices, a lot of data that we got to connect to, to really create that impactful moment for the member as the marketer's creating that message.
Got it. And then you're also building a business, right? So how does Gen AI change maybe your perception of like the type of people you need working around you, either supercharging the ones you have now, or, the roadmap of, we need X amount of talent to join our organization. You've probably been thinking about this, in phases, right? 6 months ago is probably different than 3 months ago, different than today, than 12 months ago. But where are you in that, mindset of building your business and thinking about human talent and, the world of agents and co-pilots?
Yeah, it certainly helped us do our job better. I mean, just from across the board, from just the basics of efficiency to improving our processes. But obviously, our core product is surrounded around AI. So we have to staff, great AI people, including 2 amazing AI technologists, a behavioral scientist as well. And then we leverage different data scientists as we need to make sure that we're properly sifting through the data, better learning at all time. And those folks aren't cheap. They're certainly demanded at this point in time, but I think we're constantly going to need that type of next level talent to make sure that we're being at the forefront of the innovation. Did I answer your question?
Yeah, I mean, yeah, for sure. I mean, it sounds like it's more of an enhancement than it is a replacement at this stage.
Right.
And you're building your business, so you're trying to supercharge every individual that, and then at the end of the day, you're likely not thinking, 5 years in advance of, how many number of people you need versus, where do we need to get to? And therefore, it's hard to judge, how many people you would have needed versus what you need now and stuff like that. But the idea of productivity, we had some other conversations again with others talking about productivity seems to be the biggest role today, as opposed to replacements or even driving revenue to some degree. It's enhancing the product, but not necessarily a paid feature or paid product at this stage. Shifting gears a little bit to the broader landscape of fintech, you've been in the investment world directly at JP Morgan, but you've also sit here in the lens of building a business that is fintech related, talking to credit businesses. And what is your views of like the state of fintech? I'm sure you go around and talk to different companies out there and collaborate with different founders. What is the state of fintech? Like, what's the most interesting thing happening right now? Not named generative AI, let's say, but you can go there if you'd like. But just the state of fintech more broadly. Like, what are you seeing? What's interesting?
Fintech is a melting pot of a lot of things. You can you can call a lot of things fintech, and even where I would say we're primarily fintech, we also cross into the bounds of marketing technology as well. Our product can ultimately help BMW sell their cars better, where that's not in the cards for us today. That is there's a lot of overlaps in those sectors. So obviously payments and even buy now pay later are things that are quite popular. I would say where I am excited is just this AI is unlocking a lot of different categories in subsectors of fintech. We're particularly excited for AI to supercharge credit unions, and I think there's a lot of opportunity there that's just it's been beckoning to be unlocked. But generally in terms of fintech itself, payment seems to be a good trend. We just saw the Klarna, I think, recently IPO'd, so that's we're starting to see a little bit of activity there. Even though buy now pay later is not something I'm personally a fan of, that those tend to be the trends as you show up to Money 2020 conferences. You hear a lot about that, but there's some exciting opportunities I believe in the data space, personal finance, wealth management, and we're kind of in that the crosshairs of those things. Yeah.
Got it. So why credit unions? And then also just give us the state of your capital raising today, or even just capital needs, not the dollars and cents per se, but more so, what's the health of the environment around capital raising within fintech, more so than, maybe some of the personal stuff at Nudge.
Yeah. So so credit unions, to your first question, is it's a movement that is deeply based in their mission to drive financial well-being, and it makes it easier for us to convey our message to these people that are aligned with what we do. Behavioral science can be used in the wrong way. And there's been, controversy about that. So doing good while helping an industry grow is something that's exciting to us. And, that's the right group of financial institutions to help us carry on our mission so we can help them carry on their mission. But beyond that, there's, obviously community banks and larger banks, digital banks, other industries, insurance, wealth management. They are looking for better ways to communicate with their customers. Just at the end of the day, helping them do good builds a stronger, stickier relationship. Sure. And then as far as us, we recently closed a pre-seed. So we hired who we needed to. We got a rock solid team. So
congrats.
That helps us. Thank you. That helps us get to the next stage of bringing on. We're targeting 10 financial institutions, 10 credit unions by early next year, and we're well on the way to do that. And then from there, by say middle of next year, then we'll be opening up our seed round, helping us get to the next stage, which is we've already started many conversations with the medium to large size credit unions, and then by that point, starting to look at what other types of financial institutions from mega banks, digital banks, things like that, where we can make an impact as well.
Cool, man. Well, congrats on that. I did want to take a moment here so people could learn more where to learn more about Nudge Money yourself. Obviously, I follow you on LinkedIn and read all your stuff when it comes. We've communicated in the past, but just where can they find more about you and the company?
Yeah, absolutely. They feel free to reach out to us. You can find us at nudgemoney.com. Reach out to me directly. Always love to have a conversation. So Reagan, Bonlie on LinkedIn, easy to connect with me there. I tried to get on Twitter for over a decade. You won't find me there, but or email Reagan at nudgemoney.com.
Awesome, Reagan. Appreciate you coming on. Reagan Bonlie, founder of Nudge Money. Very successful so far, pre-seed to now hopefully get into the seed round. We'll be tracking you, and thanks for coming on to Avory Idea Day 2024.
Sounds great. Thanks, Sean. Thanks for having me.